of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery.
Okay.
It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
From our global headquarters in New York, I'm Danny Berger alongside Manish Cranny in London. Let's set your agenda.
Biden vows to stay despite two critical mistakes. The president stands firm. He will remain in the race. Earnings season kicks off today. Traders await numbers from the big banks, JP Morgan, Citi and Wells Fargo. The results hit the tape before the bell. And Tesla delayed. Sources say the EV maker is postponing its robo-taxi event. It's a blow to Elon Musk's autonomous dreams. Danny, good morning.
Good morning, Manis. It was relief yesterday from a very good CPI report, one that had central bankers Goolsbee and Daly saying essentially, we are there. The reaction was palpable in the bond market. Two-year yield drops by double digits, down by about 10 basis points. We are flat this morning. 4.51% is where we stand. Opposite reaction in equities, and it was all because of the Mag 7 helping the S&P break its 7-day winning streak. Mag 7 has its worst day since 2022, while small caps have their best day so far of the year. Small caps, you can see on the bottom of your screen, still outperforming this morning versus a flat S&P future session. Meanwhile, dollar versus the yen. It's unfortunately for the BOJ. It is yen weakness again this morning after we learned that they spent $22 billion in looking at their accounts in propping up the yen. We're at 159 despite the fact $22 billion of intervention, Manis, plus a cool CPI report. Kit Jukes from SocGen with us moments ago saying that if they want to see real movement, they're going to have to spend a bigger chunk of change.
It's a brilliant moment of where you see central banks make hay while the sun shines for them. You saw that, pressure on the dollar yesterday. In they come. Kit Jukes from SocGen says, look, it's going to take an awful lot more to get from the 160 level to the 140 level, and it's going to take a heck of a lot more intervention than what he has seen so far. And so much of the gun is loaded in terms of being long dollar to the yen, and that monster carry trade. Danny.
Yeah, although he did say in a year's time the yen will be weaker, considering the trend across global central banks is to cut, save for the Bank of Japan. Now, elsewhere, Manis, we have to really dig into the reaction to the CPI report. Priya Misra, portfolio manager at JP Morgan Investment Management, writes this: stock-bond correlation should come back with the Fed in play. Owning high-quality bonds makes sense as a hedge to equities. Priya joins us now. Priya, good morning. Great to see you bright and early in the studio. And look, I know you've been advocating for quality bonds for some time, but this is a market that looks at political risk, confusion over the path of the Fed of when they're going to cut, and says the only thing I can buy right now is tech. Did yesterday change that?
I think so. You know, I think we've been sort of, will they cut, will they not cut, how much do they cut in terms of the Fed? And until the Fed starts to cut rates, all the cash is happily sitting on the sidelines. If you're earning 5.5%, why bother extending out the curve? Well, that changes because what Chair Powell's been telling us and the Fed's been communicating, they need some more good data. Well, we had great data. We had data, you know, other than the headline number that was weaker than consensus. If you look under the hood, it was shelter. Shelter really has been downshifting slowly. There's inertia in that. So as the Fed gets comfortable that we're heading back down to 2%, I think, you know, people start to move out the curve. The other thing that the Fed has been telling us is risks are getting balanced. I think there's been a subtle shift in the message from the Fed that instead of the fear, and the market's getting there too, the market focus, the Fed's focus is now moving away from just inflation to growth. And what the Fed's telling us is if things start to slow down, and we're seeing some cracks, absolutely. The economy is slowing. I think we don't know whether it's slowing below trend or it's sort of staying around trend. But if things slow down, the Fed's going to come in and they're going to cut more. So I think owning high quality bonds, it's giving you income. It's given you income for a while, but it's giving you that hedging property, which it hadn't had because we were so concerned about inflation. You highlight political risk, that's absolutely you know, out there on the horizon, but the election is still 3-4 months away. So I think until that, if things slow down, we have a big retail sales report coming up. If things are starting to slow down, we're going to price in more rate cuts. Yep. I don't think the market's overdone.
Priya, good morning. It takes me to come to London for a few days to get you into the studio at 5:30 in the morning, but it's good to see you. It's good to have you on the show. 7 days ago, Danny, yourself and myself sat around the desk and we discussed bear steepening. Here we are 7 days later with a very, very important piece of evidence to promote duration. How does that play into your view on the curve now, 7 days later?
So, you know, you would say, what does one data point do? Well, it gives the Fed confidence. It gives the market confidence. On the steepener, so I've had a lot of conviction on the steepener, whether it was bear steepener or bull steepener. I think now I have more conviction on duration itself. And here's why. As the Fed starts to cut rates, and we think we're there in September, you know, whether it's September or November, the Fed's almost there. The curve can continue to steepen, but I would look at duration because in a soft landing scenario, the Fed cuts to, let's say, about 3%. In a hard landing, they're cutting much more. But, you know, that's where what's priced in, 3.5 end point. I think we move away from when do they start to the totality of cuts. And in a soft landing, I would argue there's still more room for rates to fall in that belly of the curve, you know, that 3 to 7 year sector. We do think those rates can fall in a soft landing. And here's where that hedging property we were just talking about, you get any weak data, the market's going to price in more cuts. We should price in the scenario that there's, maybe it's a 20% chance. 20% chance that the Fed can cut much below that 3.5 is why that duration now starts to look attractive. Look at all-in yields. If you're getting 6% in high-quality spread product, you're supposed to buy it now because in the next 6 months, that opportunity is going to go away because just Treasury rates are going to start to fall as we sort of embark on the easing cycle.
I really like that idea that this market's going to concentrate not on when we cut, but how much we cut. Because that is a debate. There's a difference between a mid-cycle tweak and a full cutting cycle. So what difference does that mean for you in your duration allocation? You say it's attractive either way, but how much can you fully go in if it is a mid-cycle tweak versus more aggressive cuts?
Right, great point. Soft landing rate cuts are rare. They're rare, they're hard for the market to get its head around because we haven't seen it. Now, we're in a soft landing right now. I think the question is, do we continue? To your point, I think conviction on duration has to be a little less. So are we putting our entire risk on? No. Given the data right now, we might persist, you know, we might stay in the soft landing. In that scenario, the Fed cuts to, let's say, 3%. So then how much can that 10-year fall? The 10-year then should probably be between 3.5% and 4%. We're not that far from that. So I would put less, you know, I would put some risk on here in duration, just not max risk. If you start to see signs that the cracks that we've seen cracks in low-income consumers, small businesses, if they start to broaden out, if we start to see those job numbers, and again, I would say we don't look for negative payrolls. I think anything around 100, 150 is telling you that unemployment rate's going to rise. Well, then you add a lot more duration. So mid-cycle correction would be, I would say, 200 basis points of cuts. Recession, we're talking a lot more. That's when I think that duration, the amount of risk you can put on duration starts to increase.
Well, I just wonder how much of a canary in a coal mine was the Delta numbers yesterday, talking about oversupply and finding that's the first time I've heard a major airline talk about having oversupply in the cabins. Priya, we've heard the message loud and clear. You're now building towards a duration position. We had Padraig Garvey in the seat yesterday from ING, and he said, look, if Biden steps down at any time, and let's assume Kamala Harris steps in, if Biden steps down, he sees it as being a risk-off event and a driver of money into bonds. So just stand back from the noise of the politics at the moment. Would you see that kind of conjugation, in other words, a shift in the Democratic ticket, could be perceived as risk-off event for all the fiscal issues around it that may reverberate? Could you see that provoking a further leg up for duration?
So I think political risk is so hard to price in. You know, these are binary risks. But if I go back a month, I think we were pricing in divided government. What happened in the last month was that probability of a Republican sweep increased, and I think people zeroed into to fiscal stimulus. So some of the rise in rates, particularly in the long end, has been this idea that the deficit will increase much more, that we're going to get fiscal stimulus. If that starts to go away, I think yes, I think the knee-jerk reaction would be lower rates led by the long end, as this idea of either divided government or not as much fiscal stimulus starts to get priced in. But I will still highlight there are going to be many such opportunities. The market's shifting from one narrative. Remember, just a few months ago, we were talking on the show around, you know, higher inflation, re-acceleration. Then there was concern around recession. I think we're seeing something very similar. So I think you're supposed to fade these extreme moves. Now, if today was end of October, I might say hold off, de-risk. But we've got plenty of time between now and the election. So I think if you get too much of the lower, I think knee-jerk, absolutely. But we'll be watching for, you know, has damage already been done? So, but if it looks like the Democrats are gaining ground, the first move would be lower rates. But then if you get a Democratic sweep, I think rates might rise again, because then you might get more spending. So there's plenty of things that can move us, and I would say let's try and fade some of those up until the election.
It sounds like a bifurcated bond market, traded right up until the end of October, and then review, redux, reload. Priya, thank you very much. Priya Misra of JP Morgan. Take your opportunities on this rolling bond market. Coming up on the show with Danny and I, the plot to persuade the president. Biden doubters grow in number, so do his lapses. More on the race to the White House. That's next on Bloomberg. Context matters every day from London and New York. Good morning.
The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know the areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything. Top names in global leadership are on Bloomberg.
China has started to provide Russia with different types of aid, not direct military aid, but issues linked to energy, sometimes even dual use of goods. I argue that Russia is so dependent on China right now that one phone call from President Xi Jinping would solve this crisis. If he were to say, time to start negotiating peace, Russia would be forced to do that. They would have no other choice.
I would like China to play a serious role. Russia really depends on it because they don't have another place to export many of their goods because of the sanctions. The president of Finland, he is right. China could play a tremendous role without weapons.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stradwatts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Now I want to hand it over to the president of Ukraine, who has as much courage as he has determination. Ladies and gentlemen, President Putin. President Putin. He's going to beat President Putin. President Zelensky. I'm so focused on beating Putin, we got to worry about it. Anyway, Mr. President.
I'm better.
You are a hell of a lot better.
Moment on stage at the start. That was Joe Biden misspeaking last night at the NATO summit in Washington, as well as confusing Zelensky for Putin, the president whose mental sharpness is in the global spotlight, referred to his vice president as Donald Trump rather than Kamala Harris. Still, the president vows he isn't going anywhere. He's still running for a second term. Our Brussels bureau chief, Kevin Whitelaw, joins me and Danny now. Kevin, look, it's almost like deja vu, isn't it? This was the start of the press conference. This was the moment, and there was another lapse. Does it embolden the doubters? Does it embolden the fuel that they really need to act quickly?
They certainly did nothing to douse the flames. I mean, that's clear. Even though most of the rest of his full press conference was a pretty strong performance, he had strong words, he had cogent arguments, and answered questions pretty well. That moment and the moment where he called his Vice President Trump, that is, that's what everyone was looking to see if it was going to happen, and indeed it did. And so it does nothing to change the overall narrative of a Democratic Party that's increasingly panicking about the risk that they'll lose not only the White House, but also the House and the Senate come November if Biden stays in the race.
And it brings up the question of, could anything change it if all we're focusing on are slip-ups, and I mean consequential slip-ups, but nonetheless small slip-ups at that. So Biden has said, he talked about this in his interview with George Stephanopoulos, saying it's the Lord Almighty that could convince me to drop out. Well, there's this report saying from the New York Times that some of his allies and some in his campaign are looking at a plot to persuade him to drop out. Is that equivalent to the Lord Almighty, Kevin?
I mean, I guess it would depend which allies and how hard they're working. I don't think we have the details of that. But, I think that Biden went into this race with the same calculation he did in 2020, which was that he was the Democrat best place to beat Donald Trump. And it's not clear that he's seen anything yet to change his mind on that, even if you're starting to see other people have those doubts. And so, his family's going to be super important in that. He does have some close aides that have been with him for years. But, those are also the people that have a fair amount of incentive for him to stay in the race. And so we don't really know what they're saying in private. And we don't really know what that actual conversation is. The other risk for Democrats is the polling isn't entirely clear that replacing Biden, we don't really know how much of a boost that would get. It's a very difficult effort to try to introduce someone effectively new, even if it's the vice president, into the race right now. And so there's sort of a pretty strong unknown either way. The Democrats could simply make the call that the vote is actually Trump or not Trump, and any not Trump is about the same when it comes to the outcome. If that's what they conclude, then, I expect
Kevin,
we'll still see him in November.
How important or how pivotal will this polling be that apparently the Democrats are doing, which is to understand where Kamala Harris ranks relative to Biden? Is that enough, you think, to shift Biden? I mean, there was a small window where he says there are other people that could beat Trump too. I mean, this I thought was quite interesting nuance. If they came back and said there's no way you can win, will that poll be a pivot enough if it comes back and sends a message to Biden?
I mean, we don't know, really. The polls have already been grim for Biden even before the debate, and the path to victory was looking rather narrow. The problem is you're coming to something that is the hardest thing for polls to measure, which is turnout. And it's going to be that question come November of how motivated people are to vote, how many of them go out. And some of them are going to be motivated to vote for or against Trump, no matter what. So then the real question is, what about the people who are on the fence? What about the people who are a little fed up with their choices? You know, is a Kamala Harris or another Democrat going to move the needle for them any more than Donald Trump? Polling is pretty hard to sort of nail that down, particularly when it gets to the fact that we're only looking at a handful of states where it really matters.
Yeah, I mean, polls can't exactly account for all the new information that voters will have to absorb. They're basically just asking now, tell us what you think about someone that you haven't had a lot of time to think about at this point. Kevin, we appreciate it. As always, Bloomberg's Kevin Whitelaw. Now to the earnings that we're going to get today. Shares of the biggest U.S. banks have been on a tear this year, with all but Morgan Stanley outpacing the S&P 500. J.P. Morgan, Citi, and Wells all report their earnings today. With us now is Bloomberg's Sonali Basak to get into this. Sonali, what are you going to be focusing on today in these earnings?
Listen, Danny, there's a lot on the line on these earnings, not only because we're halfway through the year, but because there's so much uncertainty ahead. And if you look at J.P. Morgan, Bank of America, Citigroup, and Wells Fargo, the question is, do Main Street businesses perform just as well in this environment? You saw this knee-jerk reaction yesterday when you saw the CPI data came out. When you saw that sharp drop in yields, you also saw the biggest U.S. banks also fall. And they recovered a lot of those losses, but it just goes to show, even if interest rates drop, the question is how much juice is there left in the consumer to keep on borrowing? You had Bank of America earlier tell investors that they think that the second quarter, so the current quarter that we're really seeing come out in the service now, really be the bottom for that net interest income, but how much can they recover is the question. And also, how much can they all keep costs in line? For JP Morgan, there is an expected fifth consecutive quarter of double-digit cost increases. And so the returns on equity, even at JP Morgan, are supposed to be, according to analyst estimates, slightly compressed compared to a year ago.
Sonali, good to see you. The green shoots of investment banking, the IPOs that were supposed to happen, the deals, the M&A deal flow has increased. The IPOs maybe not to the level that we had hoped, but the overall fee for equity and debt capital markets should be robust in the second quarter. Is that the jumping off point?
I'll steal from Erica Najarian of UBS yesterday. They are coming off a super low bar, she said, and that is the truth. You see some of the numbers that were posted a year ago when business was just stifled, and it was pretty muted. So the question is, how much can those Wall Street businesses supplement the Main Street businesses? Over on the trading desks, the volatility has certainly helped in rates, in currencies, and commodities, and you see that expectation really feed through in the expectations for, say, JP Morgan, Goldman Sachs, Morgan Stanley. But Manus, that investment banking dream, while it has increased the activity this year, it has still not added up to what most deal makers would want it to be. And given the second half has a U.S. election season in it, there are a lot of questions about how much it would pick up from here. So to your point, we've seen some IPOs, we've seen gangbusters debt issuance. That has been a big savior, but we have not seen M&A come in through the pipe like a fire hose, at least. So we have seen a rebound, and they should benefit from that.
And then the other cloud overhanging all of this is also the implementation of Basel III and some of the capital rules that come with it that banks have been pushing back against. Will we get any sort of flavor of that in the earnings impacts, or where they stand in trying to convince regulators otherwise?
Absolutely. It comes up every quarter, particularly with JP Morgan. But the interesting thing about it here is it's going to matter more and more going into next week with the regional banks, given that they are going to be impacted in such an outsized way. The other thing that we haven't gotten a lot of clarity on is how these Basel III endgame rules will impact trading desks. And given what we were saying about that rebound in capital markets activity, that's where really the rubber hits the road for the Wall Street businesses that so many investors were excited about. Will JP Morgan stop lending on credit cards? Probably not, right? But there are certain trading activities here that many of the banks may have to reconsider in light of these Basel rules if those rules are not meaningfully changed.
Yeah, well, you're going to hear the clarion call from the Europeans and the Brits here, which is, you know, the playing field is differentiated. And lobbying works in Washington when it comes to capital rules. That'll be the other call that you'll hear from this side of the Atlantic. Shonali, thank you so much. Shonali Basak there, tracking the bank earnings. And, of course, more on the bank earnings a little bit later. On Open Interest, we have Chris Marinak of Janney Montgomery joining the team. Coming up with Danny and I, economic data to round out the week. What have we got to focus on? Well, context matters every day from a hazy London city.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg. The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything. The top names in business are on Bloomberg.
One of the reasons why I'm frustrated, like many Americans, about our choices for president is neither is proposing to do anything about a coming debt crisis in our country. Our debt is already as large as our economy. It's going to go nowhere but twice as big as that. We have an entitlement problem, which is these entitlement programs are going bankrupt by the end of the decade. We have to get ahead of that. Otherwise, we're going to have a debt crisis in America.
Nobody covers business like Bloomberg. Context changes everything.
Let's get you set up for your trading day on this Friday. JP Morgan, Citi, Wells Fargo all report before the opening bell. And then some economic data. U.S. PPI comes out at 8:30 a.m. Eastern. Plus UMich, that is at 10 a.m. Eastern. But of course, minus the most important event, 3 p.m. Eastern on Sunday. England takes on Spain in the Euros finals. I've already got the bar booked out. I am ready. I got my England kit. You won't see me on Sunday. I'll be posted up there.
You'll be held up somewhere in a bar with the burgers and the beer. It's 700 euros to get yourself from London to Berlin. Big shout out for Michael O'Leary. Don't say I don't do anything for you, Michael. Let's have a look at Tesla, down 1.77%, dropping again. Bloomberg scoop that it's delaying its robo-taxi from August to October. And what you've got there is, of course, down 8% yesterday. It comes to mind, Simple Minds. I promised you a miracle. It's not exactly being delivered on time. Boeing 737 MAX customers, you're going to have to wait for more aircraft, more delays, 2025, 2026. JP Morgan Chase, we're counting down to the numbers, Danny, ahead of the opening bell. What will the allocation for bad debt be? That's the question in my mind.
Manus, I was under the impression there were no flights left to Berlin, that you'd have to like basically walk to Germany
700
if you wanted
euros
to get there. I'm surprised there's even anything left.
there's a wee ticket in here. Oh no, that's going to Ireland actually, not to Berlin. And I'm not going to talk to you about the price of tickets of flights to Ireland. Extortion.
Oh man, if only it was Delta. Apparently they're discounting. Anyway, Manis, surveillance is up next. This is Bloomberg Brief.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
The markets are essentially priced for Fed perfection.
The market has already gotten to the point where you're likely to cut 2 times this year.
The concern is if they move too quickly, the expectational set in the market could get ahead of themselves.
I'm a little bit more cautious in the near term because I'm seeing evidence of investor over-optimism.
The most dangerous time for the economy is usually when the Federal Reserve decides they're going to help us.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend. What a long week. From New York City this morning, good morning for our audience worldwide. Bloomberg Surveillance starts right now with equity futures on the S&P 500 positive by 0.1%. Here is your day ahead as Wall Street kicks off earnings season. A little bit later this hour, we get numbers from the likes of JP Morgan, then it's Wells Fargo, then it's Citi. Later on this morning, another read on inflation with PPI data, then 10 a.m. Eastern Time, UMich Consumer Sentiment. We have to begin this morning, though. I have never seen people so happy with a drawdown on the S&P 500 by close to 1%. Have you?
Everyone's been praying for this broadening out, and that was what you got yesterday. You saw a real big performance from the equal weight. You saw a real big performance from small caps. Mag 7, fell the most going back to October 2022. People are cheering this, but you asked a question offline, and I'm going to cheat, and I'm going to say, you asked a question, how many people are in this broadening out trade and are not just celebrating it on paper?
They were certainly chasing it yesterday. Let's just get to that graphic again. Just look at these moves in yesterday's session. The move on the NASDAQ, down hard. On the NASDAQ 100 by more than 2.2%. On Russell, the Russell up by 3.6%. Small caps outperforming the NASDAQ 100 by the most since November 2020. You've posed the question, how many people today think something material has changed after the data and the price action we got yesterday?
That's a great question. We did have the two-year yield fall the most since January. Suddenly, September very much on the table with the likes of Mary Daly as well as Austin Goolsbee of the Federal Reserve coming out and giving ammunition to this, saying, if we were looking for confidence, guess what? We kind of got it. So it gives a sense that the Fed is preparing to cut rates. Now the question is, will the data hang in there enough, like the jobless claims suggested, to make it a good rate cut, to make it just a mid-cycle adjustment that allows some of the more leveraged companies to actually do better, given that borrowing costs ostensibly are heading lower?
Going into the number yesterday, you asked Michael McKee a question. What's the most important number here? Is it CPI or is it jobless claims? We were talking about this. I don't think that CPI looks as good without that jobless claims number. That jobless claims number sort of cemented this idea that we can get back to 2% and we don't need to worry about the labour market too much. But another question for this morning, that goes against the grain of the last couple of weeks. Was claims yesterday an outlier? Or was that actually a decent read on where this labour market is? Is that the kind of strength that this Federal Reserve, this chairman, thinks we have?
You know, it's a great point, and it's ironic that as we were talking about the earnings for the likes of Delta and Pepsi and Conagra and how disappointing they were and the pushback that consumers are feeling with respect to pricing on even some of the best performing industries, I'm thinking travel, we got a better than expected jobs print, and everyone said this is Goldilocks. Is it Goldilocks? Is the margin compression we're seeing at a lot of companies simply a factor of what we're seeing with inflation coming down and people said you would see a margin compression? Or is this really a sign that things are moving more quickly than a lot of the headline data can reflect?
So this is the price action, and we'll get more data later. We have to talk about the politics as well. I'm sure you sat through it. It started at about 7:30 Eastern time. It was a 7-minute address from the President of the United States. Q&A lasted about 50 minutes. Lisa, I think we're both going to agree on this. For some, it wasn't bad enough to drop out. For others, it wasn't good enough to stay in. And I'm not sure that you can put the toothpaste back in a tube after the last couple of weeks in this country.
Well, that's the key point. How much can you change this? And honestly, Joe Biden nodded to that last night. He said, you know, it's never going to be enough for some people. They're just going to say, wait another month, wait another day, see what else happens. Look, I'm fine. The key issue is there were a couple of gaffes. People are going to focus on that. I'm less focused on exactly that. I'm more looking at just his demeanor, the fact that he couldn't really answer how well are you going to be able to do this in 4 years, and a lot of questions just going forward about his energy state, and frankly, quickly deteriorating levels that we don't feel like have accurately been reflected by people who are closest to him.
Let's park the gaffes. We'll talk more about the gaffes a little bit later. Let's just leave that there. That's dominating the headlines. I get it. And we will play some of that for you in about 10 minutes' time. He opened a door yesterday to something new. There was some humility there that we didn't see in the last couple of weeks. He opened the door to the idea that it's not just him that can be the former president. And if you think about the whole reason he's been running for a long, long time, him and the people around him, the whole argument here was that he was the only one that could be the former President Donald Trump. I think that was the first time we've actually heard an acknowledgement that others can too. And I wonder how much oxygen's going to sort of like breathe some life into that story over the next couple of days.
Well, and the oxygen is just waiting to be had, given the fact that we're getting reports that his campaign is examining what a matchup between Kamala Harris and Donald Trump would look like, that it's secretly polling people to get a sense of what this is. We don't know why. Maybe it's so he can come out and say, actually, I'm the only person who can beat Donald Trump. But there's almost seemed like a tacit admission that they were open to looking at what is going on in the polling and what is the best opportunity to beat the former president. Honestly, people are going to speculate a lot. People are going to talk about the gaffes. To me, last night was sad. And really, it goes to this question that we all have when dealing with aging relatives or friends when they can't have the same kinds of energy and performance as they have in the past. It is difficult to say. It is difficult to know how to go forward, and you can feel the torture that a lot of people in his party feel right now.
You can, and I'm sure you could feel the torture in this market yesterday if you weren't long small caps. Do you like that transition?
that was
okay,
good.
Let's move on. Equity futures on the S&P 500 firmer here by 0.1%. It's a little bit of a lift to go into the weekend. Yields higher by 2 basis points on a 10-year yesterday. Post-CPI, you saw that break of 420. Back above it now on a 10-year at 422.75. Coming up this hour, we'll catch up with John Stolfus of Oppenheimer on a mega rotation out of mega caps. Isaac Boltanski of BTIG with new calls for President Joe Biden to step aside, and Gerard Cassidy of RBC as Wall Street kicks off earnings season. We begin with our top story, the 7-day winning streak for the S&P 500 coming to a close with a big move out of big tech. John Stolfus of Oppenheimer writing this: near-term volatility could continue to present opportunities for investors to catch babies that get thrown out with the bathwater in periods of downdrafts, as the market digests levels of uncertainty that are not uncommon in times of transition in monetary policy. John joins us now for more. John, we'll get into the new price target on the S&P 500 in just a moment. I think we all want your reaction to the price action yesterday in response to the data we got at 8:30 Eastern Time.
Well, Jonathan, I think it was most certainly the market celebrating the thought that the data that came out would give Jerome Powell the opportunity to cut earlier than after the election. So it looks more like a September when the futures went from 70 to 90 some percent in terms of the chance that we'll get a rate cut. I think it's a little bit overdone in its anticipation of that. I think the Fed's independence is an issue that the Fed will need to think of ahead of an election before it does that. But it does seem that one thing for sure at the moment, okay, not with any other data crossing the transom yet that would be contrary to that, it does look like the Fed really is getting very near the end of this Fed funds hike cycle. And the market, of course, likes that, and doing it without a recession.
John, you've always talked about the importance of earnings, though. If we can park the data from yesterday, let's pretend it didn't happen. I know that's a big ask. Let's pretend the news conference yesterday didn't happen either, and let's pretend bank earnings don't come out later this morning. Okay, that's a long list. I know. It's a long list, granted. But the only thing, apart from all that we'd be talking about this morning, John, would be the numbers from Delta and the numbers from Pepsi. It wasn't a great start to earnings season. I just wonder how you thought about that as those numbers dropped yesterday.
Well, without getting too specific on the names, let's just put it this way. Anyone who flies on a plane knows that capacity has been, on commercial aircraft, has been in the back end of the plane. There's more seats available than there were before. Up front, it's tough to get a seat. It's tough to get an upgrade because both business and the everyday fun traveler are flying up front. But the idea is here, not surprising on the airline and related to the soft drink and snacks maker, it's a staples stock. It's good dividends, but of course it's got all these drugs that are coming out that kill people's appetites. And the question is, are you still going to, down a bag of potato chips or another brand name, that as you would before? And I think that's the issue.
Wait, hold on a second, John.
It's idiosyncratic.
I'm so sorry.
Pardon?
But John, I have to break in there. Are you saying that some of the weakness that we might be seeing in the likes of Pepsi and Conagra, for that matter, is because of Ozempic?
I think very well. I don't know about Conagra, but I would say related to Pepsi, it most certainly has been a question that has been raised by components of the market moving forward. Personally, I feel that, I don't think everybody is going to do these drugs, and I think Pepsi will probably do fairly well, but I'll leave that to our analysts to speak with you about that, because I manage money and the firm doesn't like me getting in the weeds related to individual stocks, regrettably.
All right. Well, let's talk about the overall index. You did recently upgrade your year-end forecast from 5,500 to 5,900, talking about the resilience overall in some of the AI-related names. This trend that's kind of fueling a lot of the optimism right now. I'm just curious whether some of the recent price action, the knee-jerk reaction of markets to the prospect of a rate cut, make you question that.
No, they actually don't. I think because what we have happening in technology is both cyclical and secular in nature. It looks like some kind of a watershed, as was the introduction of the PC and later on the laptop and later on the smartphones into technology beyond the point of the early internet. And not tech bubbly, let's put it that way. And if you look at the declines yesterday, I think with the S&P, you had real estate and utes and materials were the top performers, and at the bottom were communication services and information technology. But if you consider the fact that tech is still, after yesterday, up 32% year to date, and communication services is up 27%, it's a haircut, not a rout. It's just the market is broadening. Stocks appeal across the sectors. There's a realization that among the 9 other sectors, there's lots of what I would call AI proxies in terms of companies that can utilize the AI that exists today, the AI that's coming down the pike, and to become more efficient. And that efficiency goes to both companies, and it also goes to the consumer. So if business and the consumer are using this is a pretty big thing. But I do believe that people are recognizing now, after from the start of this year, this narrow rally among 7 stocks or so. The reality is, there's financials, there's consumer discretionary, which has been fairly well ignored, even though it's had double-digit earnings last reporting season. It's off to a pretty good start right now. All in all, when you look at it, it's with the prospects of the industrials picking up with infrastructure spend and reshoring and friendshoring and all the stuff. This is a very interesting time, and it should be good for stock prices because it'll drive revenue and it will drive profits.
Hey, John, wonderful to get in touch with you this morning. Thank you, sir. John Stolfus there of Oppenheimer on a morning where small caps are outperforming. Once again, the S&P 500 firmer by 0.1%. The outperformance once more, Lisa, on a Russell.
Lots of fish in the sea. That's kind of what you keep hearing, Now we're looking around and things are looking not so bad. And that's basically what we've been hearing from a lot of people. Let's just be honest about that. Key question is, can the index continue to climb higher without the robust participation of some of the high flyers, as many people have been calling them, for the remainder of the year? We heard from John, yes, because of some of these other names. And I guess those we're going to test maybe with financials later this morning.
It's quite a move yesterday to see the S&P down by almost 1% at the close and have more than 400 or just a little bit less than 400 members of the S&P 500 higher on the day.
It highlights just how dominant those Magnificent Seven are. And some of the idiosyncratic stories. I know later we're going to talk about Tesla, but Tesla was down more than 8%. That's a pretty big component of the index. You start looking at this, and that was more fundamental.
Ed Ludlow, the reporter behind some of those moves, is going to join us a little bit later. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. More trouble for Boeing, warning some 737 MAX customers that deliveries could be further delayed for 2025 and 26. Sources tell Bloomberg the plane maker said timelines may slip by 3 to 6 months, on top of already late handovers. Just another reminder that Boeing's production of its cash cow model faces a long road to recovery. And I'll give you a little teaser for Ed Ludlow's story on Tesla. The shares are down another 1.8% in the pre-market trade. The EV maker is postponing the long-awaited unveiling of its robo-taxi by 2 months from August until October. Sources tell Bloomberg that the company is pushing back the date to allow its teams more time to build additional prototypes. Optimism about the event had contributed to an 11-day streak of gains, which ultimately added $257 billion to the company's market cap. That was before shares dropped on Thursday by the most since January. And the late Silvio Berlusconi will join the likes of Leonardo da Vinci and Marco Polo in having one of Italy's airports named after him. Milan's Malpensa Airport will reportedly be renamed for the billionaire-turned-politician who died last year. Berlusconi was a flamboyant media mogul. His reign as Italy's longest-serving post-war prime minister was plagued by sex scandals and corruption allegations. That announcement upset many Italians. Milan's mayor called it crazy, and more than 120,000 people signed a petition demanding a reversal of that decision. And that's your Bloomberg brief. John.
Danny, thank you. Were they all Inter Milan fans? That's all we want to know.
Oh, yeah,
okay.
I like that.
The AC Milan half of the city, probably not too fussed with this.
Well, how do you feel about it, John?
And a very, very different view of him. Of course, much more controversial later on, but when he took over our club in the 1980s, you grew up with a different view of Silvio Berlusconi and all the success your football team had.
I immediately just...
But ask a Chelsea fan what they think of Roman Abramovich.
Okay.
You know, they'll have a different view to everyone else.
All I can say is I immediately Googled what his favorite food was to see what the airport would look like.
Oh, right. What was it?
I haven't found it yet.
Okay, keep
Manzo
looking.
alla California.
Okay, you keep looking. Up next on a programme, mistaking your allies for enemies.
Now I want to hand it over to the President of Ukraine, ladies and gentlemen, President Putin. President Putin. Who's going to beat President Putin? President Zelensky.
The conversation's up next, live from New York this morning. Good morning.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
top names in global leadership are on Bloomberg.
I envisage not only some kind of a bridge towards membership or language linked to the irreversibility of Ukraine's membership in NATO, but also some kind of a broader package of military material, of financial aid. The more we support Ukraine right now, the sooner the war will end.
Nobody covers the top global leaders like Bloomberg Television and Radio.
DOJ or other authorities
could face bigger challenges.
Britain's next.
Was going to keep winning World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Live from New York City, welcome to the programme. Equity futures on the S&P 500 firmer here by just 1/10 of 1%. The outperformance once again on the small caps, just like yesterday. Let's see if that sticks. Under surveillance this morning, mistaking your allies for enemies.
Now I want to hand it over to the President of Ukraine, who has as much courage as he has determination. Ladies and gentlemen, President Putin. President Putin. Who's going to beat President Putin? President Zelensky.
President Biden mistakenly introducing Ukraine's leader as Vladimir Putin before dropping the ball straight out of the gate in the news conference that followed.
Look, I wouldn't have picked Vice President Trump to be vice president, but I think she was not qualified to be president.
Those gaffes overshadowing a near 1-hour news conference where he demonstrated a decent command over complex topics. For some, it was never going to be enough. Almost immediately after the news conference ended, at least 3 more House Democrats joined the growing list of lawmakers calling on Biden to step aside. Anne-Marie joined us now from Washington. AMH, you were in the room. How did they react when those gaffes dropped?
Well, first off, we should note that he pretty much lost the news cycle before we even stepped into the press conference because he introduced President Volodymyr Zelensky as President Putin at his prior event. So already you can sense this was going to be incredibly tense, and he really needed to outperform. And then his first answer, he mixed up his vice president, Kamala Harris, calling her Vice President Trump. The room was silent, but you could see there was a few sighs. People were trying to hold in their gasps, and the faces on people clearly said, ooh. And then they started sitting on basically the edge of their seat to see whether or not he was going to make another gaffe. So that completely overshadowed the fact that actually when it came to some complex issues, like you mentioned, when he was talking about Gaza, China, Ukraine, he had a good handle on the material. And it wasn't like the debate where he was losing some train of thought. But these gaffes is what has taken off, not just on social media, but also just a few moments ago, about a 5-minute segment on Russia TV, a composition of all of President Biden's gaffes. And that is why it wasn't enough to stem the bleeding, but it was enough, his performance, to give him a few more weeks. And let's see how he performs Monday evening when he sits down with NBC.
Anne-Marie, stay close. Let's continue the conversation with Isaac Boltanski of BTIG. Isaac, I don't know about you, but my sense of that news conference, that was the first time in the last couple of weeks that I think the sitting president showed some humility. Just this idea that he was somewhat open, just a little bit, relatively speaking, to being replaced. What was your sense of things?
Yeah, look, I mean, if we start with the overarching view of last night, it was undeniably a Rorschach test. Everyone got a little something of what they wanted from last night, right? We can focus on the gaffes, and that's what the folks who want him to step aside are going to highlight. But he did have, as Anne-Marie said, an impressive command of the issues. And I think that's what you're going to hear from his supporters. And so, at least for me, the way that I think about this right now is he has been in survival mode. It's been about survive and advance. And last night let him advance. And we're going to advance now to next week, where we've got to focus on how he's going to do at some of these press events, but also during this interview on Monday evening.
Isaac, as this progresses and as he buys time week by week, how much do you think this gives the chances of Donald Trump winning the presidency get bigger and bigger and bigger?
Yeah, look, I think that Trump was the favorite before the debate, and he is even more so now. And I firmly believe that the Trump campaign is more than happy to let the Biden camp fight it out with elements of its own party. They love this intra-party fighting, and they would be happy if that would continue for the foreseeable future. I wouldn't be surprised if they would like this to overtake even the headlines from their convention that's coming up next week. So look, my message to clients here has been pretty straightforward. Trump was the favorite before this. Trump is the favorite after this. But to me, what's happened over the past few weeks really underscores the likelihood now of the increased likelihood of a GOP sweep, because I firmly believe the House is going to go whichever way the White House goes. And I think that margin is going to continue to increase if Democrats are squabbling over who's atop the ticket.
Isaac, there's some reporting that Joe Biden's campaign is quietly polling the public to see how Kamala Harris fares against Donald Trump. What do you make of that reporting?
I think part of it is the humility that John talked about, right? I think that he was open to that idea that he had a terrible debate, and that ultimately the goal here is to beat Donald Trump for the Democrats. I think that one of the things that didn't get as much coverage because we were all just dealing with the fallout from the debate was his follow-up where he said that if he lost, he would be okay with it. Democrats have to square the circle there, right? Either Trump represents a existential threat to democracy and needs to be stopped at all costs, or it's okay, we can lose the election, right? And I think that's something that we're trying to see Democrats grapple with in the wake of the debate.
Isaac, we keep coming back to pressure points, and there's three of them really: party officials, donors, polls. Of those three pressure points right now, what do you think is going to be the greatest for this president?
Yeah, look, I think there is a committee to unelect the president. I think that committee is growing by the day. It grew last night. For me, I think that committee's main cudgel, their main way to influence the debate is going to be polls. And we're going to have to continue living and breathing with every single poll. And to me, that's number one. Number two is, look, the president in some ways is going to be Sisyphus, right? He's going to have to push this boulder up the hill every single time he walks out of 1600 Pennsylvania Avenue. And every single gaffe he makes when he's out in public is going to be one that we analyze to the hilt. Because look, it's no longer, your crazy Uncle Joe. right? We're talking about cognitive capacity to be president now and to do so for another 4 years after this. So, look, I'm watching the polls. Of course, that's number one. But number two is every single outing he has is now going to be like the Super Bowl for him.
Isaac Bortansky of BTIG. Isaac, thank you, sir. Yesterday was a difficult day for the president. Not the gaffes, not the news conference, the lead up to it. Report after report, New York Times, some Biden advisors discussing how to convince him to step aside. The Biden campaign testing Kamala Harris's strength versus Trump. You alluded to that. Politico, Obama was in touch with Clooney before the op-ed came out. Didn't advise him, but didn't object either. Headline, just relentless over the last 24 hours.
Which maybe was the reason why, at least for me, I was interested in some of the jabs that he had against his own staff during last night's press conference. They just keep adding things to my schedule. They talk a lot. How much he's sort of pushing back against this.
Credit where it's due, joke of the night. Good golf joke in that news conference. Writing down the score before you've hit the ball.
That was pretty good.
That was a pretty decent golf joke. We'll give him that. From New York City this morning, good morning.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
For years, people told me, why are you invested in Apple? Everybody talks about Apple. I actually think that sometimes because someone speaks a lot about something, it might be actually a good sign versus the overhyped sign.
Live from New York, welcome to the program. Equity futures on the S&P 500 firmer by almost 0.1%. The standout, though, once again, check out the Russell. The small caps up another 0.75%. Lisa, after a mega
What's the thing here? Turkish central bank head pushes back on talk of early rate cut.
To December, the equal weight S&P 500 versus the market cap weight had the biggest divergence going back to 2020. This was a seismic day and shifting back to broadening. You asked the right question. How long can this last? And how long is this going to be a positive, given how many people are hinged to those Magnificent Seven?
How durable is this move? To state the obvious, I guess we're going to find out. But ultimately, to see people jump on the bandwagon yesterday was pretty phenomenal, wasn't it? This is it. I'm so happy. And I'm sitting there thinking, a lot of people just own the S&P 500, right? They're not going to take much comfort from you telling them that almost 400 members were up, even though we're sort of down by almost 1%.
So there are two interpretations, and you are correct. One is, okay, maybe there's something amiss here that people aren't understanding how the index can actually keep climbing if you don't have the participation of the Magnificent Seven. And then you have the John Stoltzfus view of things, which is, it is so nice that people are taking some profits and going into the others, and then they're going to realize everyone just gets lifted up, and it's a wonderful evolutionary cycle of innovation and growth, and all of a sudden we can go into everything, and that's how you can get higher. That's sort of the tension right now.
In the driving seat is this right here. Switch on the board and get to the bond market. And let's just sit on the front end. Had a double-digit move yesterday, close to 10 basis points. 451.66 is where the 2-year is right now. We've said repeatedly on this program, not all rate cuts are created equally. Keep talking about it. Some are bullish, some are bearish. If you're responding to a collapse in the labor market and you're cutting rates, that ain't good. If you're responding to inflation and that backdrop improving and the labor market's holding up, that's a really decent picture, not just for the economy, but for financial markets. That's what we got in yesterday's session.
The fact that initial jobless claims came in lower than people had previously expected, it basically gave a nod to this Goldilocks that everyone's been hoping for. Key point within the CPI, which also gave people a real sense of relief. Michael Reed of RBC pointed this out. They finally started to see some decline in owner's equivalent rent. That has been the key aspect kind of keeping people back when you start to see that disinflate and things get cheaper. The point is here, right now, it seems like the Fed is threading that needle. And it seems like they're threading that needle just perfectly. And that's the reason why a number of Fed officials are saying, okay, let's go before we don't thread this needle anymore. We don't know yet. The jury is still out. And that is why I think that this earnings season is going to be so important.
JP Morgan, about 10 minutes or so away. We'll break that down for you in just a moment. Talking of threading the needle, no needle threading whatsoever over in Japan. For the Ministry of Finance, this is just about hammers. And when dollar yen's down, just beat it up. Just beat it up even more. We've broken 160, 159.22. Yesterday we had a little look at 158 at the close, 158.84. We had seen in yesterday's session something close to 162. So you get that dollar weakness, and according to reports, Lisa, the ministry just sort of piling on and intervening.
Yeah, with $22 billion of estimated intervention in terms of trying to encourage this move. That was perfectly described. That was my image last night, was they saw CPI,
get it.
They saw the move, and then they're like, let's go. This is our chance to put good money after good, or, good money after bad, but actually make it count. The question here is, are they just basically trying to propel a move that's already in the market, basically take advantage of market opportunities, or is this something that's durable at a time where there still are some structural differences between the two economies?
Some big moves in yesterday's session across the equity market, the bond market, and foreign exchange as well. Under surveillance this morning, at least 3 new Democratic lawmakers calling on President Biden to step aside after his news conference last night. Biden making 2 major gaffes in about 2 hours. The president now preparing for another high-stakes interview with NBC's Lester Holt on Monday. I guess we've got to ask the question, Lisa, at what point are interviews no longer high-stake interviews? And if you're looking ahead to next week, my question would actually be not for the president, not for the Biden campaign, it would be for the RNC. Can the Republican convention actually do a good job of keeping out of the news cycle and keeping the pressure on the sitting president?
Well, it's not something that typically Donald Trump has been particularly good at, considering the fact that he enjoys the spotlight and is quite good at it in terms of getting it. Here's the question that I have. At what point are people coming out against Joe Biden, regardless of what he does or what he doesn't do, in terms of messing up or having a real fatal blow, in terms of a sort of irreversible gaffe? At a certain point, it feels like people are trying to gain momentum earlier so the damage damage is staved off and they allow another candidate to get some momentum. That is what I am watching. How much people are coalescing, not because they're concerned about another gaffe or something else, or even any kind of disappointment with his performance, which a lot of people think has been pretty good. The issue is, let's get ahead of this, because right now we are losing, and you got to get on this now.
Another big weekend and big week still ahead for us for the President of the United States. Big day yesterday for Tesla. I know sort of overshadowed by some of the news elsewhere, but the company pushing back the debut of its new robo-taxi, according to people familiar with the matter, telling Bloomberg the event won't happen until October, after originally being scheduled for August 8th. Teams are expected to work on additional prototypes. We were down yesterday, we're down again this morning by 2%. Ed Ludlow and the team breaking down the story. We're going to catch up with Ed in about 2 hours' time. This has been the carrot over the stock since April. This August date where we'd get this update on robo-taxis and we'd stop talking about the negative growth that this growth stock's been experiencing for the last few quarters.
So there are two questions. Is he just trying to get it perfectly so that when he unveils it, it's going to be something that's really viable? Or does this highlight some of the difficulties in creating this type of product? We saw the flip side, Uber and Lyft shares gained quite a bit on the heels of this because that competition wasn't necessarily going to come to the fore quite as quickly as some people had previously thought. To me, it seems like the can's getting kicked again and again. And how long is there going to be forgiveness in the market? We saw a sniff of that yesterday. Really, it's going to be interesting to see whether that continues.
Down this morning by a little more than 2%. Let's get to the earnings. Lisa mentioned it. Earnings season kicking off on Wall Street with the big bank set to report throughout this morning. JP Morgan and Wells Fargo expected by 7 a.m. Citi expected to report at 8 o'clock Eastern Time. Goldman, Morgan Stanley, Bank of America all coming next week. Gerard Cassidy of RBC joins us now for more. Gerard, I love doing this with you. Every single time we kick off earnings season for the big banks, walk us through what to look out for in the next hour or so.
Jonathan, I think what we're going to see is a couple of real big trends. First and foremost, net interest income. As you know, the net interest income comparisons for all the banks on a year-over-year basis has been negative, with the exception of JP Morgan. I think that's going to be one of the biggest trends that most investors will focus on. They're looking for the inflection point when net interest income growth on a year-over-year basis turns positive. We expect it to happen in the second and third quarter of this year. Second, we've talked about in the past, the office markets in the United States, in the big cities, in Class B and C buildings, is very weak. There are many losses that are being taken in that area. So we're going to look for insights into that market. Third, for the big banks that are reporting over the next 48 hours or 72 hours, what we're expecting is what's going on in capital markets. The guidance they gave in June, investment banking results, as well as what we see in Dealogic numbers, are going to be very strong. Trading results are going to be more muted, but we could see maybe a surprise to the upside there due to the volatility that was created in the second half of June due to what was going on over in France in their political environment.
Jared, to build on that, we have to talk about the last 24 hours. This is a market environment, at least recently, in the last day or so, where smaller companies are being rewarded and bigger companies that have done well so far this year have pulled back. Given the environment that you described for banking, do you think this is an environment where the big just keep getting bigger? Or do you think this is an environment, at least developing into one, where the smaller names can start performing?
John, I think you put your thumb on it. The smaller names can start performing if, as Lisa was just talking about, the Fed threads the needle and we see a Fed funds rate cut in September and December. The smaller names rely more on net interest income as their revenue driver rather than fees, which of course the biggest banks have a much bigger percentage of revenue coming from fees. So therefore, if you do believe the Fed's going to cut maybe once or twice this year, maybe 3 times next year, the smaller regionals and regional banks should now take leadership amongst the bank group because of that driver for revenue.
There is this issue, though, about benchmark rates coming down and what that does to some of these banks. Yesterday, we saw kind of a motley performance. Smaller banks did outperform, though, as you mentioned. At what point does that become difficult for loan growth and for making profits on loans, given the fact that a lot of these companies still are dealing with trying to retain deposits?
Lisa, what's really interesting is that if the Fed starts to cut rates, we're going to see what we call the third act of the interest rate cycle, which is your funding costs, your deposit rates start to come down as the Fed cuts rates. But you might remember Many of the banks put on their books bonds back in 2020 and 2021, as well as loans with coupons that were anywhere from 1% to 3%. As those pay off, those cash proceeds are reinvested now in higher yielding earning assets. So you're going to see spreads and margins improve even with minimal or no loan growth. So loan growth would be the icing on the cake for these companies. But even if you get modest loan growth over the next 18 months, the margin expansion just from the dynamic of the earning assets paying off, being reinvested into higher yielding assets, and your funding costs coming down means net interest income growth is going to be positive.
We're about to get reports from JP Morgan. Then, of course, we're going to hear from Bank of America, and then we're going to be hearing from Wells Fargo, and then from Citigroup. Which of those companies do you think is going to be most interesting?
I think what's going to be interesting is Bank of America, because when you look at JP Morgan Chase, obviously they have delivered very strong numbers. Everybody expects that trend to continue. When you look at Bank of America, they have been the bigger net interest income story. We don't think about net interest income as much for the large banks as we just talked about, but this company has had a more focus on net interest income. And you might recall back in 2023, when we had the problems with the banks in the spring of 23, there was a big focus on the unrealized losses in their held to maturity portfolio. And if this 10-year government bond yield continues to fall, those concerns of the lower yields in that portfolio become less of an issue as we go forward. So that's going to be, I think, of the big three, that could be the most interesting one today when they announce their numbers.
The stock has had quite a run so far this year. Year to date, up by a little more than 24% on Bank of America. Joe Cassidy, stay close, sir. We're going to break down those numbers from JP Morgan with you in just a couple of minutes' time. Before we get there, an update on stories elsewhere this morning. With your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. The Bank of Japan is believed to have stepped into the currency market for a third time this year on Thursday. Broker forecasts estimate that the BOJ intervened to the tune of about 3.5 trillion yen. That's about $22 billion. The figures indicate that Japan's authorities tried to take advantage of a buildup of yen shorts and a cooler U.S. inflation print. The yen strengthened sharply from around 161 versus the dollar to 157, but it is back above 159 this morning. The world's biggest hedge funds are off to one of their best starts of the year thanks to a roaring tech-led bull market and successful quant strategies. According to people familiar, tech-focused equity funds Lake Street and Whale Rock led the pack in the first half, gaining 55% and 32% respectively. As a whole, multi-managers gained 6%. That is their second best start to the year over the past 15 years, data from Pivotal Path show. One sore spot, though, lagging macro funds. Brevin Howard and Eisler both posting losses for the 6 months. Food delivery in New York City has become a luxury. A city agency report found that New Yorkers have paid nearly 60% more in delivery fees in the state since minimum wage laws went into effect last year. Customers as a whole ordering from apps like Uber Eats, DoorDash, and Grubhub paid an average of $20 million a week in delivery fees in the first quarter of this year. That's a 58% increase year over year. Meanwhile, delivery couriers saw their overall earnings grow even as tips fell sharply. The agency's report suggests that delivery companies have passed on higher costs to customers. And that's your Bloomberg Brief. John.
Danny, thank you. It's certainly getting more expensive. You notice that?
Well, you've got the order fee, delivery fee, tip, and then it's all of a sudden double the price. At that point, you start to whip out your cooking books and just tell the kids, just deal with it. I know it's not as good.
Deal with it. Mum's cooking again, which I'm sure is a good thing. I'm sure it's a good thing.
Don't be so sure.
Up next on the program, the big banks kicking off earnings season.
Even under
so just a reminder, at 6:55 a.m. Eastern Time, we get JP Morgan's second quarter earnings for 2024.
Rule that would be really, really tough on
with
for
an estimated EPS of $4.28 and a revenue estimate of about $50.20 billion.
Season begins in a couple of minutes' time.
Also, a reminder at the top of the hour, we're expected to get earnings from Wells Fargo as well. So just to bear that in mind, these releases, so these earnings could come out earlier than expected or a bit later.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players. 3,184 hits, 431 home runs, and of course the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. Why are you doing this?
what we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable, it's got to make money.
There's only one word: winning. You win on the court, you win off the court. And as you do that, you bring people along.
The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything.
This is Bloomberg.
Live from New York, welcome to the program. Equity futures firm are here by 0.1%. Under surveillance, big banks kicking off earnings season.
Even under this administration, we're seeing some relief in some of the regulatory constructs. So this whole Basel III endgame rule that would be really, really tough on capital for the banks.
Wells Fargo earnings coming through with an EPS of $1.33, $1.33. So a beat on the estimate of $1.29. Also with a revenue of $20.69 billion. A beat on the estimate of $20.28 billion. Net interest income of with margin of 2.75%, a miss on the estimate of 2.77%. Total average deposits of $1.35 trillion, a miss on the estimate of $1.36 trillion. Net interest income of $11.92 billion, a miss on the estimate of $12.12 billion. Also, corporate and investment banking revenue $4.84 billion.
Is under the estimate of 12.1
also seeing Wells Fargo shares dropping 3.6% after net interest income miss. Also JP Morgan EPS coming through of $6.12, being on the estimate of $4.28, with revenue coming in
about credit losses ahead. I would also point out, if we can,
with adjusted revenue of $50.99 billion,
as well. Some interesting numbers
a
here
beat on the estimate of $50.20 billion, and their total deposits of $2.40 trillion, a miss on the estimate of $2.43 trillion. Second quarter loans $1.32 trillion as expected, and also net charge-offs of $2.23 billion, a miss on the estimate of $2.26 billion. Managed net interest income of $22.86 billion, a beat on the estimate of $22.82 billion. Also provision for credit losses of $3.05 billion, a beat on the estimate of $2.83 billion. And the investment banking revenue of $2.46 billion, a beat on the estimate of $2.13 billion.
I am wondering about credit loan losses. We did see a big gap up in JP Morgan in terms of what they expect credit losses to be. How much does that indicate?
Also seeing Wells Fargo shares dropping 6% after second quarter net interest income miss.
Ago, what we saw from the New York Fed, expectations from consumers and that worry about availability of credit, and then how much the banks pull back on the heels of those losses starting to rise. Ultimately, that's going to be the biggest question, Lisa. How willing is a JP Morgan, is a Bank of America, is a Citigroup willing to lend in the face of these higher losses?
Decent numbers on the investment banking business side of things. Revenue coming in at $2.46 billion over at JP Morgan. The estimate was 2.13. The commentary from Jamie Dimon. Lisa, how many times have we heard this over the last few quarters? We continue to be vigilant about potential tail risks?
I mean, that's kind of his job, is essentially to be vigilant and handle tail risks. He's talked about that the way that you're successful through cycles is not to get lost in the euphoria on the way up and not to get lost in the sob stories and the trauma on the way down. What you do see is a company that's benefiting pretty broadly from their heft. We're getting the equities sales and trading, they beat. Fixed income sales and trading on the margin, they actually missed a little bit, but pretty much in line. Net interest income coming in strong. To me, the question is how much they keep saying this simply to just offset incredible profits, even when other banks don't show that same kind of strength.
Shalali, just going through business line to business line, what jumps out for you here?
Definitely those core Wall Street businesses. There was a big debate going into this earnings season about just how much Main Street versus Wall Street would start to show up in these numbers, and Wall Street is showing you that they are very much alive. And these trading numbers, equities, for example, winning here, fixed income winning at JP Morgan, is an interesting setup for the rest of earnings season. That volatility in the markets is where these guys start to win. And, I will mention under the surface, one of the big debates here is, will the Federal Reserve and other regulators put more capital rules or, frankly, other types of guardrails on these trading businesses? They are certainly, for the time being, minting money.
Wells Fargo right now down in the pre-market by a little more than 5%. A little bit softer on JP Morgan. Early days, we'll see what happens here. And if this move sticks, we're down about 1.5%. Gerard Cassidy of RBC still with us. Gerard, you've had a few minutes to go over these numbers. What jumps out for you, sir?
I think what's impressive, as you guys have been talking about, is
also JP Morgan say there has been some progress bringing down inflation, but there are still multiple inflationary forces.
As the net interest income did come in a little bit below expectations,
and inflation rates may stay higher than markets expect.
Most likely led by their capital markets business. As you know, Wells has been expanding that business under the leadership of Charlie Sharp. So when we look at the numbers today so far, the investment banking and capital markets numbers are good. When it comes to credit, we know credit is normalizing, but these companies can absorb these higher credit costs because of the diversified revenue numbers.
What do you make, Gerard, of the idea that Wells Fargo missed on net interest income and JP Morgan beat? Is this a function of the fact that deposits are just stickier at JP Morgan and they can afford to not pay that much more to their depositors, which is different than other banks, anyone other than JP Morgan, frankly?
Yeah, it's interesting. The two big banks that have super sticky deposits, Bank of America and JP Morgan, but I would say Wells does too. One thing we have to remember, Lisa, with Wells, they have that cease and desist order with the asset cap. So they're unable to grow their balance sheet. So when you have pressure on your net interest margin, you're not able to grow through that, which JP Morgan, Bank of America, Citi, all the other banks can. So that, I think, is what's showing up here today for Wells is the asset cap is holding them back because they cannot expand that balance sheet. And therefore, there was pressure on the net interest margin, which brought the net interest income number slightly below expectations.
Gerard, this actually speaks to that. Wells Fargo saying that they saw growth in their deposit balances in all of their businesses. Going back to the capital markets aspect, we did see a real boom there when it comes to most of JP Morgan's businesses, a slight miss on the fixed income side of things. How much is this durable at a time where people are saying that maybe people are trying to get deals done ahead of the election, that the boom is happening now, but then could dry up later in the year?
It's a really good question.
In about 7 minutes' time, we're expecting Bank of England to report their quarterly bulletin at the top of the hour.
Capital markets businesses, this is their weakest quarter, the third quarter. Then we spring right into the full speed election in the fourth quarter. So that could certainly add to the volatility. Volatility, as you know, Lisa, is very good for trading results. That's what the markets business wants. On the other hand, it's not as positive for the investment banking business. However, in all of these companies, JP Morgan, Citi in particular, the markets business, the trading businesses are much larger than the investment banking businesses. So increased volatility would be kind of interesting, though, to your point, maybe you see a slowdown in the investment banking business, particularly amongst IPOs, but the trading business can more than offset that slowdown if the volatility turns out to be, beneficial to trading.
We're jumping between banks at the moment, talking about JP Morgan and Wells Fargo. A little bit later this morning, we get numbers from Citi. I want to sit on JP Morgan, Gerard. I just want to get to these comments from Jamie Dimon. They're comments we've heard before. But I want to talk about the value of this particular perspective that's helped JP Morgan over the last couple of years. Dimon, the CEO, saying this: there's been some progress bringing down inflation, but there are still multiple inflationary forces. Inflation and rates may stay higher than the market expects. That seems to be the biased view. Jared, of Jamie Dimon for quite a while now. How has that helped JP Morgan navigate this rate story of the last couple of years versus, say, other large banks on Wall Street?
John, it's a good point because JP Morgan has navigated the rate environment better than some of their peers by keeping the duration of their assets shorter than some of their peers. The good contrast here is between Bank of America and JP Morgan. Now, if rates continue to fall and the Fed starts to cut rates and the long end of the curve comes down, that obviously will weigh on JP Morgan more so than its peers, which they have pointed out in their guidance in the recent past that net interest income in a falling rate environment would be adversely impacted more so than their peers. So they've done a very good job. I mean, they are very conservative. Jamie Dimon, their chairman and CEO, has always taken a look that, the glass is kind of half empty to be protective of his business. And that's worked very well for him, obviously, since he's done a great job running this company for the last 20 years.
Gerard Cassidy of RBC. Gerard, thank you, sir, for joining us today alongside Shonali Basak of Bloomberg. Lisa, just going through these numbers, a final word for you. Big headline, a big takeaway.
Well, Jamie Dimon also had some other commentary where he said inflation rates may stay higher than the market expects, as you were talking about, but there are still multiple inflationary forces. And I'm curious about what that's a nod to going forward. Some of our conversations have suggested about policy shifts, but also how that's shifting their balance of businesses, what they're sort of doing to get ahead of that, to navigate the waters. But otherwise, to me, it's really a win for Wall Street's trading arms.
Yeah.
And it's a real win for JP Morgan in terms of net interest income.
The bigger you are, the better you've been doing over the last year, that's for sure. JP Morgan's down by a little less than 1 full percentage point. Shonali's going to be back a little bit later to break down numbers from Citi. Ed Yardeni of Yardeni Research joins us in the next hour alongside Democratic donor Charles Mars of Signum Global Advisors, Lara Rain of FS Investments, and the Secretary General of NATO, Jens Stoltenberg, sitting down with Bloomberg's Anne-Marie.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto.
Less than a minute until we get the Bank of England quarterly bulletin report.
The top names in business are on Bloomberg.
One of the reasons why I'm frustrated, like many Americans, about our choices for president is neither is proposing to do anything about a coming debt crisis in our country. Our debt is already as large as our economy. It's going to go nowhere but twice as big as that. We have an entitlement problem, which is these entitlement programs are going bankrupt by the end of the decade. We have to get ahead of that. Otherwise, we're going to have a debt crisis in America.
Nobody covers business like Bloomberg.
10 seconds.
Context changes everything.
I don't see any reason why we should be headed for recession here, but we are seeing that slowdown growth.
We are expecting growth to continue to slow. We do think that we're going through a soft patch here, but we think it will be a moderate soft patch.
Things are moving lower in the economy, and historically the Fed has been able to cut rates before the recession actually occurs.
We don't necessarily think there's a recession on the horizon. We think that having a soft landing is quite possible.
And the quarterly bulletin is out, and we'll get it out on the feed for you to have a read through.
To me, this is a winning hand.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now. Shonali Basak alongside us in the last couple of moments, breaking down the bank earnings. As she headed towards the exit of the studio, she just turned to us and said, Wall Street wins. This is what it looks like this morning. If you've got a big investment bank and you're winning on that side of things, you're doing okay. JP Morgan just a little bit softer in the pre-market. If you don't have
and that has also gone out to the feed for you to have a read through for the Bank Quarterly Bulletin.
Well, this one
Next up on the docket at the top of the hour, we're expecting Citi with their earnings. So, of course, just in case they do come out earlier with their data, the estimated EPS is $1.39, and the revenue estimate is $20.11 billion.
Advisory revenue going back to the third quarter of 2022 at a time where there still is a lot of uncertainty about what could get approved. This is the biggest bank winning yet again, and that is really the story that stands out.
The big get bigger, and we'll always be talking about the thoughts of Jamie Dimon over at JP Morgan for as long as he's over there. So we have to talk about his thoughts on rates, on inflation. Inflation and rates may stay higher than the market expects. Just contrast that guidance coming out of JP Morgan and the leadership there to what we heard from Pepsi yesterday, what we heard from other companies, including Delta as well.
There is a tension here, which is at what point are we looking at inflationary pressures that might be subsiding for now, but that are going to revert back to the forefront later on. Jamie Dimon saying there are still multiple inflationary forces coming down the pike. That is something people have been talking about with respect to policies as well as just sort of global supply chain issues. On a broader level, there is this feeling that there is a weakening, and that's why you did see credit loan loss reserve actually build more than people previously expected at JP Morgan. It's a confusing picture. And this is a cautious bank that is preparing for that because guess what? They can. They have enough cash.
Just getting some confirmation of the guidance as well. They still see full year net interest income of about $91 billion. The estimate, just a little north of that, the estimate was $91.33 billion. So I think we can say largely in line, just a little bit softer in the pre-market. So we've had JP Morgan, we've had Wells Fargo. Later on today, we're going to get numbers from Citi as well in the next 60 minutes or so. After that, we'll get PPI, so inflation data for you. Then after that, the University of Michigan consumer sentiment numbers going into the weekend. As we look at the totality of the data, as the Fed might say, the data this week looking a whole lot better after what we saw yesterday.
It was a Goldilocks-y kind of feel, right? You basically had CPI coming down at one of the fastest paces going back several years. You had, at the lowest level going back several years on an annualized basis. You saw actually the housing component of this print come down in a way that gave people confidence that maybe it has legs. And you had jobless claims not come in higher than expected, in fact, come in lower than expected. So it looks like a stable economy that is seeing
also JP Morgan still sees fiscal year net interest income about $91 billion, lower than the missing the estimate of $91.33 billion.
Which came out this morning and also downgraded their forecast for revenues. I know they're not an American company, but it gives a sense of just global travel. You talk about Pepsi, Conagra. At what point do you start to see the weakness coming out in other ways that might not be reflected in, say, investment banking revenues?
In a few words from Neil Dutta, have run Mac, get on with it.
Well, yes, he's been saying that for a while.
Get on with it. That's the message to Chairman Powell and the Federal Reserve as they get together later this month to consider reducing interest rates. Most people assume they will execute that call later on this year, perhaps even in September. The scores look like this morning, and good morning and welcome to the program to you all. Equity futures on the S&P 500 just about positive. The bigger move, though, like yesterday, was in small caps. Once again this morning, it's on the Russell. It's in small caps. In the bond market, yields much lower across the curve through yesterday's session. This morning, a little bit higher on a 10-year maturity, up by about a single basis point. 421.97 is where 10s are right now. The lineup for the hour ahead of us looks like this. Ed Yardeni of Yardeni Research will be joining us as stocks snap their longest winning streak since November. Charles Myers of Signum Global Advisors as President Biden vows to stay in the race. And we'll speak to Laura Rain of FS Investments amid growing bets on a September rate cut. We begin with our top story, the S&P 500 7-day winning streak coming to an end as big tech tumbles the most since 2022. Ed Yardeni of Yardeni Research raising his S&P 500 year-end target to 5,800 from 54, writing this: "We've been among the most bullish investment strategists since November 22, but not bullish enough. The bull market might continue to achieve our targets ahead of schedule." Ed joins us now for more. Ed, we keep going back to this, the rotation of yesterday. How durable do you think that so-called rotation is?
I think it might have been very significant simply because we see that it was based on expectations that the Fed is in fact going to start lowering interest rates sooner rather than later, meaning September, rather than sometime next year. And I think everybody agrees, especially after listening to Fed Chair Powell, that this is going to happen. If that's the case, then the rotation makes sense and may very well continue.
So, Ed, is it the everything trade or the everything else trade?
Well, I think, look, from my perspective, the Fed doesn't really need to lower interest rates. Economy's doing fine. Maybe it's a soft patch, but it's certainly not a recession. And inflation's coming down. So why mess with success? I think the risk they're taking by actually lowering rates, let's say in September, is that they'll just perpetuate a melt-up situation in the stock market. You know, deja vu all over again, the 1990s. But look, just because I have an opinion on what the Fed should do is irrelevant. What matters is what they're going to do, and they seem very intent on cutting rates.
It actually matters what you think they should do, just in terms of what the market seems to believe as well. And I'm wondering how much of a small cap trade right now is hinged on the idea that the U.S. economy has more risk of actually heating back up than cooling back down to some sort of recessionary state.
Well, look, if in fact the consensus view now that the Fed's going to lower interest rates happens and the stock market continues to move ahead, you know, I've been bullish, but not bullish enough. But so if it continues to move ahead here, that could certainly have a very positive wealth effect on the economy. The financial conditions are not tight here. You know, the Fed keeps talking about the need to lower interest rates because otherwise they're too restrictive. I mean, we're talking about the stock market basically at a record high here. Not, you know, after last. I mean, yesterday was kind of the first weekday for the S&P 500, but the broad market actually did pretty good as it broadened out to the small caps and the mid caps, and I think that continues.
Let's turn this on its head. If you think that there is so much momentum in the U.S. economy that if the Fed cuts in September, the risks will sort of shift to possibly a reignition of inflation, at what point does it make you more bearish on bonds? We see in the short-term bond space, not a lot of hiccups, but one auction after another came out pretty well until yesterday. And we saw that 30-year auction not do so hot. How much do you get, you know, pretty bearish on the prospects for U.S. government debt if the Fed cuts as soon as to September?
Well, we've all been very excited about yesterday's CPI, but that was in the morning, and in the afternoon, the federal deficit came out, and that certainly reminded us that there's lots of supply of government securities. As a matter of fact, the net interest income now is bigger than defense spending. So you put it all together, and you know, we still have a supply demand issue in the bond market that I think keeps the bond yield above 4%, even if we continue to see moderation in inflation, which we expect, and even if we see a Fed rate cut in September. But yeah, I mean, the worst thing that could happen to the Fed is that they cut in September and then regret it shortly thereafter. We've seen a couple of other central banks kind of go into this regret mode after they cut rates. The ECB being a good example of that.
Ed, just forgive me, I'm in shock. I can't believe how quickly Lisa managed to make this a bearish conversation. How did you manage that?
Okay, hold on. I'm just trying to figure out what the implications are if you see that there is enough momentum in the economy to not warrant a rate cut. That's all. And we talked about the deficit.
Ed, political considerations, how dominant are they for you going into November?
Well, I mean, you have to take Jay Powell at his word, and he's insistent that politics has no impact whatsoever on what the Fed does. Maybe that's his view, but the views of each of the Fed officials may very well have some political context in which they make their decisions. In a political world, in a partisan world like this, the Fed would probably, from a political standpoint, be best off doing nothing. But Powell's made it clear that they're going to go with the economic data. They're not going to be influenced by the political cycle.
How much does it influence your views, Ed? Just as it pertains to capital allocation, equity decisions, where you want to park that money in stocks?
Well, over the years, I think we've all learned, I've certainly learned that you never want to let political considerations bias your investment decision-making. Whether it was Obama or Trump or Biden, the stock market just kept going up, even though the policies were radically different among those three, for example. And we can go back further in history and find that Washington, more often than not, is sort of a sideshow. What really matters is the strength of the economy, which is driven by all of us working stiffs that are working. And making the economy work for everybody. So I am concerned, though. I mean, I guess we always look at the next presidential election as the most important one in American history, and I think everybody has that view about the upcoming one. And certainly we have the most divisive partisan candidates we've ever had for that job, and that creates uncertainty for the stock market. I mean, we'd like the political process to be smooth without a whole bunch of drama, but just because we like it doesn't mean we get it.
Talking about working stiffs, let's go to regulation. I am curious, Ed, before we finish up, there is this feeling that regardless of who wins, there has been a seismic shift, in part by the Supreme Court and the Chevron doctrine, and just how much some of these companies and more highly regulated industries will really be regulated going forward. Is that something, as we get all of these financial earnings, is that something that could shift you into more regulated sectors with the anticipation that they will be released from those shackles?
Yeah, I think that's a great point, and I think it's a huge development that is getting some press, but really maybe deserves a lot more press, and that is the Supreme Court decision that you're alluding to, in which the regulatory bodies have just been shackled. They're not going to be as powerful, as free, as independent to decide how the rest of us need to be regulated. It's going to be much tougher for them to have that kind of power, and we, the citizens, can go to court and challenge their legitimacy in some of the rulings that they make. So we're entering a period here of Supreme Court imposed deregulation, if you will, and that could be very significant, as you said, for highly regulated companies, particularly in the energy field.
Ed, thank you, sir. We've covered a lot of ground. Sure. Appreciate it. Ed Giardini, if you had any research on the equity market, new price target on the S&P, 5,800, up from 54. If you're just joining us and you've got one question, I guess, are we repeating the price action of yesterday? The answer is yes, to some extent. We're up by 0.8% on the Russell. We're down on the NASDAQ 100 by 0.1%, and the S&P 500 is going nowhere. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Just a quick recap of what we've heard from the big banks reporting so far this morning. JP Morgan, a record profit. That included a 50% jump in investment banking fees and a 21% jump in equity trading revenue to near $3 billion. Different story over at Wells Fargo. Net interest income missed analyst estimates, falling to its lowest level in about 2 years, but it did reaffirm its view for the full year. We'll get the results from Citi in less than an hour's time. AT&T has suffered a massive hack of customer data, one of the biggest breaches of private communications data in recent memory. The hack included records of calls and texts for nearly all of its mobile phone users for a 6-month period in 2022. It is separate from an incident reported earlier this year. The company said in a regulatory filing that the breach also included records for customers of wireless server providers that used AT&T's network between May 1st and October 31st of 2022. And some more bad news for the Biden campaign. Reuters reporting that the United Auto Workers president Sean Fain met with the union's executive board late Thursday to discuss his concerns about President Biden. The union is considering next steps as worries continue to spread among Biden supporters following his most recent gaffes, including misnaming Vice President Harris and Ukraine President Zelensky in post-NATO remarks. The UAW and the Biden campaign both declined to comment. And that's your Bloomberg Brief. John.
Danny, thank you. Appreciate the roundup of all the news this morning. We'll catch up with Danny again in about 30 minutes' time. Up next on the program, the president not backing down.
There's a long way to go in this campaign. And so I'm just going to keep moving. I'm not in this for my legacy. I'm in this to complete the job I started.
That conversation up next, live from New York this morning. Good morning.
Countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close, weekdays at 3 p.m. only on Bloomberg Television. Context changes everything. The top names in global leadership are on Bloomberg.
I envisage not only some kind of a bridge towards membership or language linked to the irreversibility of Ukraine's membership in NATO, but also some kind of a broader package of military material, of financial aid. The more we support Ukraine right now, the sooner the war will end.
Nobody covers the top global leaders like Bloomberg Television and Radio. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Equities on the S&P 500 just about unchanged. Likewise in the bond market, no drama there. Your 10-year yield 4.2158. Again, small caps outperforming, becoming a theme in the last 24 hours. Under surveillance this morning, the president not backing down.
The consideration is that I think I'm the most qualified person to run for president. I beat him once, and I will beat him again. There's a long way to go in this campaign. And so I'm just going to keep moving, and because, look, I got more work to do. I'm not in this for my legacy. I'm in this to complete the job I started.
Here's the latest. President Biden vowing to stay in the race despite deepening concerns about his fitness to serve for a second term. At least 3 more Democratic lawmakers calling for Biden to drop out of the race following last night's press conference, bringing the total up to 17. Anne-Marie's in Washington for us this week and has more. Morning, AMH.
Good morning, John. That press conference last night absolutely overshadowed by Biden's age. Every single question, the majority of them linked back to his age. And of course, they were also overshadowed that the gaffe the president had going into that press conference. The fact that he called President Zelensky President Putin, and then his first question at the press conference, he called his vice President Trump. That is why it wasn't enough to assuage these concerns. And that is why you had more lawmakers coming out last night. Most notably, the ranking member on the Intel Committee, Congressman Jim Himes, coming out last night and talking about the fact that he thinks this is really sick, what is going on. The fact of the matter is that it's this aspect, this sick moments of these aspects. They're watching every speech, every rally, every debate to see if the president messes up. And that is why there's concern. Can the Democratic Party even have policy discussions if they're going to continue to focus on the president's mishaps and his age?
Anne-Marie, thank you. And this was the problem yesterday, Lisa. It didn't matter how well that news conference was going to go. That wasn't going to change anyone's mind anytime soon. And you got the sense that some Congress members were waiting until the NATO confab was done before coming out and expressing their displeasure and their wish for him to step down. It almost didn't matter how the press conference went. Press send almost as soon as it ended. Did you notice
exactly,
that?
But
just
that's
like bang.
Yes. It was a predetermined kind of decision, and that is sort of what stands out to me.
Certainly felt that way. Charles Mars joins us now of Signum Global Advisors. Charlie, great to catch up with you, sir. A line that you've mentioned before, and I'm going to read it again for our audience. I think he stays in longer than most people predict. Charles, what are the pillars that underpin that particular view?
Yeah, absolutely. Thanks for having me back, by the way. Just quickly, if I can, on the press conference, it was probably the most watched cognitive test in the entire, history of the world. There was something in there for everyone. I don't totally agree with your reporter's assessment a moment ago. There were two main gaffes. There are gaffes all the time. They will go viral. They have gone viral. But there was also some pretty substantive answers on foreign policy and domestic policy. So there was a bit of something in there for almost everyone. If you wanted to not like him or you're worried about his age, you got it a bit. If you want to be reassured, you were also reassured. Here's what I'm watching to answer your question on what he does. There are really three things. First, will the Democratic congressional leadership stick with him? Nancy Pelosi, Hakeem Jeffries, Chuck Schumer, and Jim Clyburn. Schumer and Pelosi 3 days ago, in the last 3 days, have kind of opened the door a little bit for him to possibly think about dropping out, but they have not abandoned him. We need to watch that most closely. Yes, there's 17 members of Congress that have now called for him to step aside, but we need to watch the leadership. Secondly, very quickly, is polling in the swing states. In the 6 swing states, hasn't moved much yet, but it's early. We want to watch that. Third is fundraising. Is fundraising really drying up, or is it still a handful of donors that have come out publicly against the president? We need more data. We'll probably get that in the next 2 weeks.
Time is against him right now, and time is against, frankly, the Democratic Party, especially at a time where yesterday we were all talking about the press conference. We weren't talking about the inflation data, the sort of Goldilocks reports that we got at 8:30 a.m. Eastern. At what point will there be a sense of urgency? Not let's wait and see. Let's just gather some sort of consensus. Will there be some sort of come to Jesus moment where people kind of say, all right, let's make some actions here?
Yeah, look, I think you're right, because, the issues around his age, his cognitive, decline, his fitness is dominating the news cycle, as opposed to, let's talk about the issues in this election and let's turn it back to Biden versus Trump. But the president's about to get a reprieve because the Republican National Convention starts Monday. President Trump is going to pick his running mate at some point between Monday and Wednesday. Again, that'll be the news. So I think we're going to get a little bit of a break here on this question of Biden's fitness. Secondly, I would just point out that while the media and a lot of other folks are most focused on Biden's age and, again, fitness for office, the truth is the average voter in the 6 swing states actually really cares about the issues, the economy, a woman's right to choose, border security, defense of democracy, take your pick. They really do care about issues. I think in 2 weeks we will not be talking about Biden's age.
There is a concern, though, especially at an event like NATO, where internationally there are some real consequences to how your leader comes across, to how your leader presents himself or herself, and there is a sense of where the vulnerabilities are if there are all sorts of discussions about not being able to respond at certain times. I'm just wondering at what point that gets enough attention by the donor class who say, wait a second, this isn't what the image we want to project.
No, absolutely. Look, there are a lot of, Americans and donors who also worry about Trump's response to any international crisis, even though he's sharper. So, but yes, I'm not discounting the importance of the decision making of the president of the United States, especially in a moment of crisis. But, the truth is, as you mentioned earlier, part of your earlier question, he's not going to drop out anytime soon. There's, first of all, no mechanism to remove him aside from the delegates at the convention. 99% of the delegates are his. They're not going to do it. And so it will take, again, the congressional leadership, Democratic leadership, a big group of donors, but also polling to force him out. And lastly, I would just, add that while there's been a lot of reporting of Pelosi and Obama colluding or meeting and talking about his exit, I hope they're meeting. I hope party leaders are meeting considering all options, right? I mean, that's what you do in politics. You need a plan B, a plan C, and a plan D. Plan B is Kamala Harris. But I'm glad that Pelosi's talking to Obama, et cetera.
Charles, it's great to get your views, as always. As I said last time, we've got to keep doing this and get an update from you. Charles Mars there of Signal Global Advisors. Just to build on some of this, I think what we've seen over the last couple of weeks, and we've seen many things, but here's one. I think what we've witnessed is party officials regret deeply in public that they didn't have a more robust primary in the Democratic Party. And if they had have had one, a key tenet of Biden's campaign would have been, I'm the only guy who can beat the former President Donald Trump. And in some sense, I think a takeaway from me from that news conference yesterday is, yes, there were gaffes. And yes, I think we all agree with Charles. He did have command over some pretty complex subjects throughout the hour of that Q&A. But a key question for me that I'd have now is he opened the door and undermined a key tenet of his campaign, which is, I'm the only guy that can beat the other guy.
Which places such key emphasis on polling, right? Is that going to be the ultimate cudgel that could potentially get him out of office if you get the polls that really start to push against his ability to win and maybe give the opening to somebody else who could win? There just is this feeling that maybe he would then consider stepping aside. I don't know. I thought it was really interesting when someone asked him, weren't you the bridge candidate between a younger generation?
What happened?
What happened? And that was a bit of a fumbled answer, in my opinion.
The conversation continues. Coming up on the program, we'll speak to Laura Raim of FS Investments from New York City this morning. That's up next. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
For years, people told me, why are you invested in Apple? Everybody talks about Apple. I actually think that sometimes because someone speaks a lot about something, it might be actually a good sign versus an overhyped sign.
The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything. The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything.
Equity futures on the S&P 500 unchanged, the standout. The word of the last 24 hours starts with R. You know what it is. Rotation. Heard it on repeat for the last day or so. You're going to hear it again this morning with the Russell up by another 0.9%. The moves we saw yesterday, Lisa, coming out of mega cap tech, if you strip out the muscle of big cap tech, market looks good. You include it, market doesn't look good at all.
The fact that equal weight S&P 500 gained nearly 1.2% at a time where the overall index was down a similar amount, where you saw the NASDAQ down almost 2%, gives you a sense of just how big of a divergence there really is. The real question, you've been asking it all morning, it's the right question, how durable is it? And also, how much is this people selling the winners to go into some of the more beaten up, less loved stocks in order to have bigger gains? Is this fear? I mean, is this greed, not fear? And essentially, how long can that go on, given that people have been talking about a weakening economy?
I had one question about one particular dimension, one specific dimension of yesterday's rally was the home builders. Home builders ripped too. Home builders did nicely as well in a rising rate environment, and now we've sort of got these bets they'll do well when we cut rates as well. Been asking this a few times. You've asked this question. I think it's a great question. Just to test how people are thinking about the world. Are house prices going up or down when they cut interest rates in America? What happens here?
Nobody knows. And basically, you can make an argument that if you cut rates, prices go up in houses because more supply comes onto the market. But it's not enough to offset the lack of housing, the dearth of housing, and more people can then get mortgages. Other people say the prices will go down because the supply glut will overwhelm the demand, right? Pick your poison, go for it. Home builders have been struggling a little bit more of late, in part because costs have gotten a little bit more punitive and for them to borrow. So could there be some sort of reversal of that just to add to their boom? I guess that's why we've got a market.
Let's get into the rate story, and we can talk about what's at the epicenter of a lot of that conversation. Your two-year yield at the moment, 450.82.
Take a look at the market wrap for the European session. S&P 500 futures a little changed, though JP Morgan and Wells Fargo are down pre-market after reporting results. You also had Apple and Microsoft edged higher in pre-market trading, while the NASDAQ 100 contracts paired an earlier decline that followed a 2.2% plunge for the index on Thursday. Tesla dropped following news that it will postpone its planned robotaxi debut roughly by 2 months. As Wall Street giants prepare to start their earnings cycle, investors have been switching to cheaper cyclical stocks, including banks and out-of-tech megacaps. Thursday's inflation data raised bets that the Fed will be able to cut interest rates soon, with a reduction in September now fully priced in and at least 2 by the year end. The Stoxx Europe 600 index rose for a third day, with only one industry sector, tech, in the red as chip makers including ASML and ASM followed US peers lower. Telecom stocks led the advance, with Swedish network equipment maker Ericsson surging more than 6% after reporting results that beat analysts' expectations.
going into the
Oil
September
also climbed
meeting.
for a third day on signs of stronger demand and signals that the Fed is getting close to its much anticipated pivot, and gold fell after a sharp rally on Thursday. Also, looking at the need-to-know headlines from the risk, Swedish CPI was weaker than expected and led to the Swedish krona weakening. Bank Japan accounts point to intervention of about 3.5 trillion yen, and Bank Japan accounts suggest Japan intervened in the FX market overnight.
The idea being that yesterday we got some real dollar weakness, dollar yen gaps lower, and they piled on reportedly. Look at the range we've had on dollar yen today. The higher the session.
As a reminder, we still have Citi earnings that are due up at the top of the hour.
76. We've been all over the place in the last day.
Is this their playbook, that essentially anytime there's data that would indicate weaker dollar, they pile on and just add billions of dollars to try to exacerbate the strength in the yen on that particular day? Is that essentially what new intervention looks like? The estimates is that they intervened to the tune of about $22 billion in yen.
They would love to introduce some two-way risk. Let's see if they can maintain that. We're back to 159. These are levels they do not want. We all remember the days when we were talking about breaking 150 and that was the big line of the sand, and here we are still close to 160. That's the price action under surveillance this morning. Your top story, President Biden vowing to stay in the race amid deepening concerns about his fitness for a second term. At least 3 more House Democrats joining the growing list of lawmakers calling on him to step aside. It is unusual to say that every single interview, every single news conference is high stakes, but that unusual backdrop for Washington is likely to continue. On Monday, we'll get another interview and everyone will say it's a high-stakes interview for President Biden.
When it comes to the market implication, how much is this basically giving legs and giving ammunition to the whole Trump trade that really started a couple of weeks ago? Is there sort of a sense of what the Kamala Harris trade would be or some other potential options? I'm just wondering about the kind of volatility that this could introduce when so many guests come around this table and say, it's noise, not any kind of signal.
I got a note from a Bloomberg customer just moments ago, a subscriber. I love how Lisa says the donor class. I want to be in the donor class. Money I can set on fire and feel good about. They said you're the best. I agree.
Thanks.
I love that too.
Well, I mean, I'm just thinking, who has, right, the capacity to do that? I'm just thinking.
Throw money on a burning fire.
Okay, well, you know, you could call it a burning fire. You could talk about civil duty.
True. You know, some people might have a different opinion on that, of course. Wide range of perspectives, as always, on this program. JP Morgan delivering better than expected investment banking revenue. This coming as Wells Fargo misses estimates on net interest income. We'll get Citi numbers in about 25 minutes' time. The CEO of JP Morgan, Jamie Dimon, going on to say this: there has been some progress bringing down inflation, but there are still many inflationary forces in front of us. Wells Fargo getting punished. We're down 6%. JP Morgan doing okay, down 1.5.
Well, net interest income really was the reason why. The fact that Wells Fargo, which is a lending bank, it has been traditionally been a small business kind of place, came in at $11.9 billion versus the estimate of $12.1 billion, was a big blow. JP Morgan's bolstered by everything because they're just the biggest and strongest, and they always seem to win. And they've been bolstered significantly by the fact that, as Sonali Basak said, Wall Street wins. We shall see with Citi, and I actually am really curious with Citi, possibly even more so, given some of the restructuring and how that's going and how that's playing out in some of the numbers.
That stock has done so well, hasn't it, Citi, over the last year or so. Just a programming note for you, 8 o'clock Eastern time. Won't just get Citi numbers, we'll also get the media call for JP Morgan. 8:30, the analyst call will begin. So expect more headlines coming from C-suite executives from that particular bank in the next 60 minutes or so. Let's talk about the data. Investors awaiting US PPI data after a soft CPI print yesterday bolstered bets on a September rate cut. Chicago Fed President Austin Goolsbee saying he's confident inflation is on a path to 2%. Lara Rain of FS Investments writing this: we believe the Fed will cut in September as the June report confirmed inflation momentum. We expect rate cuts will be surgical, not programmatic. Lara joins us now for more. Lara, where does that distinction come from, surgical versus programmatic?
I think when I look ahead, not just at what's expected from markets this year, but next year, this idea that they're going to be able to just cut once a quarter, sort of on autopilot, I think is a huge mistake by markets, because today, while we have seen, 2 reports in a row that have looked really good, we've also still gotten some inflation whack-a-mole. Not as badly as we did in 2022, early 2023, but we're still getting sectors popping up that are a problem. The latest one, the insurance data, really had caused that super core number to continue to stay really elevated. it's dissipating now, but we cannot, I think, get too complacent on inflation. When I look ahead, I still see, even at the beginning of 2025, rents starting to become a problem again. This is not something that is just going to happen sort of miraculously as everybody had expected at the beginning of, or the end of last year.
Sounds like you agree with Jamie Dimon. This is what the JP Morgan boss had to say. We quoted him just moments ago. There are still many inflationary forces in front of us. When you say rents might still be a problem, Lara, what's driving that? What makes that sustainable? Where does that come from?
When you look ahead, you're starting to see, after months and quarters of rents coming in sort of below trend, we are now looking, and you talk about, supply dynamics. It's actually pretty easy to look ahead and see supply dynamics in the multifamily space. We've seen construction starts in that space plunge. We've seen, that is an 18 to 20 month lead time. So when you look ahead at supply that's expected in 2025, 2026, it's as low as it was during the wake of the financial crisis. So I think we're heading, at a time when, let's face it, the supply of single family homes is not really, I think, going to be able to sort of come online very speedily. And again, the dynamics of the millennium cohort, they're just a big cohort and they want homes. So you put it all together, I think you're going to see some of the rent pressure. And again, we don't know what policies are going to be in place in the beginning of next year. Should we get a Trump presidency? Those policies are inflationary. So, you put it all together, I think it's not the time to get complacent. The Fed is going to want to pick and choose depending on the data. We can't assume they're going to be able to just sort of go on some automatic program.
We'll get to the politics in just a second. I do want to pick up on what you just said there, but just sort of putting together this idea of surgical rate cuts and then this concept of fear of a policy error in terms of cutting too soon that could reignite inflation. How big of a difference would 25 basis points of a rate cut or even 50 basis point of a rate cut make in terms of helping to reignite inflation?
I think you're right, Lisa, that when you look at sort of the risk of cutting a little bit and making sort of a nip and a tuck is not significant, especially because, we all look at sort of things like housing affordability. That's much more of a long-term interest rate story than really a Fed funds rate story. So, I think there's no real harm to a 25 basis point rate cut. It's not going to sort of cause some inflationary brush fire to pick up. That's why the Fed, I think, is going to seize this moment in the wake of these good inflation reports and start down that rate cut path. But it's really looking ahead, and markets getting too cavalier in assuming that they're going to be able to take this opportunity and read that forward into multiple quarters. I think that's where we need to really make the distinction.
So just going back to the politics of the moment, because you went there and everyone's been talking about it ad nauseum. I'm sure some people are immediately just tune out. I am curious about the idea of Trump being more inflationary at a time where some people say some of the proposals that would be inflationary would also dampen growth and would therefore have a one-time inflation effect, but longer term, actually, if anything, disinflationary. What's your take on that?
I think, when I look at both candidates' proposals, one of them is, strongly sort of pro-spending, which, is the momentum that got inflation, on the higher end of the comfortable spectrum to begin with. The other one, and I think, when I think about the labor supply dynamics and some of the acute wage pressure that has emerged in that sort of services worker sector, when you think about sort of removing a large amount of labor supply from that, you end up with, I think, a wage dynamic that makes inflation hard to, again, get back to 2%. I actually, think that neither candidate, both candidates want a strong economy at the end of the day. And until we actually get a policy proposal, I am very careful to take campaign rhetoric and impose that on sort of a policy recommendation. But I think when you look ahead to next year, we got really complacent on inflation and everything has to go perfectly to keep it at 2%. Yeah. When you think about next year, I think you're probably still looking at inflation that's sticky and stubborn above that 2% target.
That's the difference between being an economist and a trader, Lara. You have time to sort of formulate the thoughts. Traders are just like, this is what I feel, let's go. It's going to be the inflationary candidate. I'm going to trade accordingly.
I love how people come on the show and they're saying the market just needs to have patience. And then traders are like,
you don't have the luxury of time.
What?
Lara Raim of FS Investments. Lara, a patient Lara. Thank you. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Novo Nordisk Ozempic was linked to lower rates of dementia and a range of other mental problems, according to a University of Oxford study. After a year on Ozempic, patients had a 48% lower risk of dementia versus those who took an older medicine. The study is the latest to show potential benefits beyond diabetes and obesity control. Hungarian Prime Minister Viktor Orban traveled to Florida to meet with Donald Trump, the latest stop on his self-styled peace mission to resolve the Ukraine war. Orban posting on X an apparent reference to his belief that a Trump presidency would result in a quicker resolution, saying, quote, he's going to solve it. Orban is the EU leader with the closest ties to Russian President Vladimir Putin. Orban has also worked to stall Western aid to Ukraine. Last week, he blindsided the EU by meeting with Putin in Moscow and Chinese President Xi Jinping in Beijing. Jurors in the bribery trial of U.S. Senator Bob Menendez are set to begin deliberations today after a 2-month trial in New York federal court. Menendez faces 18 criminal counts, including bribery, extortion, conspiracy, and acting as a foreign agent of Egypt. He's accused of taking 13 gold bars, nearly $500,000 in cash, and a Mercedes-Benz from 3 businessmen. Menendez's lawyers blamed his wife for keeping her husband in the dark about her financial problems and the gifts she received. And that's your brief, John.
Danny, thank you. I've got thoughts, but given this is an ongoing case, I should probably not share them.
Oh, yeah.
So let's park the case.
Let's just imagine the case isn't happening.
The case is parked.
Yes?
I'm talking about the case.
Okay, but?
Blaming your wife for something like this is something, isn't it? You know, sort of like just throwing your wife under the bus.
Well, I mean, it basically is what happens if you know you're going to be
work at home.
locked
Not this
up in
case,
jail.
just
Not in this case. If you might end up in jail, it's sort of like, you know, basically throwing everything you've got because, you know, I don't know.
It's rough, eh? That's tough.
Home life?
Yeah. If you were in that situation, not this case.
Let's assume.
Up next, let's assume it or not, the US reaffirming Ukraine's military limits.
First thing about Zelensky asking for the ability to strike deep into Russia. We've allowed Zelensky to use American weapons in the near term, in the near or abroad, into Russia.
We'll get you some clarity on those comments in just a moment. From New York, this is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
The S&P 500 just about unchanged here in the equity market. Yields going nowhere too. Your 10-year 421.39. Under surveillance this morning, the US reaffirming Ukraine's military limits.
First thing about Zelensky asking for the ability to strike deep into Russia. We've allowed Zelensky to use American weapons in the near term, in the near or abroad, into Russia. If he had the capacity to strike Moscow, strike the Kremlin, would that make sense? It wouldn't. The question is, what's the best use of the weaponry he has?
And this is what's deeply upsetting about the last week or so, particularly the last 24 hours. That was the president wrapping up NATO's 75th anniversary meeting at a time where there are two hot wars. We've just had a news conference where a lot of people in that room were more preoccupied, more interested in what time the president of the United States goes to bed. And that's a distraction at a time when we need to be having serious conversations about American policy.
Especially because the implications of what he was talking about is the potential for a broadening out in an existential threat, arguably, for Europe. So there's this real issue of, okay, why are we not talking about how to resolve this in a more concrete way and help people get back to their lives and not watch and witness mass death?
That distraction's not going away because, by definition, the president is only getting older. Anne-Marie in Washington is alongside a special guest in D.C. AMH, good morning.
Good morning, John. The distraction's not going away, but one individual that is hyper-focused on the actual policies that were discussed this week is, of course, the NATO Secretary General Jens Stoltenberg, and this was his final NATO summit. You're going to be retiring in the fall. You've been at the helm for a decade, so you've seen a lot. We're going to get into some of those distractions that were happening at the summit, but I want to get into some of the policies. We just heard President Biden there talking about the limits they've placed on Ukraine about striking deeper into Russia.
Just a reminder, in about 10 minutes' time, we're expecting earnings from Citi with an EPS estimate of $1.39 and a revenue estimate of $20.11 billion.
The U.S. doesn't trust Zelensky?
Well, first of all, the US and other allies have loosened the restrictions they have imposed on the use of the weapons they have donated to Ukraine. So Ukraine is now able to also strike against military targets inside Russia. And we need to remember what this is. This is a war of aggression. Russia has attacked Ukraine. That's violation of international law. Ukraine has the right, according to international law, to defend themselves. And that includes also striking legitimate military targets inside the territory of Russia. And some allies have given them that permission. Other allies have some restrictions, but they have been loosened up a bit.
But of course, the most important ally sending the most weaponry is the United States. And they've only said you can go about 40 kilometers. But to really, Zelensky's point is to really start to push back the Russians and be defensive, they need to get on top of it, meaning going maybe 300 kilometers. Do you think, I mean, you were part of these discussions, do you think this is something the United States, we've seen them before drag their feet and then make decisions that Zelensky was pushing for. Could you see them coming around to this?
This was an issue that was discussed at the NATO summit. And again, some allies have no restrictions on the use of the weapons they have delivered. Others have restrictions but have loosened them. The US is, of course, important, but half of the military support to Ukraine comes from non-US allies, comes from Europe and Canada. So when it comes to Ukraine, the Europeans have really stepped up, and with the decision we made at the NATO summit to have a long-term pledge and to have a formula for burden sharing, we will ensure that also in the future European allies and Canada will provide half of the military support because they have half of the economic strength of the alliance.
Ukraine didn't get the formal invitation they were hoping for. So they are still at the gates, knocking on the door, and they're not let into NATO just yet. While they do this, though, it unnerves Putin. Do you think they're, in a sense, almost the worst position, this security purgatory, because they're still stuck in the middle, because they're not yet in alliance, but even asking to be in alliance really underscores the issue that they're having with their neighbor next door?
At this summit, allies were very clear that Ukraine will become a member. We also stated that this is a reversible path towards a membership, but actually as important, or perhaps even more important than the language in the statement we agreed, is that actually we took actions to move Ukraine closer to membership. We established a NATO command with 700 personnel to organize the provision of training and military support to Ukraine. We agreed this long-term pledge, and we stepped up the work to do what we call interoperability, to ensure that Ukrainian forces are fully interoperable with NATO forces. These are concrete actions that actually helps them to prevail, to help Ukraine to prevail as a sovereign, independent nation in Europe. And all of that moves them closer to membership. And then when the time is right and allies agree, they will become members straight away.
As you know, politics overshadowed this summit. Everyone was talking about, if not officially, unofficially, President Biden's age. As the NATO Secretary General, who's worked with both of these U.S. presidents who are the candidates for November, do you see potential change in the future U.S. commitment to the alliance?
I expect that the United States will remain a strong NATO ally also in the future for at least three reasons. One is that this is in the U.S. security interest to have a strong NATO. In NATO, the United States has something Russia and China doesn't have, more than 30 friends and allies. Second, it's very strong bipartisan support in the United States for NATO. In the public, we have seen new opinion polls also confirming that, but also in the U.S. Congress. I met congressmen from both parties, and they all expressed some strong support to NATO. And thirdly, the main criticism from former President Trump and others have actually not been against NATO. It has been against NATO allies not spending enough on NATO, and that has changed. Over just the last years, we have seen a significant increase in the number of allies spending at least 2% of GDP on defense, which is the NATO guideline.
So is your expectation to ignore, potentially, your expectations that Trump's rhetoric will not match his policies on the ground?
Well, I worked with him when he was Prime President last time, and again, I expect that the United States will remain a strong NATO ally, because this also makes the United States safer and stronger.
5 minutes away from Citi Q2 earnings for 2024, EPS estimate of $1.39 and a revenue estimate of $20.11 billion.
50% of the world's military might, and this makes the United States stronger. And the main criticism, the fact that European allies didn't spend, that has really changed. 23 allies spending 2%, and those allies are not yet at 2%, have a promise to be there soon. So this has really improved, not least because the criticism from the United States was valid, and Europeans have heard the call and have stepped up.
Jens Stoltenberg, thank you so much for your time. That was, of course, John, Jens Stoltenberg, the outgoing NATO chief.
Anne-Marie, thank you. Thank you very much. And the incoming NATO chief, Mark Rutte, former Dutch Prime Minister, who we know well on this programme. And just like Jens Stoltenberg there, saying the same thing, that the former president was right to point these things out, and we agree with him, and we're doing something about it.
We spoke with him when we were in Davos, and he said, you know, honestly, he wasn't wrong, and frankly, it makes us stronger to also think internally about increasing our own defense spending, especially at a time of war.
Coming up in the third hour of Bloomberg Surveillance, here's the lineup for you. Keith Lerner of Truist, Bloomberg's Ed Ludlow, Mohammed Al-Erin of Queen's College, Cambridge, and Ashok Bhatia of Neuberger Berman. From New York City, this is Bloomberg.
You are also an owner, I should have pointed out, of three major sports teams.
That's right.
Right? And you're the first woman, as I understand it, first woman to own three major, have stake in three major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of
All things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg. The top names in global leadership are on Bloomberg.
China has started to provide Russia with different types of aid, not direct military aid, but issues linked to energy, sometimes even dual use of goods. I argue that Russia is so dependent on China right now that one phone call from President Xi Jinping would solve this crisis. If he were to say, time to start negotiating peace, Russia would be forced to do that. They would have no
Surely
other choice.
expecting City earnings.
I would like China to play a serious role. Russia really depends on it because they don't have another place to export many of their goods because of the sanctions.
Secured overnight financing rate unchanged at 5.34%.
China could play a tremendous role without weapons.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. The top names in business are on Bloomberg.
One of the reasons why I'm frustrated, like many Americans, about our choices for president is neither is proposing to do anything about a coming debt crisis in our country. Our debt is already as large as our economy. It's going to go nowhere but twice as big as that. We have an entitlement problem, which is these entitlement programs are going bankrupt by the end of the decade. We have to get ahead of that. Otherwise, we're going to have a debt crisis in America.
Nobody covers business like Bloomberg. Context changes everything.
The markets are essentially priced for Fed perfection.
The market has already gotten to the point where you're
Still waiting on City earnings.
The concern is if they move too quickly, the expectation will set.
Revenue of $1.63 billion, a beat on the estimate of $1.55 billion. Total loans at $687.7 billion, a beat on the estimate of $680.54 billion. Wealth revenue $1.81 billion, a beat on the estimate of $1.73 billion. Investment banking revenue $853 million, a miss on the estimate of $870.4 million. FICC sales and trading rev $3.56 billion, a miss on the estimate of $3.61 billion.
Around about 1.1% on the small caps this morning. On the S&P 500, Lisa, going absolutely nowhere.
Which raises the question, how durable is this rotation?
So still waiting on their EPS data to come through.
Basically a two-pronged idea here of initial jobless claims coming in lower than expected and ongoing disinflation. Does that Goldilocks feel continue through the earnings cycle?
Earnings cycle continues on Wall Street, kicking off early this morning with JP Morgan and Wells Fargo. Just moments ago, Citi dropping. Sonali Basak alongside us to break that down. Sonali, what do you see?
Well, a few things here, John, as we watch for the rest of earnings to continue to cross the tape here. A few pieces that critically missed analyst estimates. That includes investment banking revenue, coming in below analyst estimates, and FICC sales and trading revenue coming in below analyst estimates to a degree that we saw an even greater miss than what we saw at JP Morgan. Remember, JP Morgan just about met fixed income expectations. Citigroup meaningfully missed expectations on this figure here. Why is this important? We've been talking about it all morning.
CTC's year-adjusted expenses likely at high end of $53.5 billion to $53.8 billion.
At the top ranks of a lot of these businesses. So perhaps they get some of a pass here. Remember, their new investment banking head, which they bought in from JP Morgan, just really started a matter of weeks ago. His pay package crossed the line just about 24 hours ago. And so a lot of questions here about how Jane Fraser brings in those businesses at this market, because of course, yes, we've had a rebound so far this year, but it has not been as robust as anyone would have expected.
Meanwhile, just looking through some of the numbers, their adjusted earnings per share beat the estimate. Yes, they did have a miss on the fixed income sales and trading revenue. They also had a slight miss on the investment banking revenue, but loans came in stronger than expected. Wealth management, wealth revenue came in stronger than expected. Shanali, we got the three banks to really kick off earnings season. What are some of your takeaways? And I understand that it's early and you're still parsing through all the numbers, but is there a theme that has emerged in these three earnings reports?
So Citi's EPS of $1.52, a beat on the estimate of $1.39.
You're seeing in those key Main Street businesses. Even when you look at JP Morgan, which minted a record profit, you're looking at a lot of their net interest income from consumers coming in from credit cards. The big question about credit cards is, can the consumer keep maxing out on credit cards? Over at Citigroup, to your point here, it's a really strong sign that you are seeing strength still in the wealth management business, because you have the banks here leaning on their wealthy consumers in particular here to drive that extra dollar when you think about net interest income and the ability to lend to clients. But you are still seeing a lot of broad concerns here across the banks about credit quality at this part in the cycle. Even if it's not really extreme, you are seeing those numbers starting to mount at these banks.
Shanali, great work as always. Looking forward to your coverage at the top of the hour, 9 o'clock Eastern Time. Look out for the programme led by Shanali Bassett going into the opening bell. If you are just joining us, had some numbers this morning from JP Morgan, Wells Fargo. Citi just dropped. Here's the price reaction to all of that. JP Morgan just about positive. Wells Fargo negative by close to 6%, Lisa. That is the loser of this morning. Looking ahead to next week, got Goldman on Monday, got Morgan Stanley and Bank of America on Tuesday.
Really interesting story here as I look at some of the price action. It is messy. It is early days. The idea that Wells Fargo is down as much as it is it because they missed net interest income, or is it, to Shanali's point, some concerns about the credit quality of loans? And I'm not just talking about consumer loans, but also commercial real estate. They did flag an increasing number of non-performing loans in that space. This kind of goes to the question that we really set the show up with, which is, at what point will the earnings season kind of fly in the face of this Goldilocks soft landing? Does it indicate either more strength than people are expecting that could reignite inflation, or less strength that might make it a less auspicious moment for some of these other more leveraged names?
There's a theme here in the last 24 hours in earnings, and I think you're right on top of it, Lisa. Coming up to explore that theme in the next hour or so, we'll catch up with Keith Lerner of Truist as tech stocks head lower over the last 24 hours. Bloomberg's Ed Ludlow as Tesla delays its longer-awaited robo-taxi event, and Mohammed Al-Aaron of Queen's College, Cambridge, reacting to the inflation data that we get in about 25 minutes.
So Citi shares raising earlier loss, gaining 2% after the result.
We begin with the big issue. Stocks snapping a 7-day winning streak yesterday as investors rotate out of big tech. Keith Lerner of Truist staying bullish, saying this: stocks are in a bull market that deserves the benefit of the doubt. Moreover, strong first halves tend to lead to further gains by year-end, albeit with normal corrections along the way. Near term, we anticipate that stocks will trade in a choppier fashion, but still, the primary uptrend appears intact. Keith's with us for more. Keith, I want to build on what Lisa's been talking about. I think it's perfect. It's the way to think about things. Yesterday, we had some data that spoke to this Goldilocks optimistic, constructive view of things. We also had some earnings that said the opposite. And Keith, I'm wondering how you view things, both on the economic data side of things and through the lens of earnings in the last 24 hours.
Sure, and great to be with you all. Yeah, yesterday was an interesting day. We actually downgraded a tech in late June after upgrading it in November. And basically our view was that, after a 40% gain since we upgraded it, that things had gotten a little bit too stretched. And in July, we saw the tech sector continue to kind of grind higher. On the other side, what we saw on this kind of mean reversion trade, the rubber band just got too stretched. The relative performance of small caps up until yesterday was at on a 6-month basis, was at the greatest underperformance we've seen since 2000. It was a 20% underperformance over 6 months. It's incredible. The average stock, the eco-weighted index, also had the greatest underperformance on a 6-month basis since 2000. So I think what we're seeing right now, what happened yesterday, Jonathan, is the rubber band got too stretched. And basically, a little bit of good news went a long way for the other stocks. We got that broadening that everyone's looking for, but when that broadening is happening, those big cap tech stocks came in, and the market below the surface was strong, but the headline index was weak. So it's kind of interesting in the way this kind of played out.
I have this image in my head of kids in a rubber band fight, stretching it out and waiting to kind of let go. The letting go yesterday was the potential for rate cuts on this sort of Goldilocks-like kind of environment. At what point do you start to get concerned that maybe it's still not threading the needle perfectly, that some of the guidance that we've heard from banks, from other companies that have reported earnings so far, it is early days, signals something else that might portend a bit more weakness.
Well, I do think we are seeing a cooling of the economy. We wouldn't call it weak, and I expect that earnings will be fine. Probably not the blowout that we've seen in the past.
So yeah, looking at the Citi earnings with a rev of 20.14 billion, a beat on the estimate of 20.11 billion, and the EPS of $1.52, which was also a beat on $1.39. The total, the banking revenue was $1.63 billion compared to the estimate of $1.55 billion.
Backdrop, and we've seen corporations handle that pretty well. So again, I do think we'll be in a little bit more of a choppier fashion here near term, but I do think the underlying trend for the market is still higher, and the economy is just moving more towards a trend growth from this really post-pandemic stimulus boom that we had. That's behind us now.
Let's talk about some of the areas where we're seeing a broadening. Smaller banks, for example, which has been one of the most beaten up areas, and we saw some gains yesterday. As we get some of the bank earnings from some of the behemoths, JP Morgan, Wells Fargo, and Citi, is there a takeaway that makes you more positive, more constructive, just in general in the financial sector?
Yeah, I think time frames matter, right? So longer term, we still actually like tech on a longer term basis, and we think there'll be an opportunity to redeploy there. On a shorter term basis, I just think that areas like the financials, even the smaller financials, along with some of the industrials, even places like the REITs will likely outperform because the expectations are so low. So I think right now, I think we should be thinking more about how things are coming in relative to expectations. I think some of these areas that have been beaten up where, the small cap index, S&P small cap index was actually negative for the year up until yesterday, that the expectations are low. I think when you think about the tech side, I think expectations there are a little bit higher. So I think we're going to have maybe more of that bifurcation during this earnings season.
Keith, give us some clarity on financials. Not exactly left for dead. Bank of America's up 24% year to date. Goldman's up 24%. Citi's up 27%, close to 28% before today's moves, granted. Keith, are you talking more specifically
Dollar
about
yen turns negative, down 0.1%.
Yeah, that's right. Yeah, I'm sorry. Yeah, that's right, Jonathan. I mean, what's interesting was like yesterday during that big rebound, the big banks were actually down because what we've seen, it wasn't just tech, it was this gravitational towards the highest quality companies in the different sectors, so not just tech. So what you saw yesterday is the smaller banks actually outperformed and the other ones came in a bit. I think we'll see more of that just because of that divergence. Again, longer term, as we move past this kind of snapping back of the rubber band, which I think could last, weeks, if not a few months, I think the rotation will go back towards these larger quality companies. I just think it got overdone as far as just the quality theme on a very short-term basis. And we're going to see more of that unwind because positioning has further to go. Based on our work.
Got it. Keith, thank you, sir. Keith Lerner of Truist on the latest in this market and what we're calling the everything else rally of the last 24 hours.
I was very bad at rubber band fights. So when people start talking about a stretch rubber band...
Is that a thing? You used to do that at school?
Oh, yeah. At home, at school. Absolutely. You've never been engaged in that where you have to get it just so. I would always release
used to put things on it.
Yeah. Like a slingshot. No, yeah. I would always kind of get it wrong and it would fling back at me and I'd feel really embarrassed.
Were you that person in the class?
No, never.
All right, okay, let's leave that there. Let's give you an update on stories elsewhere. I've just got that vision now. You bullied, Brahma. We can talk about this.
By myself,
by
evidently.
Yourself? Okay. It's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Just a roundup of the earnings this morning from the bank. Citigroup reported earnings that beat estimates. Fixed sales and trading revenue, however, did fall short of Wall Street estimates. For JP Morgan, it had record profit, including a 50% jump in investment banking fees, 21% jump in equity trading revenue to near $3 billion. Over at Wells Fargo, it was a net interest income that missed analyst estimates, falling to its lowest level in 2 years, but it did reaffirm its view for the full year. Another airline reporting a gloomy view for the summer travel period. This time, Germany's Lufthansa has cut its profit outlook for the full year. It said breaking even will be increasingly challenging with higher unit costs and falling ticket prices. It was yesterday, Thursday, that Delta warned that it's struggling to fill planes, resulting in a fare war that's dragging down ticket prices and weighing on profits. Donald Trump is looking for another win in his court cases. The former president asked a New York judge to toss out his hush money conviction in response to the Supreme Court's ruling that presidents have some immunity from criminal charges. Trump's lawyer claims that some of the evidence used in the case shouldn't have been allowed under the new standards set by the SCOTUS decision. Manhattan's district attorney has until July 24th to respond to Trump's motion. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, the Morning Calls, plus we'll catch up with Bloomberg's Ed Ludlow, reporting that Tesla is postponing its highly anticipated robo-taxi unveiling. The man, the team behind that big move in the last 24 hours. Up next.
On the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
top names in global leadership are on Bloomberg.
I envisage not only some kind of a bridge towards membership or language linked to the irreversibility of Ukraine's membership in NATO, but also some kind of a broader package of military material, of financial aid. The more we support Ukraine right now, the sooner the war will end.
Nobody covers the top global leaders like Bloomberg Television and Radio.
DOJ or other authorities
could face bigger challenges. Britain's next.
It was going to keep Green World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Counting you down to the opening bell at 1 hour and 15 minutes away. Equity futures just about unchanged on the S&P 500. But as we've highlighted throughout this morning and through the whole of yesterday, the outperformance from the small caps, and it continues going into the weekend. Let's get you some morning calls with one stock very much in focus. It's Tesla. First up, Citi raising its price target to $274, keeping a neutral rating on the shares. The firm saying it's not inclined to chase the stock, even as it highlights a second quarter delivery beat. We're down again this morning. We're off by 2%. Your second call from Mizuho raising its price target on the EV maker to $230, also maintaining a neutral rating. The analyst Vijay Rakesh noting better than expected June vehicle deliveries, but says the company's focus on new markets with humanoid robots and robotaxis could be much more difficult to pursue. And finally, UBS downgrading Tesla to sell, but raising its price target to $197. The analyst citing concerns that shares have risen too much too soon on optimism over the company's AI plans, adding that any waning market enthusiasm for AI could impact Tesla's multiple. The stock in focus yesterday after this move, the stock was lower at the close by 8.4%, the biggest one-day drop going all the way back to the first month of 2024 off the back of this headline right here, that the company is planning to delay robotaxi unveiling to October from August. The man behind the story, Ed Ludlow, joins us now for more. Ed, it's great to catch up, sir. Thanks for waking up early for us on the West Coast. Just walk us through what you and the team have been learning about what's happening here.
Yeah, I mean, it's a delay of 2 months. You know, we were expecting a robo-taxi unveil on August 8th because Elon Musk had posted on X that it would be August 8th. And what sources told us is literally in the last 48 hours or so, teams within Tesla have been directed that the delay to October is because they need more time. They're just not ready. They want to have more to show at this big reveal, more prototypes. One source told me that literally on Wednesday, the design team was told by Elon Musk to kind of rethink the design of this purpose-built robotaxi. So the market reaction is super interesting. You have to give the context of the huge run-up that had happened or preceded it. But I think there's a lot of anxiety that actually, they've probably not made as much progress on a purpose-built robotaxi or Uber-like service as we'd thought.
So Ed, a couple of issues to work through here. Let's just sort of work backwards if we can and then work forwards. So this wasn't just about the carrot over the stock, the robotaxi business. They were also doing better on deliveries, better than we expected as well. Can we talk about the run-up into this news story that you and the team put out and what was behind it? Because we heard from some prominent investors, including Bill Gross, the founder of PIMCO, who said that Tesla had become some kind of meme stock, and this didn't make sense. It was divorced from fundamentals. What did you think of the rally before we get into the sell-off of yesterday?
Yeah, I mean, there's certainly a tension between a large body of sort of legacy Wall Street institutional investors who have to trade on fundamentals and consider long-term as well that Tesla's in the business of manufacturing and delivering electric vehicles to consumers, though that tension is against a large body of both retail and other institutional investors who say it's just going in the future to be a negligible part of the bigger pie, and that the rest of the pie will be software or selling a service. And the eagle-eyed of the audience who watched the Tesla AGM video, and this kind of ties together the last 24 hours, will have seen a very short video clip where a Tesla employee demos an app very similar to Uber's app, where they have a ride-hailing type service. And one interesting thing I'd note is don't just look at Tesla falling yesterday. Look at the two stocks that jumped, and they were Uber and Lyft, both up 5% in the session. And I think it's this idea that
JP Morgan's CFO says the economy seems to be on a trend for a soft landing.
On behalf of a ride-hailing community, and we're just not there yet.
There are a lot of institutional investors who also, though, are betting not on the fundamentals, but are betting on the idea of a brilliant and volatile founder who has big ideas. And Tesla is going to be the showcase for them. The reason why maybe your scoop, your story really hit hard is this idea that maybe this is a company over its skis with respect to what it's promising. Is that what you gathered from this delay, that they weren't able to accomplish the highfalutin goals that they had set out for that would distinguish them from just being a car company?
I actually have like a bit of relief that you've asked that.
At 8:30 a.m. Eastern Time, we get US PPI year-on-year forecast 2.3% on the prior 2.2% with a range of 2.4 to 2%. PPI month-over-month forecast 0.1% on the prior minus 0.2% with a range of 0.2% to minus 0.2%. Core PPI year-on-year forecast 2.5% on the prior 2.3% with a range of 2.6% to 2.2%. Core PPI month-over-month forecast 0.2% on the prior 0%, the range of 0.3 to 0%, and Canadian building permits month-over-month forecast minus 5.2% on the prior 20.5%.
This is a vision he owns. And his vision for the future of the company, which he codifies from time to time through a document he calls the master plan, has evolved. But this is the problem with investor relations at this company. It's all funneled through him and his personal use of his social media account. And so whether you're an institutional investor or a retail investor that has different rationale for wanting to hold the stock or own the stock, it's incredibly difficult because the information pipeline officially from the company just isn't there.
Well, thank you for doing what you do, and it is wonderful to get some insight on this. I'm wondering, as you were carefully reporting this out, did you get a sense of why there was this delay? Was it simply they didn't have the time frame to really test the technology and get it perfectly down pat? Or was it just that there were some fundamental issues that have plagued every company that has tried to come out with some sort of robo-taxi or an automated car and frankly faces off with different types of testing and regulations, but also just technical challenges?
Yeah, we've certainly had the sense that some staff at Tesla are a little bit caught off guard in the week of first quarter earnings earlier this year. You'll remember there was that original Reuters report that Tesla had scrapped a plan for a $25,000 EV consumer car to pivot to a robotaxi specifically. And what Dana and I did that week was kind of clarify the situation, that that it's more complicated than that. They're working on sort of engineering the cost down of their consumer cars while being focused on a robotaxi. Again, the two specifics we reported 24 hours ago or so were that they didn't have much to show, or they wanted more prototypes, more physical things to unveil in October. But also, Elon appears not to be happy with whatever it is that they currently had to show, because the design team's been asked to think again on what it looks like. And again, go back and if you're interested in Tesla, go and read the master plan documents on the website. The origin of this robotaxi plan was that you took a consumer car with all the bells and whistles to make it drive itself, and when your lease was over, you gave it back to Tesla, and that made up its fleet. And that evolved to you being able to opt in to an Airbnb-style platform, where if you're not using your car, you list it on Tesla's platform, and off it goes in the morning, drives itself to be a robotaxi. The purpose-built robotaxi is a more recent iteration of the plan. And what Tesla and Elon Musk outlined at the AGM is that it's going to be a combination of all three. And I'll just end by saying, as you guys know very well, Elon Musk often misses his own deadlines and the timelines that he's outlined, but he does often get there in the end. And I think that accounts for a lot of the confusion and panic we saw on social media in particular, but the severity of the decline in the stock in yesterday's session.
The stock is down again this morning by 2% at the pre-market. Ed, before you go, I think we all wanted to give you some space to talk about your column, Hyperdrive. Within that, you've talked about Rivian as well. You've outlined what's going on with Tesla. What is happening with Rivian?
Thank you, John. Well, I reported in a 4,000-word Business Week story yesterday about Rivian's latest plan. But there was a bit in it that I didn't want to be missed, which is, according to my sources, Rivian applied to the DOE for some loans made available through the Inflation Reduction Act. And the DOE said, sure, you can have the loans if you change your stance on unions in the state of Georgia. Rivian, just like Tesla, is not going to, welcome unions. They don't believe it's the right approach. But I think it's so interesting in this presidential election year, the DOE's function. It's been emboldened by Biden to and Biden last night spoke about his stance on unions and labor right very clearly. But what happens if Trump takes the presidency? Because remember, in his first term, the DOE was almost in that department, loans for EV programs, almost sort of thinned out, ground down to a very small group and entity. So, read the column, but I think there's an interesting situation here about what happens to the money made available in the through the Inflation Reduction Act, and how it's given out. Especially in the context of the news yesterday of more money from the Biden administration to retrofit or convert closed down.
At 8:30 a.m. Eastern Time, we get US PPI year-on-year forecast 2.3% on the prior 2.2%, with a range of 2.4% to 2%. PPI month-over-month forecast 0.1% on the prior -0.2%, with a range of 0.2% to -0.2%. Core PPI year-on-year forecast 2.5% on the prior 2.3%, with a range of 2.6% to 2.2%, and US core PPI month-over-month forecast 0.2% on the prior 0%, with a range of 0.3% to 0%, and Canadian building permits month-over-month forecast -5.2% on the prior 20.5%.
Just sort of waiting.
The bigger question is, why don't you have a driver's license?
I just think, maybe we're a few months away from the robotaxi and I won't need one.
Okay, so that's the reason why?
Yeah, and then I'll sign up.
It's a bet on the robotaxis?
It's the reason why.
Okay.
And I stand by my statement, okay? PPI's up next.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
For years, people told me, why are you invested in Apple? Everybody talks about Apple. I actually think that sometimes because someone speaks a lot about something, it might be actually a good sign.
1 minute remaining. I'll lead with US PPI year on year.
The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to
10 seconds.
Enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything.
2.6%, 2.6%, higher than forecast, 2.3%. PPI month over month, 0.2%, 0.2%, higher than forecast, 0.1%. Core PPI year on year, 3%, 3%, higher than forecast, 2.5%. Core PPI month over month, 0.4%, 0.4%, higher than forecast, 0.2%. Canadian building permits month over month, minus 12.2%, minus 12.2%, lower than forecast, minus 5.2%. Seeing some upside in the dollar, downside in stocks.
A little bit hotter than expected on PPI final demand month over month at 0.2%. The survey 0.1.
So PPI month over month, prior revised 0%, and core month over month, prior revised 0.3%.
Just a little bit hotter in those first two reads.
Especially when you strip out energy and food, as you were mentioning, we also have, of course, year over year. That means it's substantially higher when you take out food and energy year over year. PPI comes in at about 3% versus the estimate of 2.5%. This goes into the GDP print. This goes into some assumptions.
Treasury yields rise after June PPI rises more than expected.
More significantly. I am wondering, though, how much this sort of dampens the enthusiasm we got yesterday.
Can I tell you, I think the market reaction is more important than the economic data.
Agreed.
Or rather, more interesting, if I can put it that way. Look at the Russell. It was up by more than 1%, up just 0.5% now. Look at the bonds. Look at the 2-year front end of the curve. Treasuries yields are lower by a couple of basis points. Yields are higher by a single basis point. That's a turnaround, up by almost 2. 452.92. And we'll be asking a question, Lisa. Are we getting too carried away off the back of one set of economic data from yesterday?
The inflation beast hasn't necessarily been killed, and I think that that's what people are sort of reconciling. It won't be this easy path to a September rate cut by the Federal Reserve. Whether we see this stick will be interesting. I do wonder how leveraged this broadening out trade is to this idea of an imminent rate cut. And if we don't get that, how much of a reversal back to what we had previously. I also wonder, PPI is sort of an interesting measure because people previously didn't put that much energy on it. They think, okay,
we have posted the US PPI June report on the feed for all those interested.
Just a little bit. Anyway, on the margin, dollar yen back through 159, just briefly off the back of this as well. If you are just joining us then, a little upside surprise. We come in at 0.2% on PPI. Final demand month over month. The estimate in our survey was 0.1. Upward revision as well to the previous month. You're seeing that stripping out food and energy too. Coming in at 0.4%. The survey, Lisa, 0.2.
Yeah, and final demand. This is interesting. The revisions, again, are interesting. Revised to flat, basically, on the prior month versus the initially reported down 0.2%. The revisions have been inconvenient. I just want to note that and sit on that, whether it's jobs or whether it's inflation. Jobs picture looks worse when the data gets reflected. Inflation looks stickier when that data gets reflected, which just raises this question: how much are we banking on the soft landing Goldilocks scenario a bit more than otherwise assumed?
I think a lot of people banking on yesterday continuing. You could see it across the board on the south side yesterday. Andrew Hoddenhorst of Citi just put out a note. I'll share it with you in a moment. He said yesterday, call CPI cements upcoming cuts. JP Morgan's Mike Feroli brought forward their call for the first rate cut, I think from November to September, saying sticky inflation is coming unglued. Bank of America's Michael Gapin, more good data. The sequence of things for Andrew Hoddenhorst, that note just dropped from Citi. This is what they look for now. We expect a strong signal in July. The cuts
US Treasury 2-year yield gains 1.8 basis points to 4.525% after US data.
This is the call from Citi. This will also be the first in a series of steps to reduce policy rates.
And it is early days, but right now, based on Fed funds futures, you're looking at a 98% chance being priced in of a September rate cut. We'll see whether that gets readjusted. The point being, people seem to be coalescing around this, and this data that we just got seems to be a bit of a fly in the ointment.
To respond to the data we just got and the data we've had over the last few weeks, I'm really pleased to say that a good friend of ours on this program joins us now, Mohammed Al-Erin of Bloomberg Opinion and of Queen's College, Cambridge. Mohammed, wonderful to end the week with you, sir. Let's just work through this economic data we got this morning and the data yesterday as well. When you look at the totality of the data, what kind of conclusions are you drawing currently?
So I have two conclusions when you look at the totality of the data. One is based mostly on the CPI, which is that what we're seeing is demand destruction and a loss of pricing power. When Mike McKee commented on it yesterday, he said it's very broad-based, benign inflation numbers, and you're really starting to see the demand destruction and the loss of pricing power. And that's consistent with what we've heard from companies, and it will be consistent with what we will hear from companies next week and the week after. And it is also consistent with the macro data that's starting to weaken. So that's conclusion number one. Conclusion number two is on the cost side. We're living in a global economy that, despite China's deflationary impact, is not giving us the sort of deflation that we'd like on the PPI. The supply side simply isn't there to help what's happening on the demand destruction, which is going to force something that you don't like me talking about, but I will, that there'll be a lot more discussion as to what's the right inflation target, given the dual mandate. So I expect the Fed to focus much more going forward
on the US Treasury 2-year to 10-year curve, little changed after PPI data, last at minus 29.6 basis
You
points.
brought it up, so let's talk about it, and then we can talk about the labour market. Mohammed, the right inflation target. The question that the chairman's been asking for a while, and he talked about it in his testimony twice this week. It's their question. Are we on a sustainable path back to 2%? Do we need more confidence? And he said repeatedly, we need more confidence. If some officials start to say that they believe they are confident we're on a sustainable path back to 2%, not 2 point something, not 2.5, not around 3, but 2%, why would you caution them? How are you thinking about the world differently? Why do you think that's going to be so difficult?
So if they just say we're on the path to 2% and leave it wide open as to when we're going to get there, already the chair has said we won't get in there in 24, we probably won't get there in 25. If they leave it wide open, I'm fine with that. If, however, they feel that they need to deliver the 2% either this year or next year, I would worry as to all the undue losses to output. I would worry about the employment side as well. John, the only thing keeping segments of the household sector, the lower income one and the small business going, the only thing keeping those going is labor income. And if we lose labor income, we no longer have the balance sheet strength that we had
So the
before.
PBOC may mull using overnight repurchase rate as a target, according to news.
Mohammed, what you're saying is fascinating at a time where Steve Risciuto yesterday came on of Mizuho and said his fear is you are seeing companies lose pricing power, as we saw from Delta and Pepsi, at the same time that supply-side inflation is still present. His worry is that leads to margin compression now. If the Fed cuts rates, they'll be able to pass along those price increases to consumers. Inflation will go higher from here. Why is that a preferable outcome in your view?
So I listened to him, and the only question I asked myself is, what about the lags? What about the lags? It's not going to happen instantaneously. In fact, we still have the lagged effects of one of the most concentrating hiking cycles in history. So the lags right now are working the other way. So it doesn't work instantaneously. That's not how monetary policy works.
So when you talk about the labor market, and let's go there, because yesterday we got a good sign in terms of initial jobless claims and how much they actually came down below expectations. Why are you looking through that as an anomaly, a blip, rather than a sign of strength underpinning the economy?
So you said earlier, how much should we conclude from a data that's every month? How about every week? The data, the jobless claims data is inherently noisy. If you were to take a moving average of 3 months, 6 months, there is absolutely no doubt that you will see that that indicator is not as strong as it was before. Now, from week to week, it will differ enormously because it is noisy data.
At this point, when you talk about we should really be thinking about what the right inflation target is, what's the correct balance between inflation target and employment at a time where we're talking about something like 4.1% on unemployment, and you're talking about inflation of 2%?
Yeah, and it's this notion of undue damage to employment and to the economy. There's also a very important distributional effect here. So it's pretty easy now because the Fed told us that they expect unemployment at 4%. We are above that number in June, and we're likely to go even higher than 4.1%. So already that part of the mandate is flashing yellow. Meanwhile, the other part of the mandate, even though the chair didn't call it as such this week, but did call it last week, the disinflationary trend is continuing. The big question is disinflationary trend to where and at what time? I think the Fed will keep this wide open. They'll keep on saying 2% is our target. We'll get there when we get there. They're not going to sort of be very precise as to when they're going to get there. And they're going to wait and see how the economy accommodates. And that's the way of doing a slightly higher inflation targeting without calling it that.
If you are just joining us, welcome to the programme. Lucky to have with us Mohammed Al-Arian. Moments after we got PPI data, I want to go through some of that data for you, coming in a little bit hotter than expected. Going into that print, the Russell of small caps was up again by something like 1%, faded off the back of it, then started to climb again. We're positive again by 0.75%. If you switch up the board and turn to the bond market, going into the number, yields were lower at the front end by a couple of basis points. We've erased some of that move. We're just about unchanged now in the session at about 450.82. Not major moves, Mohammed, but they're the moves of the last 10 minutes or so. You said something interesting, many things in fact, but I want to pinpoint just one. And you said the labour market was starting to flash yellow. When you hear from the Fed chair, he describes the labour market as being strong and a reason to get this right. You've said before that this Fed should be thinking about moving in July, not waiting until September. What is a couple of months between friends? Why do you think it is important to start getting going and getting moving earlier and sooner rather than later?
If I was as certain as the market is that he was going to move in September, I will tell you that a couple of months, there wasn't much in it. However, you have two factors that may complicate a September cut for this Fed. I want to stress for this Fed. One is they may get one bad data point. And then because they're so overly data dependent and they're not looking forward enough, that could postpone the first cut to November. And then you're starting to talk about a longer lag. The second issue is the politics, John, is what does the politics look like when we get to September? And how worried are they that there's going to be an inflationary shock coming after the elections due to policies? So it's not as simple as saying, well, the market thinks it's over 80% probability it's going to happen, because this Fed is very impacted by high frequency indicators.
Let's flip this on its head, because a number of guests have come on the show and said that the big fear for the Fed and the worst case outcome would be if they had to reverse course and hike rates again at some point in response to an inflationary shock. Do you think that that isn't that big of a risk, or it wouldn't be that problematic if they had to reverse course, say next year, after starting cutting either in July or September?
So I do agree it's their biggest fear. They don't want to be in any way
resemble to the 1970s, and it is a huge fear. And they've already made two mistakes in the last 3 years. First, a transitory call that was horribly wrong, and then secondly, at the end of last quarter, they got too excited about what was happening on the inflation numbers, and they had to reverse their view. And we saw the amount of pivots. I've never seen so many pivots in forward guidance. The whole point of forward guidance is to provide smooth market adjustments. Instead, we've had this enormous number of pivots in the signals from the Fed. So I understand that hesitation, and I agree that this will be in the back of their mind. If they do have to hike next year, I think it's a low probability, but if they do have to hike, it is because something has happened, either externally, we've had a major shock somewhere, or the policies elsewhere, fiscal, trade, have fundamentally changed. And I think people will understand that, and they won't blame the Fed. They'll see that there's something else that has happened elsewhere. No one blamed the Bank of England when it had to respond to the Liz Truss moment. I don't want to say the US is going to have a Liz Truss moment. It will not. But people understand the credibility of an institution when the shock to inflation is coming from outside.
Mohammed, final question. Do you have more confidence, more faith in Chairman Powell's Federal Reserve or Gareth Southgate's England team?
Well, that's a really, really tough question, John. And I think, at every interview, you get very close to the line, as Paul McCulley used to say, that separates courage from stupidity. I think I'm going to stay on the right side of that line.
Mohammed, it's good to catch up. It's a lot loaded in that response. Mohammed Al-Arian there, the brilliant Mohammed Al-Arian from Queen's College, Cambridge. A lot to say there, but particularly on the Federal Reserve, this idea that if they go in September, great. This is Mohammed's view. If they go in September, great, but don't take it for granted that they're going to go in September. Things could change. And he said this a few times. He's characterized this Federal Reserve as being hypersensitive to incoming information. And it might take only one data point to put them off hiking.
If you think well, I mean, if you think about the rhetoric that we've heard, the idea from Austin Goolsbee, this was it. This was what we needed to be confident. And then you get PPI, and there's this idea that the inflation beast, at least on the supply side, isn't killed. If they do wait till September, does politics start to bleed in just a bit?
Long week, I'm confusing hikes with cuts. Forgive me. This line just came in from Chris Harvey of Wells Fargo. Here's a quote for you. Given the price action we've seen over the last day or so, we believe the great rotation needs lower rates and earnings optimism. CPI delivered the lower rates. Earnings concerns linger after Delta. This was your point.
Well, this to me might be the bigger takeaway. The data is noisy. Earnings are less so if you have some sort of overarching real consensus. We have seen those concerns about not being able to price along pricing. There's now also concerns about credit quality among the financial institutions. That might speak louder, to me anyway, than anything else.
It's been quite a week, hasn't it? Let's get you an update on stories elsewhere this morning. Quite a morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. At least 3 new Democratic lawmakers are now calling on President Biden to step aside after his news conference last night, where Biden made 2 major gaffes in about 2 hours. First, referring to Ukrainian President Zelensky as Putin, and then calling his Vice President Trump rather than Harris. The president now prepares for an interview on Monday with NBC's Lester Holt. And more trouble for Boeing, warning some 737 MAX customers that deliveries could be further delayed in 2025 and 26. Sources tell us that the plane maker said timelines may slip by 3 to 6 months on top of already late handovers. A Boeing spokeswoman declined to comment, noting that the company is in a quiet period ahead of its July 31st earnings release. AT&T suffered a massive hack of customer data. It was one of the biggest breaches of private communications data in recent memory. The hack included records of calls and texts for nearly all of its mobile phone users for a 6-month period in 2022. The company said in a regulatory filing that the breach also included records from customers of wireless service providers that use AT&T's network between May 1st and October 31st of 2022. And that is your brief. John.
Danny, thank you. Thanks for this morning. We'll catch up on Monday. Up next on the program, setting you up for the day ahead. You're watching Bloomberg Surveillance.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Counting you down to the opening bell, here's the lineup for next week. What a lineup we've got. On Monday, the Republican National Convention begins. We'll also get Fed speak from Chairman Powell himself. At 9 p.m. Eastern Time, NBC anchor Lester Holt will interview President Biden. That's must-watch TV. Tuesday, we'll get retail sales and a ton more Fed speak, including on Wednesday. We'll hear from Barkin and Waller, plus the Fed's Beigebook. On Thursday, another round of jobless claims, and we round out the week on Friday with more Fed speak from Williams and Bostic. Joining us now to wrap up the week and look ahead to next week is Ashok Bhatia of Neuberger Berman. Ashok, wonderful to catch up with you, sir. I just want to understand from your perspective, is this a week where you put more weight on the data, which was good, or the earnings, which haven't been great?
I think for the bond market, it is a little bit of a combination, but more the data. I mean, I think you take a quick step back after, strong first half of the year with, good payrolls and higher inflation rates. June and July have really brought deterioration in the job market and now a couple of soft inflation prints. And we think that's going to be the trend for the next few months. So from now until that September meeting, our estimate is we'll see continued softness in inflation and a little bit continued deterioration in the jobs market, and that leads to the Fed easing in September. I think the point you make is, though, there is softness in earnings. We've heard from some of the airlines, the consumer goods companies, and there's a lot of idiosyncratic things or stuff going on, but there is a bit of a theme that the consumer seems to be pulling back, and our expectation is that'll be a continuing trend as well the next couple of months.
Which really tees up the question about the labour market. You're expecting some further softening. Can you help me understand what that's going to look like? I think yesterday, really people were empowered by this idea, not just that CPI was a bit softer than expected, it was that jobless claims dropped back as well. And they were empowered to go and buy other things like small caps, and you saw the price action, Ashok, yesterday. What is the kind of softening that you're expecting? Is it unemployment going from 4.1 to 4.5? Is it something worse than that? What is it?
Well, I think there's two things. I mean, the unemployment rate, right, has already been rising. So, we get another, 20, 30 basis points rise in the unemployment rate from here. That'll be about 100 basis points off the lows. So kind of, maybe not lost, but certainly underlying a lot of the job market data has been this gradual rise in the unemployment rate. But I think the biggest concern that we have about the job market is just the continued narrowing of where job gains are coming from. The last year and a half, right, we've seen layoffs and job deterioration in technology, finance, real estate. Really now, like you look at the private sector jobs markets, 60-odd% of the jobs that have been created this year have been in two sectors, education services and healthcare. The last job print, that's continuing to narrow to primarily healthcare. And typically what you'll see in a labor market is at the late cycle, you see a narrowing of job gains. Those sectors then, reduce or stop hiring, and that leads to weakness in broad payrolls. And that's broadly what we're expecting. But, short answer to your question is the narrowing of job gains is our biggest concern there.
Especially at a time where we're seeing a number of companies talk about credit concerns and the loss of ability for consumers to keep spending and to keep on paying back their bills. How much do you think that has or has not been reflected in credit markets in particular?
Well, it's a really tricky one because, credit spreads, as we all know, like they're pretty low, pretty tight. High yield is just spending a lot of time around 300 basis points at the index level. And, IG spreads, remain sub 100. And these aren't the all-time lows, but they're closer to that than something else. And I think, the tricky part of this is that company balance sheets are generally in good shape. So they are in a position to weather moderate deterioration in the economy. You get into something more significant, that can be more of a fundamental risk for credit. But, the environment we see is that of how the macro will develop is that the impact will be more in the rates market and the central banks and the Fed and ECB, rather than something that's the deterioration is going to really show up in the credit markets. So credit's more about just dealing with these tight valuations rather than, there's a big fundamental story brewing in our view.
Interesting framing. Ashok, always love catching up with you. Learn something every time. Ashok Bhatia there of Neuberger Berman on this fixed income market. We've got to wrap up the week and look ahead to next week. Bramo, let's get over to Anne-Marie down in Washington, D.C. The Republican National Convention coming up next week. Another key interview as well, Anne-Marie, for the President of the United States on Monday.
That's right. He'll be sitting down with Lester Holt of NBC Monday in Austin, Texas. Today, he's going to be in Detroit, Michigan. He wants to make sure that he can sell his campaign to not just the American people, but the Democratic Party. 17 Democratic lawmakers have now come out and said he needs to step aside as the nominee. Politico put it this morning, really fantastic, saying Dems are living in purgatory now. Yesterday, didn't do enough to assuage their concerns about President Biden, that performance, the fact that these gaffes completely overshadowed the policy and the substance and what we should have been talking about. Your point, Jonathan, earlier was right on target. There are two hot wars happening in the United States, and yet everyone in the room was wondering about President Biden's bedtime. They're worried about his health. Can he do this another 3-4 years? Can he go sit across the table of autocrats like Xi Jinping, Vladimir Putin? But yesterday, was it so bad the game is over for him? No. So he's still fighting his political life. So next week is going to be entirely focused on Biden, maybe potentially until we get to the RNC and we find out from President Trump, former president, who his VP pick is.
Elisa, this is the presidency. This is not just about the campaign. This is about serving as the President of the United States. This ridiculous game about whether we can get through an interview or a news conference, when are we going to stop playing this?
Well, a lot of people have been treating this like a, reality TV show for quite a while, and that's the reason why a lot of investors who sit around here say we look at the earnings of the companies because that's a little bit more reliable than some of the reality TV shows.
Perfect time to take a break. Guess who's taking a break next week?
I'm off.
Lisa's taking a week off. Bramo, enjoy yourself. Next week, here's the lineup. Monday, Steve Cheverone of Federated. We'll catch up with Matthew Bartlett of Derby Field Advisors, Jim Kerrin of Morgan Stanley, Stephanie Roth of Wolf Research. Have a wonderful weekend.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players. 3,184 hits, 431 home runs, and of course the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. How are you doing this?
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
There's only one word, winning. You win on the court, you win.
Effective Fed funds rate 5.33% July 11th, unchanged from July the 10th.
Friday, the end of a long week. We have 30 minutes to go until the start of trading. I'm Matt Miller.
I'm Shanali Bassick.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Bank earnings, they're rolling in. JP Morgan posts record profits. Citigroup beats on equities trading, and Wells Fargo warns cost-cutting efforts have started to slow.
We get a fresh read on inflation, or got one a half hour ago. U.S. producer prices climbed slightly more than forecast in June. Up next, we're going to get consumer sentiment data from the University of Michigan.
And a defiant Biden strikes again, with the president vowing to stay in the 2024 race despite a series of high-profile missteps. Let's take a look at where markets are trading. About 30 minutes to go until that bell rings. You can see the S&P 500. We're up slightly after that big wipeout we saw yesterday. Currently up about 0.1% in the pre-market. The NASDAQ 100 pretty much unchanged, but of course the color is green, and the bond market even has calmed down a little bit. We're pretty much flat right now, even though we got that slightly hotter than expected PPI, but that's following a big rally yesterday, Matt.
We have had a series of bulls on today already. Yardeni and Stoltzfus. Now we get Julian Emanuel in a second. He has a target of 6,000 for the S&P. That's here in white. Meanwhile, Ed Hyman at ISI says the economy is slowing. And you can see the surprise index in blue just continues to disappoint. That's what we're going to focus on this morning.
And Matt, if you were looking for the big banks to really drive that S&P 500 higher, you are looking at mixed results. JP Morgan Chase really down 0.6% pre-market. Citigroup on a tear, though, 2.2% higher. Wells Fargo now down almost 6% before the market opened.
All right, so it is Shanali's Super Bowl today. We're going to focus in, of course, on the bank stocks throughout the next couple of hours. And wow, JP Morgan really delivered, knocking the cover off the ball. They did so well that Jamie Dimon said, I don't even need to be on the earnings call.
I'm going to Germany. Don't worry about me. Yeah, you're not necessarily seeing that rewarded in the pre-market action, but you are seeing Wells Fargo punished in a big way. I mean, down nearly 6% just on that net interest income mix.
Yeah, that, and then also that provision for credit losses really at many of the banks, barring Citigroup here, starting to show some signs of trouble, some concerns at least around credit quality, and that's feeding through sentiment.
All right, Julian Emanuel, as I said, is joining us this morning. He is, of course, the chief equity and derivatives strategist and quant strategist at Evercore ISI, the most bullish name on the street of the big names. I mean, a target of 6,000, Julian. And we're so happy you joined us in our inaugural week of this show. We want to tell the story of the macro through the micro. Can you do that with Shinali's banks this morning? Can you look at Wells Fargo, at JP Morgan, at Citi, and tell the story of this economy?
Well, you can if you actually look. So they're basically telling you, on a broad sense, that business is still good, okay? Yeah, we're worried about net interest margins and so on, but the flip side of that is we still haven't had a capital market cycle. So we've got that to look forward to. That's the backdrop. But when you look at it, it is the story of what we've seen for several quarters in a row in terms of earnings. One stock's going one way, the other stock's going the other way, and net, this really reinforces, even though the massive stocks continue to move higher, and we think they do continue to move higher, that it is much more a market of stocks rather than a stock market.
But the funny thing here, coming from an investment banking correspondent, I think this is a funny thing to say, Wall Street isn't enough for me. If these Main Street businesses aren't really driving forward, if consumers are perhaps maxed out on credit cards, how much steam is there left in a consumer that is still feeling the pinch of higher rates?
So I think what you're seeing, again, is trade down in various areas. But in the final analysis, we think that there's plenty of liquidity out there. We also think, look, yesterday's number, it's no coincidence that yesterday's CPI sort of calmed the bond market, and today's PPI, the bond market is trying to sort of digest that in another way, because what we know is that the Fed is there, and it's not necessarily that the Fed put is going to be exercised, but the market feels good, and I think consumers are going to start to feel better about the fact that whether it's inflation moderating or the fact that policy is going to do what it needs to do in response to the incoming data.
I want to talk a little bit about the market action that we saw yesterday, because I think that yesterday was a pretty important day. It was kind of staggering to see the S&P 500 down almost 1%. You take a look at the equal weight index up by more than 1%. I really feel like we learned why concentration cuts on the other side. Is this the start of the great rotation? Do you have any confidence in calling that?
We do. Okay, but from that perspective, though, this isn't a, sell the Mag 7. We think that's one of these things that, you've had such enormous gains in those stocks that a period of digestion is normal. It's actually healthy. It doesn't necessarily need to drag the broad market down, which is what we saw yesterday, which is what we're seeing on the screen this morning. And for us, again, when you think about the long-term prospects of the market in general, you want to see small caps start to participate. Again, to your point a moment ago, Shinali, is like that is more of a ratifying the broader health of Main Street America.
Well, to your point on small caps, the Russell 2000 up, 3.6% yesterday. They were definitely participating in a big way. You did get a note of caution from Wells Fargo this morning, Chris Harvey writing that we believe the great rotation needs lower rates and earnings optimism. Maybe we have the lower rates coming, but when it comes to earnings optimism, are you going to see that broadening out just in the fundamentals of those smaller companies, or do we have to wait a little bit?
So that may take another quarter or two to develop when there's a greater sense of confidence that we are, a recession, perhaps will get pushed off in time or, furthering the soft landing thesis. But when you think about the small caps and you think about sort of that progression, they're trading at such a compelling relative discount to the S&P 500 that, this is the time for us where you need to start rotating there, and then the earnings come after the move has started.
My buddy Joe Brusuelis writing into the show and says, maybe we get more talk about the possibility of a cut in July. Is that, you just mentioned a Fed put isn't coming necessarily, but could we see it in July already?
It's not likely. Okay, the data hasn't deteriorated. The labor market data hasn't really deteriorated enough. It's one of those ones, again, the Fed doesn't need to. They have the luxury of waiting. And of course, this morning's data certainly is sort of a little bit of a sidetrack on that story. But in general, we do think they're on track for September.
To take the flip side here, when you look at the PPI data this morning, just a little bit of uncertainty, at least a choppy path to September here. What if we don't see that rate cut in September? What would that mean for equities?
Well, so here's the interesting thing. Remember, the story of this year is we started the year off pricing 6.5 cuts this year, and now we're pricing 2, and stocks have just rallied the entire time. It's much less about when the cuts are coming and how they're delivered, and much more about the confidence that the Fed is going to do the right thing. It's ready if the economy starts to turn down, which it has not. The labor market is softening very gradually here. And on the flip side, it's okay. The market is confident that the Fed will be patient if the inflation data unexpectedly starts to...
Do you think the economy isn't turning down? I mean, I was looking at Fastenal earnings this morning, 51 cents on 1.9 billion in revenue. The same quarter last year, 52 cents on 1.9 billion in revenue. And this is a company that, they supply everything to the industrial manufacturing base. The economy looks like it's slowing.
So I guess maybe it's no coincidence, or maybe it's a happy coincidence that we're underweight industrials on the theory that the economy is slowing. But there is definitely a material difference between slowing and negative GDP.
Right.
And we just, to us, where the consternation would set in is if you really see the labor market start to crack. And you look at yesterday's weekly claims, we're not there yet.
All right, we're going to take a break, but you're going to stick with us. I want to ask you about, your call specifically, 6,000, and the choppiness that requires maybe valuation convexity. Do you like that?
That was good. That was very Tom Keene of you.
Yeah, let's get a look at some of the stocks moving before the opening bell. Besides the banks, here's Jess Metten. Jess?
Well, Matt, I'm taking a look at Tesla because it did snap an 11-day winning streak yesterday. If you look at this, though, UBS actually cut its rating on the stock to sell this morning. So if you're looking at that, they feel like the stock was rallying too fast, too far, too fast, basically over that 11-day session. So that stock was down about 20% the first 6 months of the year. It was the worst actually point decliner in the S&P 500 at the beginning in the first half of this year. But of course, in that 11-day session span, it actually had gained about 44%. So you're seeing that moving there too. A little bit lower if you're looking in pre-market trading. But another one I'm looking at is Carvana. So obviously we know this stock can be quite volatile, edging a bit higher here though in pre-market trading. And really what's happening here though is that BTIG actually initiated coverage on this stock with a buy rating with a 155 price target. Actually closed yesterday around 130 there. So even though it's trading at a high premium, if you're looking at BTIG, they still think it's equally positioned against some of its competitors here. And of course, if you're looking at what's happening, it almost went out of business in 2022. But if you look over the last 18 months after it reached a deal with some of its bondholders, it's actually risen about 2,700%. So it's been quite a ride there. But if you are looking at what's happening with some of its over the last 2 weeks with high yield bonds, there's some issues there. So that's something to keep an eye on. And then lastly, Array Technologies, that stock's up actually more than 8% in pre-market trading here ahead of the opening bell. So Citi actually raised the stock to buy from neutral and is actually touting its growth potential. It lost about more than a third of its value so far this year, and there's been a lot of different issues. It had a CFO actually announce that it was going to leave recently. It also has some issues when it comes to project delays, but when you're looking at, especially with Citi, they feel like a lot of that pain, especially with compared to its competitors, is already passed, and especially the margin pain that it's had. But that is another stock to watch ahead of the opening bell, guys.
All right, a lot going on there. Carvana, up 265% in the last 12 months. We got to get Ernie Garcia on this program. Coming up in the next hour, Liz Ann Saunders, Charles Schwab Chief Investment Strategist, joins us. She says mega cap performance bias masks underlying
The Japanese yen extends gains against the US dollar, last at 157.93.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal. The deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
So the Bank of America, citing EPFR data, says the US large cap stocks see $3.3 billion of inflows, 12-week of inflows, and tech inflows $1.9 billion. Investment-grade bonds see inflows of $5.2 billion. This is a 37th week of inflows.
Earnings season is here.
We're skating into another earnings season.
The expectation for earnings going forward are quite high.
Bloomberg is first to break the numbers.
Adobe earnings crossing earnings out of Broadcom.
JP Morgan, we get Citigroup, we get Wells Fargo.
There is something for everybody.
With the smartest insights.
Now banks have earnings power.
There's a resilience in the bigger cap companies.
We're not talking about a collapse in earnings for technology.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Let's get to high interest. A look at what's making headlines around the world. Growing bets for Fed rate cuts probably gave Japan an opening to step into currency markets for a third time this year and prop up the yen. That's according to a Bloomberg analysis of central bank accounts. The scale of intervention was probably around 3.5 trillion yen based on a comparison of Bank of Japan accounts and money broker forecasts. The exit of Wall Street's last bear, Marko Kolanovic at JP Morgan, reminds many of a similar departure before the dot-com bubble burst. Now, if they're wondering if the whole saga is a sign of the market peaking, the fear is history is about to repeat itself, as the erasure of cynics is something that typically happens toward the end of market manias. President Biden downplaying concerns about his presidential campaign, but a series of high-profile gaffes during the NATO summit yesterday renewed concerns about his age and acuity threatening his presidential status.
I'm determined on running, but I think it's important that I allay fears by let them see me out there. Let me see them out. You know, for the longest time it was, you know, Biden's not prepared to sit with us unscripted. Biden's not prepared to, anyway.
And Julian Emanuel of Evercore ISI still with us. And Julian, I guess we'll start there, and it's political risk. And I'm not going to ask you Biden versus Trump, but if you were going to invest on themes that come out of the election, when is the time to put on that trade? Some have suggested August, for example, but how are you thinking about it?
This cycle is very different, okay, because the volatility around, the candidates, the news cycle, the conventions, all of that make this really, really unique. Look, the fact is a lot of what we would call, quote unquote, the Trump-related themes have worked in recent weeks, and it's not a coincidence, as if you look at the polling and predicted and so on, the probability of his winning has risen. But there's also this thing that, you tend to get sort of a peak in enthusiasm and interest once the convention is over. So I think it's one of those things that we're probably better off picking stocks, identifying things that we think are going to work under either administration, And if you want to be tactical, there is a potential for that.
There's no themes? There's no Trump 2.0 themes that you can invest in? I mean, with big tariffs, with probably, I guess, the completion of the wall, with Mexico footing the bill this time. Isn't there anything you can do that you can pull out of that makes for a good 4-year investment?
Look, there are, and frankly, you talk to our energy analysts, and obviously it's pretty clear that energy is likely, traditional energy is likely to do better under a Trump administration. But a lot of it isn't quite as clear. Conversely, you talk to our semis analysts, and frankly, politics may not play all that big a role, even though you would think intuitively, based on our relationship in China, that it would.
It's really interesting to see the divergence in how investors are really baking this possibility. Yesterday, we spoke to Steve Eisman over at Neuberger Berman. Let's take a quick listen about how he really weighed the benefits of trades versus investing in this environment.
100% certainty Donald Trump wins.
Interesting.
Really?
100%
Is that
certainty.
investable, though? What do you do?
Well, let's talk about why.
Yes.
So forget about, whether Biden's going to run. It doesn't matter at this point, to me, whether Biden drops out or does not drop out.
So he went on to talk about how the banks, for example, would be a trade. Do you agree with that?
I'm going to step back for a moment, and the concept, particularly when we look at the markets of the last 4 or 5 years, the concept of something being 100% certain is very frightening.
We
to
did
us.
question him repeatedly about that.
As you got my title, we have derivatives in our title, we have quant in our title, and then basically, that tells you that 100% certainty is not something that markets typically tend to deal with. Again, there's been an enormous amount of noise in and around this, and let's face it, it's not even Labor Day. The amount of noise is going to get bigger. We were all glued to our TVs last night. We will continue to be glued to how this evolves. So to us, again, what it likely is that you get these times where emotion takes over, and that's where you get dislocations, and that's actually, part of the recipe for, in a market that's in general very highly valued, you're still able to buy things low. And that's the kind of thing we're trying to do.
Well, speaking of 100% certainty and high conviction, let's talk about the state of forecasting. Obviously, your 6,000 call made a lot of waves, but it was interesting to see, for example, you had Michael Kantrowitz of Piper Sandler backing away from the practice of S&P 500 forecasting. And I'm just wondering how you're thinking about the state of your industry. Do you foresee more people, and perhaps yourself included, backing away from that practice?
We're not going to back away from a price target. It's just, it is, whether it's, a strict discipline or what it is, but it is one of the things that frames the ability to talk about markets in general, again, against the backdrop of there is no such thing as 100% certainty. Everyone knows that, it involves a range of outcomes, a particular path on the road, and frankly, for us, as you know, we revised our price target up drastically several weeks ago when we came to the conclusion that looking at the past, expensive markets, and this is an expensive market, tend to actually go on for longer and run further. So it's an uncomfortable reality, but again, it's our conviction.
Bull markets last about 5 years on average, right? And we're only 19 months into this one. We're up 50%, and typically bull markets would double that. I want to ask about buying low, because you said you still can. And you have this concept of valuation convexity for people who don't trade in options. Explain that to us, because you can definitely buy high in this market.
Yeah, no. So when you look at the quant factors, one of the sort of the head scratchers about the first 6 months of the year is that for the most part, valuation, as in buying lower PE stocks versus sort of using higher PE stocks as a source of funds, has not worked. And if you think about it,
but wait, so you sell like a Tesla, and then you buy something that's
the home
like
builders,
a Toll Brothers.
the home builders, for example, are and think about what we've seen in the last few days is the market is validating this idea where interest rates may not fall, but they're clearly capped to the upside. That's good for something like a home builder.
All right, Julian,
So the Japanese yen hits a one-month low
Hope to
versus...
see you again soon. Our thanks, of course, to Julian Emmanuel of Evercore
Next time we need to have him on for the hour.
I agree. At least half
there's a lot
an
to talk about.
That's for sure. But anyway, coming up in the next hour, we'll be speaking with famous short seller Carson Block, the CEO of Muddy Waters. But up next, we're going to take a look at the companies making the most social buzz today in our Social Climber segment. This is Bloomberg.
So the US dollar hits a one-month low versus the yen at 157.3.
Good morning from our world headquarters in New York. I'm Menace Crenny.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
All right, it's time now for Social Climbers, the companies making the most waves on social media this morning. And first up, Bally's playing a winning hand today. The casino entertainment chain announcing a $2 billion deal with gaming and leisure properties for a permanent casino in Chicago. It's also unveiling a hotel redesign pending approval from the city. Next up, Ozempic may cut the risk of dementia by half, according to a new University of Oxford study. It's the latest in a series of trials designed to show the potential benefits beyond diabetes control and weight loss for GLP-1 drugs. Scientists are also studying whether the medicine can help treat alcoholism by reducing the urge to drink. And finally, AT&T says that hackers stole data from nearly all of its wireless customers. While there's still a lot of unknowns about the breach, it has the potential, if the data is released, to be devastating for some customers, including anyone who doesn't want others knowing who they are calling, such as politicians, executives, journalists, and their sources. Of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal, Matt.
That's great news about Ozempic.
Great news about Ozempic.
Because I'm worried about, I feel like I'm a prime candidate for dementia. So
I don't know.
You know.
I think you need to give yourself more credit here. We're okay, Matt.
I am 50 years old. All right, coming up, more analysis on big bank earnings. We're going to talk to Chris Marinak, Janney Montgomery Scott, Director of Research. And don't forget, Carson Block is coming up. I've been looking forward to this for weeks. We're going to talk to the CIO and founder of Muddy Waters, find out what he's shorting today. This is Bloomberg.
decided to acquire Indeed 12 years ago when I was 36. I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big American company. But I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the praise to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right.
So whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
So looking at the market on open imbalance, S&P 500, 250 million to the buy side, NASDAQ 100, 10 million to the sell side, Dow 30, 50 million to the buy side, and the Mag 7, 7 million to the sell side.
The bell. Look, the 99ers ringing it down at the New York Stock Exchange. These are members of the 1999 women's Olympic soccer team, U.S. soccer team, and that was really the beginning of this huge craze for women's soccer and really popularity in women's athletics. There you see the NASDAQ now above food, ringing the bell down there. And in terms of stocks today, it's been really a wild week. We had some CPI data that should have made the markets happy yesterday, but we came down. Even Tesla, Katie, ended its winning streak yesterday. What are we going to see today?
Well, it's made some parts of the market happy. Of course, the small caps, not so much. If you take a look at the big benchmarks, the S&P 500 down almost 1% yesterday, but so far into today's action, you can see actually a little bit higher, rebounding from those losses, up about 0.1%. The Dow leading the way so far, up about 0.2%. The NASDAQ 100, big tech, like you were talking about, took a bath yesterday, but so far up about 0.1%. We'll see if those gains can hold. But one stock to keep an eye on, as you mentioned, Tesla. It's lower today after postponing its planned robo-taxi unveiling to October, and as such, snapping an 11-day winning streak for the EV maker.
All right, I'm looking at telephone. AT&T suffered a massive hack of customer data, separate from the one they reported earlier this year. The hackers got all of the mobile phone calling data and texting data from, it looks like all of AT&T's customers. So it's one of the biggest breaches of private communications in recent history, and as a result, that stock is lower. Shonali?
And of course, I'm also keeping an eye on bank stocks. It was a very busy morning and a very mixed morning at that. JP Morgan Chase, despite posting record profit, Matt, you're now seeing it down almost 2% on the day. Wells Fargo down about 7% on the day. Citigroup, which has been flirting between gains and losses, now relatively unchanged, marginally down on the day, quickening those losses actually, down as much as 0.2%. Listen, what exactly is happening here? Let's flip up the board, because even though you had that record profit at JP Morgan, you did see provisions for loan losses at the highest level here since 2020, and you are seeing them rise exponentially or periodically as well. If we also take a look here at other metrics that we're looking at the banks underneath the surface, by the numbers, there has been this notion that Wall Street would save Main Street, that those Wall Street businesses, trading, investment banking, the rebound would really offset a lot of the hurt you're feeling in the consumer. But what you're seeing here is net interest income at JP Morgan alone is roughly 10 times what they bring in investment investment banking fees. That net interest income, of course, is tied to both corporations and consumers, but it is certainly meaningful, that number. And remember, across the street, there's a little more concern here about what is expected in those net interest income numbers more broadly. Remember, Wells Fargo missed on that estimate. Pulling up the board one more time here, looking at the banks that are reporting next week, you are also seeing some weakness here in Bank of America. Shares down 0.6% to start the morning. Goldman flat. Morgan Stanley up by about 0.6%. I'll tell you the reason why really quickly. Goldman Sachs more heavily weighted here to fixed income. Very big in that business. It's where we saw a little bit of weakness relative to expectations for both Citigroup and JP Morgan. Also Morgan Stanley more heavily weighted in equities here. Both of these banks will set up for a stiff equities trading competition next week, guys. Can't wait to talk to you about it.
Well, let's keep the conversation going now with Chris Marinac. He is Janney Montgomery Scott, Director of Research. And let's start with the biggest of the big, at least when it comes to the U.S. JP Morgan. Shares falling from the bell. It seems like that record profit isn't necessarily being reflected by what we're seeing in the stock action so far.
I think that's right. We had a big day yesterday in the bank stocks, so I think you're giving some of that back. We've had a couple of good days in a row this week, so that's to be expected. I think as we transition into next week with the rest of the with the regional and national banks, I think we're still going to see reasonably good results. These companies are raising a fair amount of equity each quarter with retained earnings, and tangible book growth was really strong at JPM this quarter. Also positive at Citi and Wells. So we really like what we see overall. I think the points made earlier about higher provision is correct. Charge-offs are going to rise. I think the credit cycle is evolving. There are commercial risks that banks have to provide for, and so I think we're going to see more of that continue to play out.
You know, I was just reading through JP Morgan and thinking, what great news for the bankers, right? Investment bankers, trading, doing so well. For the women and men sitting behind their screens this morning, Chris, how strong is Wall Street job security?
Oh, I think it ebbs and flows each quarter. I think it really depends on how these markets behave with a lot of the sort of national and international news that will continue to unfold. I expect we're going to see a back and forth market as the rest of this quarter in Q3 and year play out. It could be a very wild ride. Now, volatility historically is good for business and revenues, so that's not necessarily a bad thing, but I certainly think it's not going to be a one-way street for certain.
Chris, I want to talk about expenses here because it matters for the banks. It also matters for everybody else who's running a business. And if you look at how much patience investors have for anything that looks a little undisciplined when it comes to expenses, even if it's just regulatory costs here, how much of this is an issue here?
So expenses tend to be rising 0 to 1% for the biggest banks in the country. It's a little higher for your mid-cap and community banks, but overall expense discipline gets really good in the second and third quarter because your first quarter annual items for expense increases on Social Security and compensation, that's largely behind you. I think you're going to find that the FDIC special assessments go away, and I think you're going to find that the inflation impact on banks is going to get limited from here. So I actually feel pretty comfortable with expenses. They're not necessarily going to be zero, but I think they'll be modest on the growth rate.
And it's interesting, we're focusing so much on Main Street businesses here, even though Wall Street is showing some love. How about those Main Street businesses? How much juice, Chris, is there left in the consumer to max out their credit cards? This is all about these credit card businesses.
Well, sure. I think the juice is limited. I think most of the consumers have seen the big increase of their spending. I think the question is sort of keeping it flat and not having it be a downside or a downtrend. At some point, the economy will roll over and slow, and that'll be a problem. I don't see it in the immediate future, but I think in terms of pushing further on lines of credit, I don't expect that to be a tailwind by any means for these companies.
Chris, I got to get your thoughts on Wells Fargo because the stock is currently down more than 7%, the worst day since March 2023. You think back to what was happening in March 2023, and needless to say, it was pretty bad. And I know there were some concerns when it came to Wells Fargo around credit quality and, of course, those expenses as well. But is it bad enough to justify the biggest drop since March 2023?
Well, I think investors are very sensitive to the revenue and earnings guide from Wells, and I think the fact that it was not as robust as investors wanted, plus the fact that the stock had a great Thursday, those are the two items why it's down this morning. I think that will work itself out as the day and next week play out, but I think that's specifically why it's open week today.
What's your take on, CRE and now I guess multifamily is in play as well. We're going to talk to Carson Block a little bit later from Muddy Waters. I know they're boosting loan loss provisions, but how bad is it going to get, Chris? And who's the worst? Who has the worst exposure of the big banks that Shanali follows?
Well, certainly, I think from the big bank perspective, CRE tends to be limited compared to your mid-cap companies. I mean, we had the New York Community saga earlier this year. That company's now on the road to recovery. I think overall, commercial real estate is in the early innings of its cycle playing out. So it's many quarters ahead where you're going to see loan loss reserves rise. Credit losses starts to happen. I think banks are going to actually be selling real estate loans the second half of this year just to limit some of their concentration and limit some of their exposure. That's actually a healthy thing. That's why these reserves are rising. It's just a process. I mean, we have many quarters ahead where you will see CRE losses rise, but the banks have the earnings and the PPNR to stomach it, and I think it'll be a limited issue in terms of a distraction. I think it's more of a worry that is probably played out in the stocks already.
Chris, and I've got to pour one out here for the bank analysts. It's such a busy season, and it's not just the big banks. You cover a whole host of regionals as well. How do you feel about the regional banks' earnings season here? How much dispersion and perhaps pain might there be?
I think the pain will be limited. I think you're going to find that the cost of funds is flattening out. The companies are profitable. They're going to see reserves rise, but they're also going to see their profits be steady, if not slightly higher, from Q1 to Q2. I really like the fact that the bank balance sheets are growing on a limited basis, which means the capital retention is quite strong. So tangible book, tangible capital, those should all be rising linked quarter. And I think that will continue in the second half of the year. So from that standpoint, capital is really king in the banking industry. And I think we're going to see very good numbers on that regard.
Chris, great to get in touch with you. Hopefully we can talk to you again soon. Chris Marinac there of Janney Montgomery Scott talking to us about the big banks and the little banks. We're going to talk to a smaller bank a little bit later, so stay tuned for that. Coming up, President Biden's doubters grow in number, and so do his missteps. More on the fallout next. This is Bloomberg.
Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players. 3,184 hits, 431 home runs, and of course the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. Why are you doing this?
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
There's only one word, winning. You win on the court, you win off the court. And as you do that, you bring people along.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This is Bloomberg.
The top names names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything. Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Let's take a look at where we're going with these markets 13 minutes into the session. S&P 500 right now up 0.25%. 55.99 is the level. I think 56.35. Anything at that level, 56.34, 56.35 or higher would be another all-time high. NASDAQ up as well, and we put the small caps in there. So the Russell 2000 gaining after it took off yesterday on good CPI. Katie?
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, UBS cutting its rating on Tesla to sell. The analyst says that the EV maker shares have risen, quote, too much, too soon on optimism over its AI plans. Remember, Tesla also pushed back its planned robo-taxi unveiling to October. You can see shares rebounding a little bit, though, after yesterday. Next up, we have BMO Capital Markets raising its price target on Microsoft to $500. The analyst cites rising cloud expectations, shares down mildly. And finally, we have JP Morgan lowering its price target on Estee Lauder to $129. Now, the cosmetics giant announcing earlier this week its CFO will retire. And the stock, it's been under pressure thanks to weak demand in duty-free shops in Asia, Matt.
All right, always interesting, that Estee Lauder story. Let's get, though, to politics. President Biden downplayed concerns about his campaign despite a series of gaffes at the NATO summit yesterday.
Now I want to hand it over to the president of Ukraine, who has as much courage as he has determination. Ladies and gentlemen, President Putin.
What concerns do you have about Vice President Harris's ability to beat Donald Trump if she were at the top of the ticket?
Look, I wouldn't have picked Vice President Trump to be vice president until I think she was not qualified to be president. So let's start there.
For more on President Biden, we're joined by Bloomberg's chief political correspondent and surveillance co-host, Anne-Marie Hordern. So, Anne-Marie, this is, yet another make or break test. And it seems like as long as he stays in the race, we're going to be having these to look forward to each week. How do you think he did?
Well, also, it takes up all the oxygen in the room. Most of the questions yesterday in the press conference, and I was there, was about his age and whether or not can he continue in this race. I like the way Politico summed it up. Democrats are living in purgatory. Biden did a good enough job to keep his political life intact at the moment, but he didn't do enough to assuage these concerns, and that's because these gaffes overshadowed the press conference. And it started before the press conference even kicked off. He made that gaffe about President Putin. He meant to say President Zelensky, and an event right before the press conference. So then the press conference became even more of a high-stakes event for President Biden. But when it came to some foreign policy issues, he was asked about Ukraine, he was asked about China, he was asked about the war in Gaza. He gave substantial, nuanced answers. And that's why you have these Democrats, as Politico's point, living in purgatory.
Something about this that I'm really curious about is actually Kamala Harris's role in all of this. What kind of pressure does this put, or what situation does this put the vice president in, given that there's so many eyes on her at this point as well?
Well, it puts her in a really difficult position because, one, her name is on the ticket as the vice president. So she cannot come out and say that she wants to challenge the top of the ticket, even though New York Times is reporting also quietly the campaign is looking at how she would do against former President Donald Trump. So this could be a breakout political moment for her, but she has to stand back because she is number 2 on the ticket. At the same time, if she was to move to the first place, and if she was to become the Democratic nominee, The issue she has is that she's going to get a lot of questions about how much she knew about President Biden's condition. Were these just episodes or conditions, as former Speaker of the House Nancy Pelosi put it? And is she almost part of this? What some are criticizing the administration as potentially, are they complicit in this? Have they been covering up? These are the kind of questions they are being asked. So she's really in a difficult position. And at the moment, what she's trying to do is just campaign and talk about issues.
Well, Anne-Marie, just quickly to end it, let's talk about what Donald Trump was doing throughout all of this. And at the same time, he was meeting with Hungary's prime minister, for example. What message does that send to NATO, for example?
Well, I think it was very clear at the NATO summit that a lot of these leaders, and this was clear from my interview with Volodymyr Zelensky, Ukrainian president, last week, they want to understand what Trump 2.0 would look like. Because this election right now is, a lot of the polls will show a toss-up, and it's even more challenging if you are looking that potentially it'll be, if you thought a month ago it would be a continuation of Biden, that's looking even more challenging following the debate performance. So there's a lot of consternation amongst allies about what the next 4 years will mean, and they want to get in rooms with either individuals that are close to the former president or used to work for the former president to try to have an understanding of what a Trump administration would look like.
Our thank you to Bloomberg's Anne-Marie Horridern. We really appreciate your reporting this week and very much looking forward to what comes next week, of course, for the RNC. And coming up, a breakdown on bank earnings. That and more in today's Wall Street Beat. Stick with us. This is Bloomberg.
At 10 a.m. Eastern Time, we get University of Michigan data, sentiment prelim, forecast 68.5 on the prior 68.2, with a range of 72.3 to 64. 1-year inflation prelim, forecast 2.9% on the prior 3%. 5-year inflation prelim, forecast 3% on the prior 3%. Conditions prelim, forecast 66 on the prior 65.9. And expectations prelim, forecast 69.3 on the prior 69.6.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
For years, people told me, why are you invested in Apple? Everybody talks about Apple. I actually think that sometimes because someone speaks a lot about something, it might be actually a good sign versus the overhyped sign.
This is Bloomberg Open Interest. Let's take a quick check on the stock market right now because we have a rally on our hands. The S&P 500 rebounding from yesterday's wipeout, currently up about 0.3%. Big tech even more. That was your big loser yesterday, and it's a winner today. Currently up about 0.4% on the NASDAQ 100. Interesting, though, that rotation that we were talking about yesterday, it seems to be continuing today because you have the small cap index, the Russell 2000, leading the way here up over 1%. Shanali, it's going to be fascinating to see if this actually sustains itself.
Gotta love those small caps. But now going to some big caps, we're going to talk about the Wall Street beat, the most talked about stories in finance, starting with the big bank earnings, kicking off earnings season. JP Morgan, Citigroup, Wells Fargo, all reporting this morning. Really mixed results here. I want to talk a little bit about this idea that the investment banking boom has come back. Certainly it has. It hasn't, according to investors, shaken off that concern here about credit quality. Of course, Wells Fargo is feeling the brunt of that, but the CEO in the statement, interestingly enough, really tried to point out that they are really focusing here on that recurring fee revenue. Still, you see every one of these banks so far in the red by at least 2%, 7% or more for Wells Fargo.
Well, tell me a little bit about Citigroup, because we were chatting before the show, and it's Wells Fargo, it's JP Morgan, then Citigroup has some idiosyncratic issues going on there.
It's totally in a league of its own here, because if you think about where the expenses are coming from, they just got ahead of it more than any other bank because of that big restructuring they really had to do, the reorganization. They're feeling the benefit now. Their efficiency ratio is down. Interestingly enough, a lot of the businesses that they said that they would focus on now, trading, for example, you're seeing some gains, equity trading blowing through estimates, and some of that investment starting to come back, though we know, and this gets us to our next story, the investment banking division still has some gains to go. And next up, we are going to talk just about that. Citi's new investment banking chief was granted shares worth $41 million to replace the compensation he gave up when he left JP Morgan. And of course, guys, as we've been talking about, this is all in an effort for Citigroup to really punch above their weight in the big leagues here.
I mean, $41 million is a big pay package even by Wall Street standards, right? I mean, this guy has enough money to buy his own private island now. What does that compare to in terms of, for example, CEOs across the street?
I've heard there are islands up for sale, but
yes.
beyond that, you know, even CEOs, to your point, if you think about the biggest banks, it's in the $20 to $30 million range in a given year. But this was a big hire coming from JP Morgan at the highest levels of their investment bank. JP Morgan is always top 3 in advisory. Debt underwriting, I've got to say, is where it would be the most interesting. JP Morgan brought in more than $1 billion in the quarter alone on debt underwriting.
Right.
And Citigroup less than half of that. It's an opportunity.
So $41 million, big headline there, definitely gets Matt Miller's eyeballs. It's interesting to look into the details of the compensation, how it's structured, because the award, it vests in 6 installments from January 2026 through 2031.
At 10 a.m. Eastern Time, we get University of Michigan data, sentiment prelim, forecast 68 spot 5 on the prior 68 spot 2, with a range of 72 spot 3 to 64. 1-year inflation prelim, forecast 2 spot 9% on the prior 3%. 5-year inflation prelim, forecast 3% on the prior 3%. Condition prelim, forecast 66 on the prior 65 spot 9. And expectations prelim, forecast 69 spot 3 on the prior 69 spot 6.
That's what we're celebrating, right?
Yeah.
I would rather just buy the S&P. What's the cheapest ETF I can get?
Like 2 basis points.
Yeah, instead of paying 2 and 20 for less, better performance.
Hey, listen, if you want to slam on the hedge funds, I won't mind it all day, because, you know, you have to think about they're also operating at essentially max leverage. Remember, leverage don't come cheap these days.
Yeah. And what's the pitch, basically, that you have uncorrelated returns, you have diversified returns, but I tend to
I guess in the up years you don't make as much, but in the down years, do they protect you? Do they hedge against big losses?
That's the point. I think what's more interesting in all of this is that the macro funds are getting weaker, and you are starting to see that in the fixed income trading numbers at these big banks.
All right. Interesting stuff. Fascinating stuff, Shanali. It's a great day for you.
It's almost over.
Yeah, no, there will be more bank earnings coming out.
We've got 1 more hour.
Let's get to the trading diary, what you need to be watching today and next week, really. Today, we're going to get University of Michigan, just a couple minutes, top of the hour, consumer sentiment. Bank earnings continue with Goldman Sachs reporting on Monday, followed by Morgan Stanley and Bank America on Tuesday. And then from Monday to Thursday next week, as Shanali mentioned, outside of banks, we'll have special coverage on the ground in Milwaukee, Wisconsin for the Republican National Convention. This is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, that comes in with an investor like ARK. As I think about, my top
1 minute remaining, I'll lead with University of Michigan sentiment prelim.
3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Ten seconds.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
66, lower than forecast. 68.5, 1-year inflation prelim, 2.9%, 2.9% as expected. 5-year inflation prelim, 2.9%, 2.9% lower than forecast, 3%. Expectations prelim, 67.2, 67.2, that's lower than forecast, 69.3. And conditions prelim, 64.1, 64.1, lower than forecast, 66.
From Wall Street to Main Street, we delve into the community banking landscape with Chris Marr, CEO of Ocean First.
And the next big trade, we'll be speaking to Carson Block of Muddy Waters, who will tell us where he's placing bets right now, Matt.
I am watching closely University of Michigan consumer sentiment coming out at 66. We were looking for, the survey was 68.5, and the previous month's reading was 68.2. So consumer confidence coming down a little bit. In terms of current conditions, which is one of the parts that economists watched very closely, 64.1 was the reading. We were looking for 66, and 65.9 was the previous month's. 1 year out, inflation is expected to be 2.9%. That's bang in line with the survey. And 5 to 10 years out, 2.9%. That's actually a little bit less than the survey, which is 3%, a little bit less. Both of those are a little bit less than last month's reading, which was 3%. So with that, it looks like the consumer is a little bit weakening. Katie, how do the markets react?
They love it, apparently. You take a look at the S&P 500, really building on its gains here, now up about 0.5% right now. And you can see the jump rate as those 10 a.m. data figures rolled in. You can see it too in the NASDAQ 100. Big tech now up about 0.7%, while bond markets continue to rally. Yields actually building on their drop from yesterday. The 10-year currently down by about 1 basis point, Matt.
Wow. You know what? The Russell 2000 gets a big jump as well. Now up 1.25% after yesterday.
You're a believer.
Well, you know what? It is. I believe that it is interesting to look at, especially in times like this.
If there's a rotation trade underway, we should probably talk about
just
it.
1 week to crack him.
The Dow is still fascinating stuff. All right, joining us to talk about it is Liz Ann Saunders, Chief Investment Strategist over at Charles Schwab. Sorry, Liz Ann, we have this kind of argument all the time. We have been having it for years about which equity indexes to put up on a triple board. Is the Dow still important to you?
I think it's for old folks like me. I think it's still a reference point. The biases in terms of where exposure lies at the sector level, obviously, is quite different from the S&P 500. So it gives you a little bit more of that cyclical exposure. It's price weighted, not cap weighted. So I think it's worth having on the list, on the board, so to speak. But it's certainly not the benchmark or reference point for most individuals or institutions.
Well, there you have it. I mean, I am in my 6th decade. I'm living in the second.
That's all I heard.
The second half of my century. Lizanne, in terms of the rotation, I'll ask Katie's question, right?
Thank you.
Are we seeing the great rotation happening as we get closer and closer to a rate cut? Can you buy small caps? Can you buy cyclicals?
Well, it depends on what you mean by small caps. I mean, that's obviously a large universe. The Russell 2000's got 1,800 and change stocks, and they're not all created equal. What has been the real dividing line, not just including what happened yesterday, but the real dividing line for the past year has been around profitability. You've got about an 18 percentage point spread between the non-profitable stocks within the Russell and the profitable stocks. You can do the same thing if you look at zombies versus non-zombies, high interest coverage versus low interest coverage. And I think although yesterday was obviously a benefit to small caps broadly and in areas within that had not performed well, was the move down in yields in response to the CPI report. Looking forward, though, I don't think you want to lean into the lower quality areas that might have had their day in the sun or a short-term period in the sun. I think you want to continue to lean into higher quality, stronger balance sheet, strong free cash flow, high return on equity, obviously profitability, the non-zombies. And I think that's the best way to think about opportunities within small caps. There are times where it's okay to go down the quality spectrum if you're really pricing in a significant turn back higher in the economy. That often happens coming out of recession. I just don't think we're in that stage right now. So yes, look for opportunities down the cap spectrum, but stay up on quality.
Well, Lizanne, should we be viewing the market right now through a factor lens? You brought up just a ton of them right now, profitability, cash flow, et cetera. I mean, is that the lens that you're applying to this market?
Yeah, I think this is not the kind of environment or market where you want to take a monolithic approach, either at the index level or the style box level, or even at the sector level, because there are opportunities as well as landmines across the spectrum of sectors and within style boxes. And I think taking that factor approach is the way to weed out and differentiate between the winners and the losers on those factors like profitability, valuation-based factors, strong free cash flow, high interest coverage. And I just think that that's a better approach in an environment where dispersion is starting to widen out and correlations are way down. That is very supportive of more of a factor-based approach as opposed to a monolithic sector or style-based approach.
You know, Lizanne, I really want to marinate for a second here on this University of Michigan data because it's interesting. Reading more through the data, you are seeing consumer sentiment falling below estimates, but you're also seeing year-ahead inflation expectations fall to 2.9% versus 3%. What does it mean for a consumer to be more pessimistic in this environment? What are the ripple effects?
Well, so one of the interesting things about UMich version of consumer sentiment relative to, say, Conference Board's consumer confidence is UMich. The sentiment measure is based on the questions that are asked. It tends to be biased more by what's going on in the inflation backdrop, whereas consumer confidence tends to be biased more by what's going on in the labor market. So that helps to explain some of the differentials. But specific to UMich and consumer sentiment, I think the reason why you haven't seen any meaningful improvement, even though we've been in this disinflationary path, we've seen, a metric like CPI come from a 9 handle down to a 3 handle, is that, all of us, the three of you on set, me, we all live in the minutia of this inflation data, and we're focused on the headline data and the core data and core services ex housing and how month-over-month readings track to year-over-year readings and what the base effects are, blah, 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 blah. The average human being out there thinks I'm still paying a lot more for stuff than I was pre-pandemic, period. And I think we get lost in the minutia of that, often forgetting that it's price levels that the typical consumer thinks about, especially the fact that the difference between non-discretionary and discretionary components within CPI is still a yawning gap. You're still close to 6% in terms of non-discretionary components of CPI. the stuff we have to buy and consume and use versus the non-discretionary components, which are actually at the zero line.
Yeah.
So I think that's what filters into the psyche.
I 100% agree, and I am also a consumer. So I care about the price of eggs and the price of cars. They're still incredibly expensive. The rent is too damn high, as everyone knows. So that's a real problem. How does this play out for the 493, Liz Ann? Because, the Mag 7, their earnings are insane. And as we get into earnings season, our own Bloomberg Intelligence notes that we could finally see growth for the rest of the S&P. Like the first time we'll see earnings growth for the 493 in 7 quarters. What are your earnings expectations as, economic surprises continue to be disappointing to us?
Yeah, so, and we don't publish our own earnings expectations. I don't cover individual stocks, but I can provide an assessment of what the consensus is looking into the second half of the year. And it is expected that by the third quarter, maybe latest the fourth quarter, you've had almost a complete convergence in terms of the expected growth rate for the Magnificent Seven, or maybe the largest 10. You can subset it in a number of different ways, and the rest of the market, where you see deceleration in earnings for the Magnificent Seven, acceleration in earnings for the other 493, such that by, again, third quarter, maybe latest fourth quarter, if the consensus is right, you've seen a convergence there. And that's something that we could start to get a clearer sense of, even though reporting season is for the second quarter when we have earnings season. But I think, just as been the case the last few quarters, I think that traditional metrics that are focused on, like the beat rate, percent by which companies are beat, they're arguably still important, but maybe more important would be the same for the top line growth. So beat rate, percent by which companies are beating on the top line, because that has been weaker than the bottom line. And then the relationship between the two obviously affects profit margins. I would also focus, and I will be focusing on, the growth rate of the cost side of the corporate equation as a proxy for whether profit margins can be maintained. And if not, what is the answer to the question that analysts will ask, which is, if you still have to cut costs, where are you going to do it? Is it exclusive of labor or inclusive of labor?
We have to leave it there. Our thanks to Liz Ann Saunders of Charles Schwab. Thank you so very much for joining us on what has been a tremendous week here over at Bloomberg Open Interest. I want to also bring you some headlines as they come. Wells Fargo shares still on the decline. The CEO answering analyst questions on a call right now. Shares down more than 7% still. Charlie Scharf saying that it's up to regulators to make judgments about the bank's work. Heightened regulatory environment for the industry. I would say also in the JP Morgan call, heightened amount of questions about those capital rules. A sense here that things might get a little tougher down the road.
This, to me, is so fascinating, because did they not see the Supreme Court Chevron decision? I mean, regulators have been rendered fairly toothless.
Can't fight the Fed.
Everyone's fighting what's been called in the halls of Congress Basel III, right? The Basel rules.
Those oregano rules.
I mean, and then you've got the possibility of a second Trump administration, which you have to imagine would also weaken regulation, including bank regulation, substantially.
The problem is these rules are still coming, like it or not. Even if they're watered down, they are still more than they were before. And so it will have some impact, and the uncertainty of that impact is what's spooking people a bit, Matt.
All right, but I think it's a really interesting story to follow, and you are doing that very well for us this morning. Thank you very much. Coming up later, an interview with the CFO of Wells Fargo. Speaking of, at 3 p.m. Eastern. Don't miss that on the close. But up next, short sellers have made
seeing some downside in dollar yen. Currently down 0.57% at 157.72.
From regulators, we'll speak to Carson Block of Muddy Waters next. This is Bloomberg.
names in global leadership are on Bloomberg.
I envisage not only some kind of a bridge towards membership or language linked to the irreversibility of Ukraine's membership in NATO, but also some kind of a broader package of military material, of financial aid. The more we support Ukraine right now, the sooner the war will end.
Nobody covers the top global leaders like Bloomberg Television and Radio. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Shorting a stock purely because you think it's expensive is a death wish. You have to have a fundamental reason to be short a stock. I think the economy is fine. Is it slowing a little bit? Sure. Are delinquencies up a little bit in consumers? Okay. But there's no fundamental case to be massively short things.
That was Steve Eisman, Senior Portfolio Manager at Eisman Group at Neuberger Berman, speaking to us yesterday. Of course, one of the main characters behind The Big Short. But joining us now is a man known for his bearish best known for it. One of the few last standing activist short sellers really left out there. That is Carson Block, founder and CIO of Muddy Waters Capital. And would love to start with you on the environment here for a minute, because there is a lot of conversation about how difficult it can be to short in this market, particularly whether you call it a melt up, whether you call it a bull market. You certainly see even the unprofitable names or even some of the potentially troubled names moving higher. How do you feel?
It's never been a good time to be a short seller, I suppose. But a lot of what drives stocks these days, and your previous guest was talking about factors. And that's the thing. It's really so much of what moves stocks is really just flows into and out of index funds. So mainly into index funds. So as a short seller, you have to be attuned to that and really have to stay away from names that have significant passive ownership, because effectively that just shrinks the supply of the stock. And when you have inflows into those passive funds, they will buy those at any price. So that is something that has warped the environment and caused a disconnect between fundamentals and the prices of the stocks.
Carson, that's really interesting. We heard something similar from David Einhorn talking about how these passive flows have sort of just fundamentally changed markets. I do want to bring you some sound from our interview with Jim Chanos a month ago on the close. He had some interesting things to say about the state of short selling.
I've called this the golden age of fraud. So there's just so many companies, so many companies now that are playing games that are to try and take advantage of investors. So we need short sellers more than ever.
The golden age of fraud, of course, Jim Chanos' perspective that we need short sellers more than ever. But talk to me about the fundraising environment. I mean, is there investor demand for those short sellers?
Well, when I began raising money, so I was first an activist short seller, didn't have a fund, and then we launched. And my initial conversations, so we're talking 2014, 2015, were a lot of them flowed in the following way, which is, we're concerned about valuations, we're concerned about the market, we want short exposure, but we just don't want to lose money when the market goes up. And it's like, well, you can't really have it both ways, guys. And since then, the environment's only gotten worse. I mean, Jim has shut down his hedge funds because, investors don't want to pay the price for that insurance policy that is your traditional short selling strategy. They don't care about alpha. And, I'd say that also one of the things, to Jim's point about the golden age of fraud, yes, there are more companies playing more games A lot of them are in the gray zone. You don't know whether
Taking a
it's
look at
over
the
the
Fear and
line or
Greed
not.
Index, 57
So
out
they're
of
not going to
100
get
equaling
prosecuted
greed,
in
and the
this
Crypto
environment.
Fear and Greed Index,
And
25
some
out of
are over the
100
line,
equaling
but
extreme fear.
I
And
think
taking a
that
look at the VIX,
2013 was a
currently down
tipping
at
point where on the long
4.88% at
side,
12.28.
investors stopped being remunerated for caring about risk, and it became just about buying narrative. And so the long side investors who didn't make that transition, who still cared about risk, well, they became the butt of jokes or were derided as value investors. And I think that that's one of the transitions that David Einhorn went through, was realizing that you have to look at things differently than you used to. So that's the problem. Like, yes, the market needs more short sellers more than ever, given the amount of games that are being played. But if the long side doesn't care, then this can continue until it doesn't, basically.
So Carson, that's the sort of markets explanation. I wonder about the political issue, because during the Biden administration, the Department of Justice and the SEC have opened investigations into short sellers, accusing them of market manipulation. You would think that the Democrats should appreciate, speaking truth to power, holding corporate America accountable, pulling back the curtain and showing that it's not a wizard, it's a dude back there, So do you expect anything different if we were to have a second Trump administration, or do all politicians hate short sellers?
Well, it's interesting because just small correction, Ed, nobody's been accused of market manipulation yet. So to be fair,
just investigations, though, right, have been open.
So I mean, look, we received subpoenas and search warrants back in 2021, which that's a day that I'm sure my then 8-year-old son will never forget. I've got a real personal issue with this, but I think one of the things that I realized was, at the SEC, when they were making these cases in 2010 to 2013-ish, based on work that activist short sellers had done, well, a lot of those people left the agency, and they now bill $2,300 an hour working for big law firms. So I'm not sure that the agency has much of an institutional memory of how helpful short sellers have been to it. And when you look on the whistleblower side, there's that SEC whistleblower program. It seems that the SEC is now trying to actually, contrary to the law, there's no law that states you're differently situated if you're a short seller versus company insider who's blowing the whistle. But it seems like the SEC is trying to make it harder for whistleblowers to actually get paid when the SEC has recoveries. So I chalk it up to no institutional memory, number one. And number two, there's this populism, right? There's political populism, but that's infiltrated the markets. And I think Elon Musk is really the first to recognize that in the markets and use that to push Tesla up. But I think that part of that populist message, it's easy to demonize short sellers as part of the populist message and somehow call us the suits. That was a really weird moment in 21 when that started happening.
Well, Carson, wrapping it all together, I mean, you think about the regulatory overhang, the political demonization, it sounds like you'd call it, of short sellers, and then the fact that you have those market dynamics, all of that passive money coming in. I mean, do you see the short selling industry shrinking from here? What's the outlook?
Well, you have to differentiate the traditional short sellers who are not talking about the stocks they're short, and they're typically going to be short 50 to 80 names for fundamental reasons, melting ice cubes from what we do, which is we look for companies that have been generally, gravely misrepresenting the information they give to investors, if not outright lying. I think the former, that's a very difficult business right now because, it's just, there's this inclination to buy narratives, and allocators don't really want to lose money waiting for, paying for that insurance policy. For what we do, there's still, as Jim makes clear, right, there are plenty of companies that are problematic. The question always is whether investor apathy investors in a given name, whether they're so apathetic that the problems that we find won't matter to them. And when you have an environment in which there's no enforcement, that contributes to it.
Carson, I want to switch gears a little bit and talk about sectors, because you have been clearly targeting certain areas, and one of very high interest to investors right now, that is the commercial real estate market. You've had this short when it comes to BXMT, Blackstone's mortgage trust, and it has been down about 10% on the year. Clearly you've made some money, but to what end are you looking to short this stock? They say they have $1.7 billion of liquidity. How much further are you going to go here?
Well, our thesis from when we unveiled it in December of last year is that in the second half of this year, BXMT is going to cut the dividend. So we're generally not forward-looking in what we do, but our BXMT short is different.
The euro sliding versus the yen, tracking the dollar fall, last down 0.5% at 171.93.
Which that's apparently emblematic of BXMT's CLOs, of what's on BXMT's balance sheet. So, I mean, a lot of these loans are in trouble. BXMT has not trued them up in terms of the risk ratings. So we believe that as more and more of these loans are allowed to pay in kind, that in the second half of this year, BXMT is going to have to cut the dividend. So that's what we're playing for in that short.
So if you think about what's happening now and this idea that you could see an interest rate cut, does that make the situation simpler for BXMT and other REITs? Do you think that this is a trade that you would continue into other areas, this higher for longer pressure on loan books trade?
So in December, when we went public with this, I mean, our view was that unless there were a roughly 300 basis point drop in SOFR within the next month or two, the BXMT would have to cut the dividend. So we've seen no decline, we've seen no decrease in SOFR, and maybe you're going to get a 25 basis point cut, before the end of the year, maybe 50 basis points. It doesn't matter. In our view, because the problem is the borrowers had been protected from the interest rate rises because they put into place these, they call rate caps. They're effectively interest rate swaps. And as those swaps burned off last year and are burning off this year, now they're exposed to the much higher interest rates. So that's what we think is the straw that's going to break the camel's back here.
What do you think about banks? Shanali's had a banner day with the big ones. Are there any that you would short, especially those that are exposed a lot to commercial real estate or multifamily?
Man, well, look, certainly there are some regional banks that could be interesting. In the past, in 2016, we were short bank OZK, which has a lot of exposure basically to niche CRE, doing construction lending. Now, at that time, it was also partly to say, look, this is trading at 2.5 times book because everybody thinks there's no risk here. It's such a great bank. I'm not current on that one, but if one were inclined, I would look at that.
All right, Carson, that's a good place to leave it. Unfortunately, we're up against the clock. Have to have you back on soon. That is Carson Block of Muddy Waters Capital, and this is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg.
This is Bloomberg Open Interest. A quick check on the markets here now, because of course we are watching really markets react not just to earnings, but of course tons of economic news. We have the S&P 500 now nearly 0.6%. The Dow Jones Industrial Average up about 0.5%, and the 10-year yield just about flat. But you have been seeing some movement in bonds this morning after PPI data this morning, and of course University of Michigan sentiment data, 10-year ending the week at 420. Now let's get a look at some of the stocks moving this hour. Here with us is Bloomberg's Jess Menton. Jess.
Well, Shonali, we have other stocks moving beyond just the big banks. Of course, I have to point out what's happening with AT&T. T is the ticker symbol on this. It actually came off of its lows earlier this morning, had been down almost as much as 4%. Of course, this came after AT&T did disclose it had a separate incident of a hacking in 2022. This is separate from what we heard earlier this year, so it affected users as far as when it came to text, as well as some of their mobile devices for about a 6-month period in that span. But you're not seeing a bigger reaction because there's still a lot of news we still have to figure out with this. But another company I have to point out is Fastenal, because this is a big read and a tell on the economy. Obviously, this is a distributor when you're thinking about nuts and bolts, and a big read when it comes to manufacturing. It actually did beat estimates, and Bloomberg Intelligence saying those expectations came in better than expected. And also the company said that its CEO is still going to stay on tap as well. And of course, they do have a new, when you're coming with Jeff Watts coming into taking the president position there, because their CEO is going to move away from that, but still is going to be chief executive. And then, of course, we still have other banks beyond the big ones. We obviously know JP Morgan with those sort of record profits with the deal making there. But of course, you have other banks like y'all have mentioned with Wells Fargo, those cost-cutting profits and cost-cutting, especially when you're thinking about the efforts they're stalling a bit, and then Citi warning about some of those costs likely to be at the high end of the forecast. But then you also have BNY Mellon reporting, the oldest bank in the U.S., and that coming in strong there too with those expectations when you're thinking about not just the bigger banks, but obviously more regionals too. If you look at the BKX though, that obviously tracks when you're thinking about bigger banks and then obviously regionals that are comprised in that. If you look year to date, it's actually up 13%. So obviously still underperforming the broader S&P 500 today, just about marginally lower there. But of course, we will have more big banks coming next week when you're thinking about Goldman Sachs, Morgan Stanley, and Bank of America, of course.
Jess Menton, great roundup as always. You have a great weekend when you get there. But on the topic of banks, obviously commercial real estate an issue for many small banks across the U.S. And earlier in the hour, we spoke to Chris Marinac. He is Janney Montgomery Scott Director of Research on that topic.
I think overall, commercial real estate is in the early innings of its cycle playing out. So it's many quarters ahead where you're going to see loan loss reserves rise. credit losses starts to happen, I think banks are going to actually be selling real estate loans the second half of this year just to limit some of their concentration and limit some of their exposure.
Deutsche
That's
Bank
actually a
raises
healthy
UK's
thing. That's why
GDP
these
growth
reserves are
forecast for
rising. It's
2024
just
to
a process.
1.2% from 0.8%.
And for more on the banking industry, I'm pleased to say we're joined now by Chris Marr. He is Ocean First Financial Chairman and CEO. Ocean First, of course, is a regional bank with branches in New Jersey, New York, and Pennsylvania. Chris, great to see you in person.
Great to be here, Katie.
I think you can guess I'm going to start with CRE because CRE, it's over 50% of your loan book. How are you feeling about that exposure right now?
Actually, oddly, we're feeling great about it. So, when you think about loan exposures, concentration is what kills. And there's this narrative that commercial real estate is all bad everywhere, all asset classes, all geographies. We operate throughout the Northeast, predominantly in 5 states from Washington to Boston. And we've always underwritten cash flowing real estate. So our portfolio has performed well, continues to perform well. So I wouldn't be surprised as we go into earnings season if you'll see kind of here or there, maybe some elevation by a bank or two. But there is no indication that we're seeing a broad-based commercial real estate issue right now. Certainly not across multiple geographies or asset classes or all that. So we feel pretty good.
And interesting. So to that point, that 50% figure, it sounds like that's not something you're necessarily looking to push lower here.
No, we don't feel a need to push lower. It's something we've done well. We're a 122-year-old company. We've been around. We've been public for 26 years, and our history will show whether it was the Great Recession, whether it was the dot-com bust, or even going through COVID, that our portfolios perform really well.
It's interesting, and certainly the market is really warming up, not just to Ocean First, but also more regional banks as well. Your stock is on a 5-day tear, right? And so if you think about also the impact of lower interest rates, talk us through what that means for deposits, what it means for net interest income moving forward.
Yeah, those are really the 2 big issues, right? Credit and rates. So when you think about what will happen with rates over time, and I'm not in the camp of these massive rate decreases or multiple decreases. I think I'm more in the Jamie Dimon camp that we might see it flattish. We might even see it go up, and that's still a possibility. What that will do, though, is it rolls through our income statement and others, is it does take pressure off your funding costs. But it's not a light switch moment. So it's not like you're going to have a 25 basis point cut whenever that happens, and then you'll see a ripple through bank earnings in the next quarter. But it takes the pressure off, moves you in a different direction. And I think what investors are thinking about now is not what are your earnings the third quarter of 24. They're thinking about earnings trajectory for 25 and 26 and saying if the worst is over in rates and we've troughed in margins, then things are going to get incrementally better. And then the only question really is credit. I think that really, if you look at valuations, it's been overblown.
I'm going to try really hard not to bore Matt Miller for this one, but I have a question about the overall impact of bank regulation. Right. Do you think that this could ultimately spur more mergers and acquisitions? Would you be somebody that's willing to play in that consolidation story?
It's a great question, Shanali. So when you think about bank regulations, right, there are tens of thousands of pages of regulations, but when it gets to M&A and the rules under M&A, it can be very difficult to understand exactly what M&A would be okay, for your regulator. There's a little more clarity coming to that. The major agencies have come out this year and given us some guidance about things they think are productive M&A and things that are unproductive in M&A. So I do think there's an opportunity for that to improve regardless of what happens in the fall. But certainly depending on the outcome in the fall, you could see that's an area of regulation that I think is a little bit more subjective and will depend a little bit more on who's appointed in various seats.
And you've tried it before, and we're sort of thwarted by regulation.
Yes. Yeah, we've had both experiences, Matt. So we've done successful M&A. We did have a deal a couple years ago that became complicated, and we just chose to move on.
I want to ask about, community banks are so important to the locals, right? I'm from Columbus, Ohio. My entire family uses Huntington, and all the businesses, they come to our weddings. Our bankers are like family. How hard is it as inflation has increased prices to a point where consumers are truly suffering, and at the same time, rates are climbing, so borrowing money to deal with those high prices is harder? How hard is it to serve your community?
Our customers are doing okay, and I think although rates are higher, and when we think about them in context the last couple of years, they seem really high. Over a long term, they're not very high, and in fact, for most of my career, rates have been about this level, maybe even higher. When you think about the absolute level rates today, or even a quarter point change up or down in either direction, it does not radically change the cost of financing for a good business. But I will tell you, we're hearing from clients and folks that are particularly serving the lower income segments that you're seeing the consumer is under stress in certain areas. You saw that in the big bank releases this morning. They put aside reserves in credit cards, all three of the big banks, that were the most meaningful reserve bills that they had.
And given that you do have this unique perch as, a local bank, a community bank, I'm curious what you're seeing in the suburban office landscape. To bring this conversation back to CRE, when we talk about office, a lot of the time we're talking about, Manhattan pretty much. But what are you seeing in those more suburban centers?
Katie, that's a great question. Because when you look at suburban office, it's done really well, especially in the Northeast. We have, actually in our portfolio, our occupancy levels are higher than when we underwrote the loans. Kansas City Fed had a study out in April that I think is really worth diving into. And that showed that for large-scale office buildings, we're talking 500,000 square feet and above, the risk of default was strikingly higher than in small buildings. So at 500,000 feet, you've got a default risk of almost 25%. Small buildings, 50,000 feet and less, you're talking default rate about 5%. And at the end of the day, your dentist still has to come to the office, right? He's not staying home. So.
Chris, we thank you so much for coming in studio, joining us on our first week here. That is Chris Marr of Ocean First Financial. And coming up later today, an interview with the CFO of Wells Fargo at 3 p.m. Eastern. And coming up, the price to pay for economic growth. President Biden and Donald Trump have different economic approaches, but the federal deficit might be a common challenge. We're going to hear from Key Square Capital CEO Scott Bessent up next. Stick with us. This is Bloomberg.
U.S. stocks extend gains, NASDAQ up 1%.
Names in global leadership are on Bloomberg.
We are 40 millions. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio. The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything. The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything.
right, it's time now for our daily Wall Street Week conversation. And former President Donald Trump will pitch his economic proposals to the nation next week at the Republican National Convention, including his plans to tame inflation. Now, in a conversation with Wall Street Week's David Weston, Key Square Capital CEO Scott Besson says that it might still be too soon to call the recent data a victory.
I think if we look at the aggregate numbers, aggregates are good, but Chinese have a central plan, and they tell us they have a 5.5% GDP target. So GDP looks good, but underneath the hood, there's some alarming things. The last jobs number. 50% of the jobs were created by the government. If we have government adjacent, which is healthcare and education, it was up to about 80%. Inflation is slowly coming down. The shelter number came down this month, and I don't think the Fed needs to be in a hurry. They had been with this so-called dot plot, which I think they should get rid of because it's becoming an embarrassment for them. They'd been at 3 cuts for 2024. Just at the June meeting, they adjusted to 1 cut, and now the market is pricing in 2 or 3 for the year. So it's all over the place. So having been very wrong, why not take your time? Make sure and see what happens.
So maybe not in September for a cut, maybe not even November.
No, look, I do think that the bottom 50% of Americans are really having a lot of trouble, and that never augurs well. Statistic that's very interesting is the bottom 25% of Americans, their inflation expectations are twice the University of Michigan median inflation expectation. So the bottom 25% is seeing something different than the rest of the country.
So let's talk about what you think a second term with Donald Trump might mean for some of those very factors you're talking about, particularly that bottom 50%, the people who really feel that they're hurting right now. What would he do, given this economy, given that it's pretty good from most measurements, what would he do to really make it that much better?
Well, look, I think we're going to have to reprivatize the economy because this is running on government spending. We're at a 7% peacetime, non-recessionary budget deficit. This is unheard of. I have a piece out today saying for the first time, interest costs are exceeding our defense spending. So, the spending is now becoming also a national security issue. So I think we are going to go back to, under Donald Trump, the private sector pushed the economy. We didn't get inflation because the private sector impetus was met with deregulation. Under the Biden economy, they had big government spend, but it was met by increased regulation. That's the formula for inflation. So, I think we would see the tax cuts, Jobs Act extended. I think we would see a return to energy, a policy of fossil fuel dominance in the U.S. I think we could see up to 3 million new barrel equivalents a day, so oil and gas, off about a 20 million base. So push down energy prices, and once the deficit really is under control, we won't be talking about 1 or 2 rate cuts. We'll be talking about getting rates back down to 2%.
There's a lot of talk, as you know, about getting the deficit under control, but President Trump in his first term did not get the deficit under control. I mean, if you look at least the Committee for Responsible Federal Budget, they say under his administration, we added $8.4 trillion, and $4.3 trillion of that was not COVID related. We added a lot under Biden as well, but actually substantially less than under President Trump.
Yeah, well, they're using CBO projections, not the actual numbers.
Well, talk about taxes, because that's also a concern in that piece you refer to, Bob Rubin and Ken Chenault. They actually said there's a problem with the tax, extending the tax cuts that we had back in 2017. If you extended that, that would really substantially increase the deficit. Because only, and I think this is a CBO number, you correct me if it's wrong, but only 20% of those tax cuts actually paid for themselves.
Well, I think this time around, and I think with Trump 1.0, we got to stop the clock at the end of 2019 because COVID was a game changer, and I think that there is big appetite for pay-fors this time. So I think we would get this Orwellian named Inflation Reduction Act under control. I think you can save $1 trillion on that. I think if you empower states on Medicaid, that's another $1 trillion. I think that there will be some tariff income. So I think that there's a big appetite to reinstate the tax cuts, but with pay-fors.
And that, of course, was Scott Besson of Key Square Capital with our own David Weston, who's sitting next to me on set. Really interesting conversation with a potential Trump pick there, of course, about Trump tax cuts and what they might look like under Trump 2.0.
Yeah, and he talks with the former president, I think, fairly regularly, and he gives him advice. I don't know whether he accepts it or not, but he has some view into what President Trump thinks about the economy. But you notice in that discussion, he really is emphasizing the bottom 50% or even the bottom 25%. It's really a populist message. A lot of the people he says benefited from this great economy are at the top of the income spectrum, not the bottom. Those are the people I think Donald Trump really wants to speak to.
Around this table, you got a couple of New Jersey gals, right? I'm a boy from Westchester. For us, these weren't tax cuts at all. In fact, my tax contribution has at least doubled, if not more, because the state and local tax deduction was taken away by Donald Trump in 2017. Do they intend to push that forward as well?
Well, I don't hear anything that they want to. And let's think about it for a minute. I'm not sure that Donald Trump is too worried about people in New Jersey and New York. He doesn't think they're going to get to vote for him anyway. He's worried about a different part of the population that cares a lot more. And they think, if anything, maybe we stick it to those those Easterners, who are spending too much, they would say, in their government anyway. This will get some fiscal discipline into New York and New Jersey.
Taxes used to be a boring topic, but the reality is it's pretty key moving forward. And there's this headline from the Center on Budget and Policy Priorities recently saying the 2017 Trump tax law was skewed to the rich, as you were saying, expensive, and failed to deliver on its promises, needing a 2025 course correction. Could anything be different next year if Trump were to gain office?
Well, it's interesting to hear from Scott Besson. He is, to some extent, saying Trump 2.0 is not going to be simply an extension of Trump 1.0. I mean, you heard him say, if we can get our arms around the Inflation Reduction Act, we can save $1 trillion. If we can delegate to the states some of the Medicare, we'll save $1 trillion. He's looking at saving some money, which, of course, President Donald Trump, when he was president, did not do. If you look at the amount of money they spent, it did not curtail. In fact, the Manhattan Institute, which is not a hotbed of liberal thinking, the Manhattan Institute did an analysis of President Trump who said, actually, he added $3.9 trillion to the deficit, above what the line was they expected from the CBO going in. So he's got a little bit of a pivot to make to say we're going to save money this time.
All right, David Weston, great conversation. Of course, tune into Wall Street Week with David tonight at 6 p.m. New York, 11 p.m. in London. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Let's get to the trading diary, what you need to be watching today and next week. Bank earnings continue with Goldman Sachs reporting Monday, followed by Morgan Stanley and Bank America on Tuesday. All of next week, Bloomberg is going to have special coverage on the ground in Milwaukee for the Republican National Convention. And then U.S. retail sales are due on Tuesday. On Thursday, we're going to get the European Central Bank decision, and that's a lot. That's already a lot. Do I need to go on?
No,
I'll stop.
Let's move on because it's been a big week for ETFs as small caps see the biggest flows in a decade or so. Athanasio Sarafagis, he is an ETF analyst with Bloomberg Intelligence. He joins us now for ETF Friday on set on a Friday. Obviously, yesterday was an important day in the market. You saw that rotation trade. Where did that cause money to move when you take a look at the ETF level?
Small caps was definitely the biggest. You know, this is probably, I think, one of the most toxic relationships. It's like every year, everyone wants small caps to work. It's an election year. Everyone thinks it's going to come back. Money rushes into it. Performance always doesn't really live up to expectations, and it tends to move out. So anything just moving away from large cap, that was like really the big trade for yesterday. Equal weighted, anything not Mag 7, that's where most of the money tonight
I used to be on the ETF show.
You did.
With Katie and Eric. And we saw a ton of new ETF launches that just kind of started to taper off. How's that looking this year?
No, it's the opposite. It's ramping up. The launches are getting intense. They're getting intense. There is now 2x levered micro strategy in the filings.
Single stock ETFs?
Single stocks. I think it's like speaks to the frothiness a little bit in the market, right? Launches always tend to kind of follow how market sentiment is, and it seems like it's getting it's pushing the limits a little bit.
I'm going to play my role on this show and be the boring one again because...
It's not boring.
TLT? What about treasuries? What about treasuries?
That's extremely important. Long duration bonds. Let's go.
That's an exciting one. That's not boring. That is finally starting to work. That has lost a lot of money for a lot of investors because they're always fighting the Fed, especially last year, and the Fed wasn't cutting. Finally, it looks like you might get a cut. That trade's starting to work. It's still, TLT is always a popular one. That definitely took in some money yesterday. It's on a 2-week win streak in terms of flows. So I think people are maybe starting to be more confident in fighting
Well, if you thought TLT was exciting, how about TMF? That is a triple leverage 20-year plus treasury. It's almost too much fun. People keep pouring money into it. They keep getting burned. And I think that's so interesting that people just keep trying to make long duration work, just like they try to keep making small caps work.
Yeah, I think, it's anything levered up is obviously more exciting. But yeah, I think the two big things are going to be the Fed fight, that might continue on, and then trying to see if you can move away from the Mag 7, whether it's small caps or equal weighting or smart beta or one of these strategies.
All right, Athanasio Sarafagis of Bloomberg Intelligence, thank you so much. And tune into that ETF show, ETF IQ, every Monday at 12 p.m. Eastern. Matt won't be there, but I will.
And we're going to get another check on these bank stocks before you let you go here. Of course, Citi's analyst call about to begin here, and it was a tough day for financials. We are still seeing JP Morgan down about 1.5% on the day. Citigroup now extending losses to 3.2%, almost 7% on Wells Fargo. Of course, another week of bank earnings ahead, Katie.
Yeah, a lot of red on that screen. We'll see how everyone else fares next week. The CFO of Wells Fargo, he joins Bloomberg TV at 3 p.m. Eastern. But that does it for Open Interest. I'm Katie Greifeld along with Shanali Bassick and Matt Miller, and this is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well, because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from San Francisco and New York, this is Bloomberg Technology. Coming up, AT&T. It reveals a massive new cyber attack. Details ahead.
And we'll bring you the details on Tesla's robotaxi unveil delay.
Plus, Amazon and General Catalyst, they bet on an AI robotics startup. But first, Ed, what have you got on the AT&T hack?
Yeah, this is our big breaking technology news story this Friday morning. AT&T, in a regulatory filing, has disclosed a major hack of customer data. It relates to basically all of their cell phone customers for a period of time in 2022, the beginning of May to the end of October. It is a broad spectrum of customer data, but right now the belief is that that data that has been obtained by malicious actors is not publicly available. We're actually way off session lows on the stock, down 0.7%. We have been down kind of the most in about a month. It's kind of a hard to gauge situation. I think the main point is that we're still assessing, Caroline, the vulnerability of that customer data. But the context, I think, is that this is a big hack. This is something that, and it's different from a hack a year ago, which we've already talked about.
Well said. The context is this has happened quite recently. Before we get straight to John Butler of Bloomberg Intelligence on the hack, as Ed mentioned, John, AT&T has said it currently doesn't believe that the data is publicly available. What is the damage?
Well, I think the damage for AT&T could be to their brand image in the near term. The one thing I'd say, Caroline, when you think about it is, think of all the hacks that have happened with Fortune 500 companies over the past year. It's become quite common. And so I think from a consumer standpoint, people may be more ho-hum about it than they would have been, say, 5 years ago, given how common hacks have become. Having said that, this is bad news for AT&T in the sense that, as Ed just mentioned, it's the second big hack announced in less than a year.
I want to bring some of the latest news we've got, John, to you and our audience just before we came on air. To be expected, but we started to hear from regulatory agencies and bodies, and AT&T had already said they were in touch with law enforcement, but the FBI says it's been contacted by AT&T about this. The FCC is investigating the massive hack of AT&T customer data. The question is, what is the vulnerability to AT&T? What is the risk to the company from this point?
So I think regulators are going to look into how it's handling its data. So to be clear, this hack was not on AT&T's network. It's to be clear, its network was not breached. It was housing data with a third-party cloud provider. So it generates massive amounts of data through call logs, right? When you call someone, it logs your number and the number being called. That's the type of data that was stored on, as Bloomberg reported, Snowflake's data
Japan's
platform,
currency
and
chief
that's where the
Candace
breach
says,
was.
I
So
won't
think
say
data
if we
regulators
intervened.
or telecom regulators are going to look into data storage practices, and of course AT&T will be open to potentially consumer lawsuits from this.
To that point, we reached out to Snowflake as well, John, and the company saying we have not identified evidence suggesting this activity was caused by a vulnerability, misconfiguration, or breach of Snowflake's platform. Is there any read across to more broadly how companies like AT&T do work with third parties?
So I think, like a lot of Fortune 500 companies, a lot of data now is moving into cloud storage because it just isn't practical in the age of data to store everything on premise. So I'm sure AT&T is going to do a reevaluation of its vendors. I'm sure a lot of companies do that routinely. And for Snowflake, I think they are probably, having spoken with our analyst here who covers the company, they're probably going to lean much more heavily into securing their platform and augmenting the level of security around the data that's housed on the Snowflake network.
John Butler, Bloomberg Intelligence, thanks for breaking it all down for us. We appreciate it. Meanwhile, we follow on from an incredible scoop from our own Ed Ludlow and Dana Hull yesterday that Tesla has been, of course, delaying that rollout, that unveiling of its robotaxi that was set for August the 8th by a couple of months. Now, we're down on a two-day basis, but we have recovered somewhat on the trading today. Dan Ives, I'm pleased to say, Managing Director, Senior Equity Analyst at Wedbush, joins for more. And you put out a note very quickly on this reporting saying the delay did not change, ultimately, your bullish call on Tesla. Why not?
Look, I mean, it's 2 months. We're not talking 9 months, a year. You'd rather them be what I view as kind of a jaw-dropper event. And that's what really needs to happen in October. And obviously, the delay is not what you want to see. So no one's popping champagne when you hear that there's going to be delayed, congrats to Ed and Dana on the story. But in terms of the AI story, FSD, the next phase of Tesla, that's unchanged. That's why in our opinion, this is just more an air pocket period to get on to what I view as gold at the end of the rainbow.
Let's talk about some of the golds at the end of the rainbow. Ed, I mean, we had seen a run-up in Tesla's stock, previous week up 27%, but we did see a fall yesterday.
Yeah, and look, what really surprised me overnight was all of the retail investor community very publicly on X saying to Elon Musk, like, can you confirm this? Can you confirm this? Like, Bloomberg stands by its reporting, and we always reach out to Elon Musk and any other avenue at Tesla to ask for comment and verify. But Dan, what was it then? I know that you remain bullish on Tesla, but when I said you were coming on the show, a lot of folks in that community were saying, well explain the 8.4% drop that happened in Thursday's session. Is that just because the run-up in the stock that preceded it, or is it because of genuine concern?
No, I think it's more the run-up. Look, this is going to be a historical day, whether it's 8/8 or 10/8 or whatever day it's going to be in October. A lot of anticipation going in here. And in my opinion, Tesla's more of an AI robotics play than just an auto company. And investors, they don't like delays because then it feeds into that narrative. And obviously the bears, they focus on in terms of empty promises. And I think it's important, and this is the most important thing, that when they have this event in October, it doesn't disappoint. It shows the path for robotaxis, shows autonomous, shows the AI vision and monetization. 2-month delay, that's a rounding error relative to where we see longer term. As we've said, I think the AI story alone is worth $1 trillion for Tesla.
Mr. Ives, we always appreciate having you on this program, Bloomberg Technology. You are unwaveringly bullish on everything. And we just showed a graphic with your coverage, right? All the stocks that you are across, 30 buys, 3 holds, and 0 sells. So again, I kind of think, Caroline, what would it take to make Mr. Ives a little more cautious on Tesla? What is it that he would see that would make him rethink his call, Caro? I don't know.
Yeah.
Slow down.
I mean, what I'd say to that point, look, we've talked, I mean, for the last almost 25 years, I mean, really pound the table on tech. And of course, we've had bad calls in there as well. But our view, especially where we are, and especially the last decade, but especially the last, I'll call it 18 months, this AI revolution's just starting. So when I look at Tesla and talk about what would make us negative, we talked about a quarter or two ago that Musk needed to step it up, right, in terms of adult in the room. I think he did that. I think deliveries was important for 2Q, and I think, you know, you saw a lot of the bears going back into their caves for that. But you need to continue to see demand stabilization, no more major price cuts, and October, you got to deliver in terms of this next phase of the story, in terms of robotaxi.
I'm really interested by the take that you're like, this is an AI robotics play more broadly. That's certainly what we've heard from Elon. Apple suddenly has got on the AI bandwagon as well. They're also talking up production, at least with their suppliers. That's what we reported yesterday. How are you feeling about the AI play for that big company that you're also an outperformer on?
And we've talked, the consumer AI revolution goes through Apple. So when you think about WWDC, and I'll compare it a little to maybe a robotaxi day, that was a historical day. And I think that's where investors started to recognize the keys to that kingdom is Apple. And we've talked about a huge part of what I think, not just the valuation, but catalyzing this next upgrade cycle is going to be Apple Intelligence and AI. And that just speaks to a broader view in tech that we see with Google, Amazon, of course, Nadella and Microsoft, and godfather of AI, Jensen, NVIDIA.
Dan, I want to just remind two specific points to our audience that we reported. One is that part of the robotaxi delay was because I think Elon Musk wanted more to show. We said via sources that they wanted to have more prototypes, but they also had some design rethink. And in the same moment, Uber and Lyft jumped 5% in the session. What did that tell you about how seriously investors in the market take Tesla in basically an app-based ride-hailing platform that Tesla might introduce?
Yeah, and I also, Ed, I'd say, I mean, you get an England win and that scoop. It was a good day for Ludlow, right? And I think when you talk about the AI piece, yeah, I mean, I think there's worries about this fleet and what that could ultimately look like for Uber and Lyft. So that negative for Tesla is viewed as a positive Uber and Lyft. I don't view it as a zero-sum game. I think some of the negatives, specifically on Uber, is overdone in terms of what this is going to mean from a robotaxi fleet perspective. And I ultimately believe that's something where, like, they're going to have partnerships as well, Tesla, when it comes to rideshare. But 3-5 years from now, I mean, there's going to be a decent percentage, whether it's 10% or 20%, that ride sharing will not have a driver.
Be interesting to see if Waymo's still in that conversation as well. Dan Ives of Wedbush, thank you. Happy Friday. Grateful to have you on set. Two names that actually didn't come up there are Rivian and Lucid. Look at the gains we're seeing in Friday's session. You know, I talked with the team in equities, Caro, like, what's going on here? And I think it's just risk on for risk on's sake. Both, you know, over a long-term period downtrodden, but rebounding super significantly this Friday.
Yeah, we've got a little bit of macro weaving in, helping boost that risk appetite. PPI, maybe not it, but maybe there's a bit of a hope around the dialing back of inflationary pressures. We're going to talk it all with Anna Rathman, CIO of CBIZ Investment Advisory Services, joining on her market outlook. This is Bloomberg Technology.
In tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself, actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
Good morning from our world headquarters in New York. I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
Let's get a bit of a macro picture right now in the markets. There's risk on for tech names. The NASDAQ goes higher, more than 1.2%. Volumes higher on this benchmark as well. And that's as perhaps we get a feel-good music coming back in when we're looking at consumer expectations for inflation dialing down to 2.9%. Yes, US producer prices were climbing a little, but actually if you dig into the personal consumption expenditure price index, that didn't look bad. Two-year yields, they fall. We're seeing actually Europe on fire. Stock markets more broadly around the world doing well, albeit maybe some in Asia sell off, Japan intervening once again. But we want to get to the macro picture and what it means for tech stocks. Anna Rathbun's with us, CIO of CBIZ Investment Advisory Services. And look, this tech market has been what's dragged us higher, Anna. Can it continue to do so?
I think it can, and here's why. There are some weaknesses in the economy, as we've been talking about, I think, for the last month or so. And when there are weaknesses, there's bound to be cost reduction and cost management, as well as margin pressure. So if you look at it from that perspective, the cyclical areas of the markets are going to continue to be pressured. What does that mean for tech stocks? We have believed that the tech stock rally has not just been an AI phenomenon, it is also a quality phenomenon. So when you have tech stocks running, really the companies that are at the Max 7 companies that have given us more than 50% year-over-year earnings growth in Q1, there's a reason to be in those stocks other than AI.
Right.
So if you continue to see economic pressure, we think there's more room for quality stocks to do well.
Anna, a single session a market does not make, but I found yesterday very interesting. You know, the moment that Dana and I and Caroline reported that the Tesla news, it clearly had an impact on the index level. And we all reflected that it was the worst performer on the S&P 500 and the NASDAQ 100. But the biggest points drags were NVIDIA and other names relating to AI, be it on the software side like Microsoft, I think. Is there a lesson to be taken from that in yesterday's session?
Well, I think the lesson is that investors had been flocking to them because they're heavy with flush with cash, little debt, and that is the place to be. And when the Fed it lowers interest rates, as the CPI numbers seemed to suggest yesterday, we're going to have a rotation into more cyclical areas that had been really pressured downward. And so I think the lesson yesterday, it was a confirmation for me, actually, that a lot of the reasons for the tech Magnificent Seven going up had also been quality. And that the reason for believing that Max 7 can continue to do well going forward, it was a confirmation.
Well, therein lies the question of earnings and proof of fundamentals. Look, the banks today not looking good, Anna, but all eyes continue to be Netflix as they come first, but then some of the Mag 7, as you mentioned. Can they support the valuations with the earnings growth that many are factoring in?
Yeah, the valuation component is the sticking point. the question is, how much of the valuation is reflective of earnings? How much of it is reflective of AI? And how much of it is just investors flocking to quality? And that's very difficult to tease out. On the AI component, it's like, how do you even price hope? Because frankly, I mean, we are seeing AI kind of filtering into the consumer life through, I guess Rufus was the news today to fetch, information from Amazon. But we still don't know exactly how it's going to be expressed in the productivity component, the labor market. So that is the sticking point. And that's why we're pretty much balanced in terms of our investing. We're very, very diversified. When the markets seem to be irrational, we ride it and then we rebalance it, taking the gains, and that has been our strategy year to date.
Anna, the world was watching last night in the context of NATO summit press conferences and a US presidential election. If you are an investor operating in the technology sector, do you look at it as well and think about what might happen to the areas you put money depending on the outcome in November?
Well, so the big threat, I think, to big tech is regulation. And I know there's been a lot of talk about one-party rule in Washington, and that's really, it's way too early, but I think there is a fear of that. If we do have a one-party rule, it's not so much just about the White House, right? It's about passing of laws. And if that's the case, then it changes the landscape for not only tech, but definitely for AI, because there's a lot of fear around it. So I would say that that's the uncertainty that is facing us in the future.
Anna Rathbun, CEO of CBIZ Investment Advisory Services, thank you very much. Now, coming up on Bloomberg Technology, there are growing calls on the Hill for a probe into Microsoft's AI deal with the Emirati company G42. We have some more details next. This is Bloomberg Technology.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal. That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Now, key Republican lawmakers, they are now calling for a formal intelligence probe into the budding AI partnership between Microsoft and Abu Dhabi AI firm G42, with a focus on the Emirati company's ties to China. Let's bring in Bloomberg's Mackenzie Hawkins. We've heard murmurings, worries, now it's more formal. What is key, the risk here for them?
So we have yesterday House Foreign Affairs Committee Chairman Mike McCall and the chairman of the China Select Committee calling for a formal Biden administration intelligence probe into this partnership between Microsoft and G42. This deal, which has Microsoft investing $1.5 billion in the hottest AI startup in the Gulf, has attracted a lot of scrutiny in Washington on issues ranging from human rights to the risk of sensitive American tech being diverted to China. And folks in Congress have been frustrated for a long time about what they see as a lack of transparency from the Biden administration. They haven't gotten a comprehensive briefing, and they're now saying it's not enough for the U.S. government to be working on sort of general frameworks behind closed doors. They want to see the intelligence community prepare a formal assessment and evaluate all of the national security risks that they've identified.
Mackenzie, you and I have been through a similar story together with CATL, the Chinese battery maker, and its relationships with U.S. automakers. And it was kind of the China hawks that were doing this in DC. How analogous is this G42 and Microsoft tie?
So we're looking at, two different types of investments. The CATL thing that you mentioned has a partnership between CATL and Ford for a battery plant in Michigan, but it's not actually a direct investment by Ford into a Chinese company. And in G42's case, this isn't a Chinese company. The concern actually is that if the U.S. allows sensitive American technology, everything from AI model weights to the NVIDIA H100 chips that would be necessary to actually stand up a data center, that China would be able to use G42 and the UAE as a country as a backdoor to access technology that the U.S. has cut China off from. So these are sort of different situations, but a similar tide of concern in Washington that's been consistent over the past couple of years, that any deal between a U.S. company and a Chinese company or a company with links to sanctioned Chinese companies poses an inherent national security risk.
Bloomberg's Mackenzie Hawkins, always on it. Really appreciate your reporting this Friday. Thank you. OpenAI has come up with a set of 5 levels to track its progress toward building AI software capable of outperforming humans. It's the startup's latest effort to help people better understand its thinking about safety and the future of AI. Bloomberg's Rachel Metz is here with the details. I saw you put this out last night on social media, and I think for the everyday person right through to investors and AI industry participants, this is kind of a set of codified rules that might be helpful. What are they?
So the company has these 5 levels, and they also told employees that they believe they're on level 1, which is chatbots, similar to ChatGPT, which is probably their most popular product. They're sort of on the cusp between level 1 and level 2, which they call reasoners. This would be machines that have more of the reasoning type capabilities, similar to what humans today can only do. They put this out in part because they want people to be a little bit more aware of how they're thinking about this process of trying to build artificial general intelligence, which has long been the company's stated goal. Whether or not they will get there is another story, but they've been working on this for quite a long time.
And Rachel, I mean, to that point, Sam Altman himself has said maybe we get to AGI in the next decade, but has there been any whisperings of ultimately how far along, how quickly we could get to the ultimate level 5?
I mean, I think everybody has a different opinion on this. I mean, one of the things we have to think about is this is a very rough draft in progress thing that they're working on here, as they were very clear about saying, and they're going to be taking feedback from a lot of different kinds of people. But nobody can really agree on what it even would mean to have artificial general intelligence, AI that can outperform humans or do all the things that humans today can currently do. So maybe we need to work on that too, figure out what do we mean when we talk about that? Like, what would that look like?
Bloomberg, Rachel Metz, all over trying to gauge the risks that is to artificial intelligence. Meanwhile, coming up, we're going to be discussing the state of crypto markets. Tomas Perfumo is joining us, head of strategy over at Kraken. Ed, some interesting news on IPOs.
Yeah, some breaking news. The Wall Street Journal is reporting that StubHub has delayed its plans for an IPO until at least September. And the rationale that the Wall Street Journal is reporting from StubHub is that we have some choppy market conditions, StubHub being the sort of online resale marketplace for tickets. Interesting one. Stay with us. We'll be right back. This is Bloomberg Technology.
Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players. 3,184 hits, 431 home runs, and of course the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. Why are you doing this?
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
There's only one word, winning. You win on the court, you win off the court. And as you do that, you bring people along.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. And I'm looking at the markets really quick, Cara. I think the story this Friday is very much like Fed bets, cut rate, something like that's going on. We're looking at economic data. But the conversation we had earlier in the show about also thinking valuation, what's happening in the election is at play. NASDAQ 100 up 1.2%. Tesla's a really interesting component of that, right? It's rebounded from its biggest drop since January 24th on Thursday. It's now up 3.4%. Generally, there is a risk-on attitude, and the EV names, others like Rivian and Lucid, are caught up in that. I've also been thinking a little bit about Bitcoin. You know, we do say it's kind of our go-to risk asset from time to time. Not a lot going on over the course of the week. It's a weekly gain of 1.6%, but at $58,000 per token, we're trading at a level that we were kind of at in February and March before the steeper climb tied to the approval of spot Bitcoin ETFs. And I just don't see a lot in the moment out there. A lot of our audience will say, well, we hodl, you know, we're all about the long term, but we do a little check on it, and then maybe it's back to being a risk asset along with everything else in a risk-on environment. I don't know.
Well, if you don't know, we've got someone to ask. Thomas Parfumo is with us, head of strategy at Kraken. And Thomas, look, there's been a lot of supply-side issues weighing, at least sentiment-wise, worries about the Mt. Gox issuance coming back, money being given back, and German government moving things around within wallets. But fundamentally, what is our next catalyst? Is it the ETH ETF, if and as and when it comes?
Yeah, so I think in the short run, I'd say there's about 4 big catalysts in the second half that I'm looking out for. So broadly speaking, risk assets, we're talking about the macro economy. So Canada, Europe already cutting interest rates. Question is, when is the Fed going to do it, and to what degree are they going to do it? With crypto specifically, the Ethereum ETF launch is a big deal. That brings a lot of attention on crypto. Again, it brings a lot of capital flows. It's a rising tide lifts all boats story. Looking forward, U.S. election sets the tone for policymaking and the legislative agenda for the next 4 years. And then beyond that, you know, I think it's just the ongoing trend of adoption of Bitcoin, global engagement with exchange-traded products like the UK and Hong Kong launching their own, as well as increased access to crypto ETFs here in the US.
And Ed, actually, Tomas mentions an election here in the US, and that's something we've been thinking a lot about and the impact on crypto, right, Ed?
Yeah, I mean, one of the things I reported, Tomas, was this idea that Vivek Ramaswamy had acted as like an intermediary between Elon Musk and Donald Trump, former President Trump. And one of the areas that they found a renewed common ground was on crypto. So I wanted to ask if Kraken kind of has a scenario or game plan for either case in this election. What happens in crypto markets if it's Biden, or what happens if it's Trump? Or, after last night, we may ask if it's a different Democratic nominee. We don't know.
Yeah, I'm not an expert on the political spectrum here, but I will say that when it comes to the U.S. specifically, it's really about legislative action and developing clarity for this industry. And when I think about the issues that we've seen this year, the progress we've made, it's really been light progress along the Congress where they've passed 2 bills, more recently FIT 21 and SAB 121. And what's interesting there is it showcases some of the bipartisan support that's emerging for crypto legislation in the Congress, at least. And so even though you've hit barriers at the executive level, still good progress going forward. I think, of course, the Republican side of things seems to be more pro-crypto, more progressive in that sense. You have Trump going to Bitcoin Nashville in a couple of weeks, so we'll see how it plays out.
Tomas, can I make a hard pivot to football, or for our American audience, soccer?
The US dollar index fell to 104 spot 4, the lowest since June the 7th.
With Atletico, well, the thing I've always thought about Atletico Madrid is they have a massive following in Latin America, even though they may be the smaller of the clubs in the city of Madrid. Just explain why you did that.
Sure, so I'll try to keep this short, but Kraken was founded in 2011 with this ambitious vision to be the most trusted and secure place to buy crypto anywhere in the world. And when you think about our 13-year legacy, pioneering things like proof of reserves audits, things like being a day one supporter for Ethereum when it launched, being a day one supporter for staking when Tezos launched this concept, and even today, making crypto accessible to the world. Now, we feel like we've earned the right to boast about this legacy being in the market for 13 years, but it's only in the last year that we've really started to bring our brand out into the world. So things like our F1 partnership with Williams Racing, or even this new partnership with Atletico Madrid, one of the most iconic football teams in Spain. And so I think it's really just a showcase that we're trying to get Kraken known globally in a place that we have already operated for a number of years. And so we're really proud of everything that we're doing now.
Marketing, Tomas, to an audience that you want to come and use the product, but also maybe is marketing to an investor base that eventually you go public into. Is that something that you're eyeing in terms of this market?
I got nothing proprietary to share here, but I will say our mission is to accelerate the adoption of crypto. Any strategic paths available to make that happen is something we're going to be exploring.
And look, we pass the numbers. We look at a 58,000 handle on a Bitcoin, and we've been looking at what the altcoins have been doing in the meme coin rush that we've seen. But ultimately, are we still seeing money move into the overall ecosystem for the second half of the year, or do we trade where we're currently at, do you think?
So I think a lot of it hinges on the Ethereum ETF and the launch of that. So a lot of the market sentiment is trying to gauge what kind of capital inflows do we see from that event in general. So from what I've been able to gauge, I think the market is pricing in something along the lines of $750 million to $1 billion of net inflows into Ethereum ETF products on a monthly basis. And so if we start to match that, I think that creates positive support for the industry. If we surpass that, note that Bitcoin was at a pace of north of $2.5 billion. That's where you start thinking about maybe Ethereum tests all-time highs in the mid 4,000 range. And again, rising tide lifts all boats. One last note here is when I look at the prior all-time high back in March for Bitcoin, that's what I'm calling a quiet peak. We didn't see similar levels of extreme volatility or similar levels of unprecedented volatility of signups on our platform to suggest that you really had peak momentum of lots of people, tens of millions, hundreds of millions of people coming into the industry for the first time.
Hundreds of millions. Tomas Parfumo, we thank you, Head of Strategy at Kraken. And what else are you looking at?
So some of the other big news stories in today's Talking Tech. First up, a rare failure for SpaceX. The company's Falcon 9 rocket deployed 20 Starlink satellites, but into the wrong orbit. In a post on X, CEO Elon Musk said a portion of the upper engine failed for unknown reasons. SpaceX has said it made contact with 5 of the satellites and will attempt to reposition them using the attached thrusters. Within the last hour, the FAA has announced it will require a probe into that Falcon 9 failure, but I would say that's largely procedural. SoftBank strengthens its chip investments. The Japanese investor acquired UK semiconductor startup Graphcore. The company is set to operate as a SoftBank subsidiary and will keep its management team. The financial terms of that deal were not disclosed. And Samsung is facing more walkouts, this time at one of the company's most advanced AI memory chip plants. Several hundred workers joined the protests on Thursday and Friday as the campaign for higher wages continue. Union leaders have told Bloomberg they're targeting smaller but important complexes in the hopes of amping up pressure. Caroline.
Fascinating. Meanwhile, stay global with Russian story now. Waging a war under the sea? This question has been emerging after a worrying pattern of missing underwater cables. Bloomberg's Jordan Robertson has a story.
In 2021, an unexplained incident occurred off the coast of Norway. An important undersea data cable had been damaged, and no one could explain why.
Something was obviously seriously wrong. Nothing worked anymore. No instruments, no sensors. Where the cable was supposed to be, there was no cable. You just see mayhem.
At the bottom of the world's oceans lie an essential network of data cables. They stretch hundreds of thousands of miles around the world.
Information flow, communications, banking system, financial communications, it's a vast network and it's extremely vulnerable.
Damage to any of them could be catastrophic.
It could spread a panic, disrupt the normal functioning of states.
In the last few years, there have actually been a whole series of incidents involving undersea cables. These may not be freak accidents. They may actually be a sign of something more sinister. Sabotage.
That was epic. And that was Bloomberg's Jordan Robertson, who you can catch the full story from on Bloomberg.com. And there's also a much longer video report on the issue. All right, coming up, we're going to be joined by the CEO of Standard Bots on the company's fresh Series B round and how they're going to use the new funds. That's next. This is Bloomberg Technology.
I decided to acquire Indeed 12 years ago when I was 36. I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big American company. But I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the praise to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right.
So whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
For years, people told me, why are you invested in Apple? Everybody talks about Apple. I actually think that sometimes because someone speaks a lot about something, it might be actually a good sign versus an overhyped sign.
The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything.
This is Bloomberg. Let's talk about robotics, AI robotics. The startup StandardBots. It's raised $63 million over a series of deals, with a majority of the funding haul, which has not previously been reported, coming in at $39 million Series B round led by General Catalyst, with participation from some key strategics, Amazon Industrial Innovation Fund and Samsung Next. Here from StandardBots CEO, Evan Bund. Great to have you here.
Thank you for having me.
How quickly did it come about?
Came really quickly. General Catalyst actually preempted our round, so I think it shows how hot AI and robotics is at the moment.
Okay, does this feel like slowly, all at once? Because I'm pretty sure you've been at this for quite a while, and already you've had your robotic arms in companies.
That's exactly right. I think it's a moment in time where we realize this is happening.
Evan, really grateful to have you on the show. I want to go into those strategics. You know, we've done a lot on this program about Amazon, robotics in the warehouse. Samsung, I guess, is the opportunity down the line in the manufacturing context. What are you kind of hoping for there?
Yeah, so we realized a few years ago we could make an American-made robot that's easier to use, more affordable, and most importantly, capable of performing many more tasks than other robots out there. Most robots today, they have this rigid programming it's sort of like code, something that resembles code. And so we're focused on this new paradigm where you just demonstrate the task that you want the robot to perform, and then it can learn how to perform that from the demonstration autonomously.
So we're just showing some pictures of the technology we're talking about. We're not talking about humanoid robots. We're talking about cutting edge of robotic arms, essentially. Why is yours better than the rest? We've had some similar things on the show, Evan.
Yeah, I think we don't need to create legs and a torso to make a huge impact. So our approach is we make a device, and this device, it's sort of like scissors, but it can grip instead of cutting. And you can show how to assemble something, show how to prepare food, what have you. And it learns from that demonstration. And we think our approach with this device, it's a much quicker way to market than the humanoids, and it's going to make a really big impact. And we can take it to market this year. We already are with some really big customers.
Look, how hard is this? What sort of academic affiliations are you having to have? How much are you having to push forward innovation with the funding that you've got? Is this now about hiring talent? Is it about expanding here in New York? Yeah,
it's definitely hard. We've got an amazing team, so they really get all the credit. But we've hired from places like Cruise, Waymo, Rivian, Meta. So we've got the best of the best on the team. We really think this can make a really big impact in the world. So that drives our team, and it's a lot of fun too. So
I mean, spell out the mission here, because many who are working in manufacturing might be like, well, that's my job. So ultimately, what is the net positive outcome that you want from this business that drives all the people to want to leave Rivian and other key companies to come to you?
Yeah, actually, we have industry stats show over the next few years a shortage of 2 million workers. So it's not so much replacing jobs as we have this huge shortage. And we really think that most of the products we buy are not made in the US, or many of them aren't. And so if we can bring back manufacturing, that actually creates jobs. And it's better for national security. It's better for the environment to produce where we use the items. And these kind of productivity boosts, they really lower the cost of food and other items for people who can't afford them the most. So we think it's really important work. They can have a large positive impact. And there's a huge shortage right now in jobs, so I think people can rest assured.
I've listened to Jensen Huang talk about the biggest opportunities to be unlocked by what's happening in large language models, and robotics is front and center for him. What I find interesting is your scale and your location in New York. So talk to me about building the company, talent. Is the money you've raised enough? Walk us through the roadmap of the next couple of years.
Yeah, we're bringing this to market this year in a big way. Talent is I think this is like a really, really fun, other than being a TV anchor like you, Ed, this is one of the most fun things you can work on right now in tech. So it hasn't been that hard to attract amazing talent, and I think the mission-oriented focus of the company helps to attract amazing talent as well. But we're going to continue to need amazing people. We've doubled our team in the last 12 months. Our robot orders have gone up 20x in the last year. So we're really experiencing a lot of growth. We're trying to hire to handle the growth and the orders, and we're very excited about the future.
Evan Beard, CEO of Standard Bots. Great to have you on the show.
Thanks so much for having me.
Coming up, we're going to take a look at X's video ambitions and if their efforts have translated into anything tangible yet. This is Bloomberg Technology.
In global leadership are on Bloomberg.
We are 40 millions. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio. In global leadership are on Bloomberg.
I envisage not only some kind of a bridge towards membership or language linked to the irreversibility of Ukraine's membership in NATO, but also some kind of a broader package of military material, of financial aid. The more we support Ukraine right now, the sooner the war will end.
Nobody covers the top global leaders like Bloomberg Television and Radio.
We just want to turn our attention to what President Biden is saying on the platform X. Just a few moments ago, he's posted that 6 weeks ago, I laid out a comprehensive framework for how to achieve a ceasefire and bring hostages home. He's, of course, talking about Israel-Hamas. There's still work to do, and these are complex issues, but that framework is now agreed by both Israel and Hamas. And he says he's making progress. And interesting use, of course, of the social media platform.
Yeah, there's been a big development this morning with X and its relationship with the European Union. The European Union, or the Commission, has basically said that X is the first breacher of the Digital Services Act. I want to bring in Bloomberg's Kurt Wagner, who also has a column out today about X's video ambitions. But Kurt, you will have seen the ping pong on X in the last hour between Musk, Margaret Vestager, Thierry Breton. Explain what's happening, please.
Yeah, I actually haven't seen it this morning, Ed. I'm sorry but you know, obviously there's X is doing a lot with the check marks. That was the big issue that Musk started when he took over, that he was saying, hey, this is something that I'm going to charge for versus something I'm going to give away for free. I imagine, that there's some issues with how they're doling these things out to people. And obviously they'd run afoul of some EU regulations before, so it doesn't surprise me that they're running into this again.
Yeah, I mean, across the board, though, this is something that Elon Musk wants to be able to be bringing back brands, bringing back the talk of driving forward revenue and people's confidence. How is he doing that with video at the moment, Kurt?
Yeah. Well, you may remember that at CES a few months ago, they said that they were going to really push into this high-quality, professionally produced video shows. And they announced a bunch of partners, Don Lemon, Tulsi Gabbard, Jim Rome. And there was this big idea that X was going to sort of be like a second TV, right? You would watch these highly produced things on your phone. Well, 6 months later, a lot of this just hasn't materialized. We've talked about what happened with Don Lemon. That show's fizzled out. Tulsi Gabbard has not posted any shows yet. Jim Rome is posting shows, but I watched yesterday. There were no ads running alongside these shows. So it just feels like this big push, this big sell to rebrand X as this video destination, in my opinion, seems to really be struggling right now, 6 months into this process.
The question is eyeballs, right? So Elon Musk really emphasizes this data point of user seconds, how many seconds user eyeballs are on the platform. If you go to a tweet, you see the tweet views, and if you posted the video, you get separate data. Is there any confidence from advertisers that it is actually being watched if you put video content to the platform?
Yeah, I mean, this debate between views and, someone actually sitting there and consuming it has been a big issue for years, and not just on X, right? We've talked about this with Meta before, Instagram as well. And so I think the issue, and what I put in the column this morning, what I heard from a source, is that part of the reason these shows aren't really getting made is that they are having issues with advertiser demand, right? And if people are sitting there throwing money at you, those projects usually get made. But the fact that they're not seeing that interest from advertisers is sort of a sign that, the views probably aren't there, right? Because advertisers are going to want to go where they can get eyeballs. So I don't know the specific numbers behind this, but usually, Ed, as you know, if there's an audience, there are advertisers that want to reach them. And the fact that there's not that interest right now is sort of a telling sign.
How are things internally at X right now, Kurt?
Yeah, I mean, I think it's tough because there's a lot of cost cutting still going on. There was this big push, obviously, when Elon took over. There were a bunch of layoffs, a bunch of cost cuts. Things sort of settled down. But earlier this year, they brought back in Steve Davis, who was, the head of Boring Company. And he was sort of the guy who did the initial cost cuts when Elon took over. And he sort of re-looked at the books. There were some layoffs that happened again. So I do think that they're at this place where they're sort of still trying to level set the business. And, it's now been coming up on 2 years. It's not a super encouraging sign when they're still out there really slashing costs 2 years into this new venture.
Bloomberg's Kurt Wagner, thank you. And I apologize, I didn't mean to put you on the spot. Literally, since we've been on air, Elon Musk has been posting on X at EU officials. The short of the story is that Elon Musk's social media platform X has been hit with a warning from the EU for deceiving users into engaging with potentially harmful content, which prompted that little back and forth with Elon Musk himself on X. The bloc's regulators say they're worried that blue check marks for verified accounts are tricking users into believing these are safe when, quote, there is evidence of motivated malicious actors abusing the checkmark system. And I just say, Caro, I wrote to Linda Yaccarino this morning, along with some other staff at S, and offered them the opportunity to come on the show to respond to the EU's prelim warning, but no response.
Maybe by Monday. Meanwhile,
Maybe.
We've got a lot to pass over this weekend. You and I have got a pretty integral soccer/football match to watch. But for now, that does it for this edition of Bloomberg Technology.
The Euros and Copa America. I'm excited for Monday. It was a shorter week for us. We missed 2 days of shows because of Fed Chair Powell, but there was so much happening in the show. So recap on the podcast, you know exactly where to find it: Apple, Spotify, iHeart, and the Bloomberg platforms. Good luck to England for those of you that are supporting, and good luck to all the other teams playing this weekend. This is Bloomberg Technology.
See US crude futures briefly turn negative after rising by more than $1 a barrel earlier in the session.
The top names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself, actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. The top names in business are on Bloomberg.
One of the reasons why I'm frustrated, like many Americans, about our choices for president is neither is proposing to do anything about a coming debt crisis in our country. Our debt is already as large as our economy. It's going to go nowhere but twice as big as that. We have an entitlement problem, which is these entitlement programs are going bankrupt by the end of the decade. We have to get ahead of that. Otherwise, we're going to have a debt crisis in America.
Nobody covers business like Bloomberg. Context changes everything. The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything.
From New York City for our viewers worldwide, I'm Shonali Bassick, and Bloomberg Real Yield starts right now. Coming up, the data paints a mixed picture as PPI comes in slightly hotter than expected. After a soft CPI print bolstered bets in a big way on a September rate cut, and Treasuries erasing this year's declines as the traders weigh the Fed's next move. But we begin with the big issue, the road to September.
The economy looks as if it's slowing.
The CPI report.
It's a very welcome development.
A welcome surprise.
There was some normalization in some very abrupt moves that we saw in the May report.
That negative month-over-month print was a surprise for the market.
Inflation is a lagging indicator, of course. It's finally starting to catch down to developments in the economy and in the labor market.
On the PPI, the supply side simply isn't there to help what's happening on the demand destruction.
This Federal Reserve has been itching to cut rates. I think they'd be crazy to go in July.
They just need to be steady as they do this, because if they rush it, it's going to actually look like they're scared about something.
They will start to cut in September.
They should go in September.
The labor market looks as if it's coming back to normal. Inflation looks as if it's coming down. To me, this is a winning hand.
The data is going to be interesting to watch over the next couple months.
And I want to point out just how far we've come in just 11 days, because you were flirting with about 450 on the 10-year yield within that time frame at a high, and you've dropped roughly 30 basis points or more since then, firmly ending the week below 420 on that 10-year. Of course, the brunt of that move came first when you saw the labor market looking like it was weakening here with an unemployment rate rising, and then when you got the CPI data here, the consumer inflation print really coming in showing progress on inflation. And now you have people betting on duration at a faster speed. When you look at the MOVE index, what's interesting here is that you do have volatility in the bond market, but you do have that volatility now finally subsiding. You just saw levels that were more elevated than they've been since 2019, certainly. Remember, back then was the pandemic. We have gotten to that level of volatility in that bond index. But really, since 2023, we have started to see it come down. We've seen spikes of it this year, but the direction of travel, even for volatility, is starting to be lower. And this week in front of Congress, Fed Chair Jay Powell spoke about inflation and what the central bank needs to see before they start cutting.
We want to be more confident that inflation is moving on a path sustainably down to 2%, not at 2%, but on a path sustainably to 2%. That's the test we've articulated. I have some confidence, as I said earlier, that we are on a downward path. I think if you look at the data, it's pretty clear that, but we have not said, though, that we have sufficient confidence, and that will be a decision that our committee makes.
Joining us now, Marilyn Watson from BlackRock and Jonathan Mondillo from Aberdeen. And of course, we're going to talk about the big story is whether you see that September rate cut or not. But even more so, what kind of risk around there is it, Marilyn?
Yeah, so we have been thinking for a while that September is our base case. We think they'll probably tee things up potentially in July. We know that the Fed have been very, very data dependent, and the market, as you showed, has been incredibly volatile over recent months, particularly if you look at end of last year when the market was really pricing in steep cuts. Then this year they were even at some stage pricing in a hike. And now I think we have seen a lot more data. I think the Fed has been very, very patient. And now, with the labor market is still in a very strong, robust place, but it is softening. So the CPI and other data is coming down. And so in our view, we think, the Fed, is very well placed to, say, potentially cut in September and maybe once more again before the end of the year. And, July may be the point when they really start to indicate that.
What's interesting here, Jonathan, too, is you moved your expectation to September after you saw the CPI data, from my understanding. And do you still see risks around that September cut at this point?
I think it's pretty much priced into the markets at this point. To your point, I think headed into this week, we were not expecting such cool inflationary data coming out. So we did have a December 25 basis point cut. We've since moved that forward to September. And I would tend to agree that, I think July, the statements in and around the July meeting are going to be fairly dovish, and they're going to sort of lead into that September rate cut. I would also agree that obviously unemployment ticking up to 4.1%, statements made on Capitol Hill this week sort of couching things as being relatively balanced now with Fed Chairman Powell saying that one of the things that keeps him up at night is that labor market, rather than what we've heard over the last, let's say, 2 years where inflation was really front of mind. It's now shifted more balanced. So.
Well, do you think that 25 is enough, or do you believe that 50 will be achieved this year?
I think at this point, 25 is enough. We've seen a tick up in unemployment, but I still think that the labor market appears to be strong. Payroll numbers continue to come in rather strong, albeit not to the strength that we've seen over the last, say, 6 to 12 months. And unemployment is still low. Growth hasn't really fallen off a cliff either. This is sort of that Goldilocks scenario that we've talked about, that soft landing as they land the plane. I don't think that it necessitates over-engineering things or sort of big cuts at the front of this cut cycle.
Yeah, Marilyn, how do you feel here? Because we have a story out on the terminal that is being extremely well read. This idea that October Fed's funds futures began flying off the shelves yesterday. This idea that the supersized rate cut could be more in view. What is the risk to that kind of thinking?
I think given all the Fed communication we've had so far, and given the fact that they are, we think, in a very strong position to start to cut rates now, but they don't want to make a misstep, and they do, I think, want to be very gradual, and they certainly don't want to be in a position where they have to reverse anything. We think it's likely that they'll cut in 25 basis points in September and again in December. I think really when you look at the data that we've seen coming out recently, then the labour market remains pretty robust, but so there are more job openings now, and really the strength in the labour market really resides in the services sector still, and not so much in the goods sector, in the manufacturing sector. I think also when you do look at if you look at real rates, they're a lot tighter now than they were a few months ago, given the fact that inflation has come down quite considerably, and rates have been at a relatively elevated level by the last 10 years standards, at least, for some prolonged period of time. I think now actually rates look pretty tight.
Well, speaking of that too, you even have Barclays coming out recommending just today that you should short 5-year treasuries, citing election risk, and they say that the markets are pricing in too many cuts cumulatively, which is not consistent with the resilient economy and inflation risk following the U.S. election. Jonathan, have traders gone a little too far right now?
Yeah, absolutely. I mean, you look at the market pricing in 8 cuts by sort of December of next year. We think that it's a little bit overdone. And I think one of the things that you pointed out too, between the December and the September meeting, we do have a sort of a large headline risk with the election. We could get a change in policy, change in administration, and I think that's going to have an impact on the overall economy. And some of that could be rather swiftly with executive orders, et cetera.
You can make a ton of arguments here, right? That, whether you get Trump tariffs in the future or more spending under the Biden administration, that there are inflation risks. If you see that first cut in September, you were talking about caution from the Federal Reserve. What is the risk that 2025 doesn't see as many cuts as the market expects, or even staying stable towards having a hike?
So yes, at the moment, the market is pricing in around 150 basis points of cuts from now on. I think on its current trajectory, then we think it's likely that the Fed will continue to cut rates, but it will be very gradual, whether it's quarterly or it could be potentially a bit faster in the short term, but it may well be quarterly. But as you say, I mean, it's really a 2025 story when you have whichever administration we have. And then it will be, I think, it will have an impact on inflation. You might have a difference in, obviously, regulation, expenditure, taxation. And so I think from there, it is a little bit less clear in terms of certainly the path of inflation and also, the strength of the economy.
Where do you think the 10-year ends 2025?
So it's hard to tell, but I think we would argue that potentially it would end up lower than it is here today. So we do think that inflation will continue to come down for some time. We do think that the Fed will, at this trajectory, continue to cut. But as I say, it is nuanced and it is balanced. But I think potentially being around here or lower, we would see the base case.
Do you have a view on where the 10-year ends?
Yeah, I mean, I think personally, I think this rally's been a bit overdone. But I do think that, between now and September, we could absolutely see it continue, and we could see the 10-year with a 3 handle, if you will. I think once we get the election cycle over with, it's anybody's guess based on, who is enacting policy as a result of that. I still think we are north of 4% come year end, though.
Year-end 2025.
Correct.
But do you see, depending on which administration does take over, do you see an inflation risk greater in one or the other?
Yeah, I mean, I think a continuation of Biden in the White House would be more of a continuation of his policies that he put in place over the last 4 years. I think you continue to see sort of inflation subsiding, growth sort of muddling along 2.5%. I think the real risk to fixed income markets is probably a Trump presidency, where some of his tariff policy would be, in our view, very inflationary, and was going to put pressure on the Treasury market and fixed income yields overall.
Marilyn, leaving you the last word on the consumer. You saw that Michigan data come out this morning, and some concerns moving forward. What are the ripple effects of that?
So I think it's all a pattern of we are seeing the economy remain resilient, but it is definitely moderating. And I think we'll continue to see that feed through into the rest of the economy. The labour market, say, is cooling. We are seeing a cooling in consumer confidence. I think next week we get retail sales, which will be obviously another key one to look. But I think we do expect to continue to see the economy moderating somewhat. And for all these different reasons, I mean, our positioning in the US Treasuries are really, we like the front end still, sort of out to the 5-year part. There we think, you still get very decent carry, you get very good yield, and you don't have the volatility and the risk that you get further out the curve. So I think in terms of our positioning, we are long duration, but at the front end of the curve.
Fascinating. That is Marilyn Watson from BlackRock and Jonathan Mondillo from Aberdeen. Of course, a very busy week in the Treasury market this week, and more economic data for next week as well. Now, up next, the auction block. Saudi Aramco pulls in a massive order book for its auction. We're going to look at the credit markets next. Stick with us. This is Real Yield on Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
I'm Shonali Bassick, and this is Bloomberg Real Yield. It's time now for the auction block, where high-grade issuance picked up after tallying the slowest week of the year. Broadcom led the way with a $5 billion sale as it looks to refinance a portion of the loans it secured to pay for the VMware deal. Total overall U.S. sales passed more than $17 billion, and all but 3 of this week's sellers were based overseas. One other corporate sale that I want to highlight is Saudi Aramco. It pulled in more than $31 billion of orders for its $6 billion sale. It was the company's first dollar debt offering in 3 years and included 10, 30, and 40-year notes. And looking at this week's auctions of 3, 10, and 30-year treasuries, we saw mixed demand, with the 3-year auction drawing the highest bid to cover since January, while the 30-year saw the lowest ratio since November. And when it comes to credit, PIMCO is warning that the market returns are failing to compensate for the risks. The firm's CIO of Core Strategies wrote this week that liquidity premiums have compressed in both public and private credit markets, with lower quality segments of each facing elevated vulnerability to economic slowdowns and higher interest rates. This week on Bloomberg, Lauren Basmajian joined from Carlisle to speak about those risks in credit.
Default rates, there were all sorts of very high projections out there. We're at 1% as a market. That's much lower than long-term averages, which are between 2 and 3%, depending on the time frame you're looking at. I think the loan market is very bifurcated, though. So you could have, you see most of our companies that trade around par, meaning there's not really problems in those credits. And then you have about 4% of the market that trades under 80. And I'd watch that for more signs of stress. But again, that's the lowest it's been in 2 years.
Joining us now is Sinjan Bauran, Portfolio Manager and Head of High Yield and Leverage Loans at Beach Point Capital Management. And it is a really good time to talk about risk, because clearly there's more people in the market who are getting concerned about kind of these slowing economic conditions, weaknesses in the consumer. Where are you seeing stresses emerging even more now than perhaps we did a couple months ago when we last spoke?
Great. Hi, Shonali. Thanks for having me on. We would agree that stresses are starting to mount. The financial conditions which everyone was measuring and trying to price in when there will be, in fact, a change in monetary policy are good for a debate around what inflation will do and how economic activity will behave. But the leveraged credit markets are still having, technical tailwinds which have tightened valuations, and then they still have a tail of very levered issuers for whom 1, 2, perhaps even 3 rate cuts won't matter a lot in terms of how they will address their balance sheets. So that tail of the levered credit universe is one that we're watching.
Well, what does this mean for new issuance moving forward? If new companies are coming to market, the economy is weakening, do you think that there's going to be demand for leveraged credit?
Well, leverage credit overall still looks incredibly attractive. Spreads are indeed tight, probably in the 10th percentile historically, though yields and price are still quite attractive, and that coincides with an overall fundamental picture which is still holding in quite well. Leverage is manageable, interest rate coverage ratios are still very healthy within the leverage credit universe, and so there should be a persistent demand for credit in general. However, it stands to reason that when rates were raised, above 5% when inflation was running high single digits, now that inflation is around 3%, financial conditions continue to tighten. And each month of passing, and we'll soon hit the record for the longest Fed pause in history, that tends to transmit through to leverage credit, especially that lower tail, in negative ways.
Well, let's talk about high yield as well, because you kind of mentioned the valuation concern here just slightly. You're talking about yield, but you're also talking about that worry in spreads. And I think a lot of people in this market can't decide. Do valuations justify the risk you're taking on, and does the higher yield make up for it?
In general, yes, the higher yield does make up for it. On the lower end of the quality spectrum, there's not, it's underperformed its beta to the market historically. And so those return profiles, while attractive more recently, will probably start to tail off as financial conditions continue to tighten. This calls for greater security selection, greater care in terms of investment picking. But in general, that will likely turn into a very attractive market opportunity at some point.
One question I have is, where are the vultures? And the reason I ask this is because you do have S&P Global coming out earlier this month saying that U.S. corporate bankruptcies in June have reached the highest monthly level since early 2020, since the pandemic times. And so even if you're not seeing a wholesale swath of bankruptcies or the economy weakening drastically, you certainly are seeing pain, which a lot of people don't notice in a market that's been flying at record highs. So where is the distressed opportunity right now?
Well, it's a great question. Right now, defaults are indeed low, and we would anticipate that overall defaults will remain low given the overall health of the credit markets and strong fundamentals. Credits that do need capital and have had trouble accessing a regular way market for financing have turned to other more creative or aggressive ways. Some have turned to other asset classes. Some have resorted to what we call liability management, or LME, which sounds like a new term, but is actually as old as institutional credit itself. And we're seeing more and more of these transactions as companies and their sponsors try to address their near-term maturities.
No, it's interesting. One of the big areas of the market here that people are really questioning as well is private equity-backed credits, right? I mean, speaking of ways that people are kind of extending and trying to get past this era of maturing debt into a higher interest rate environment, you're seeing that very pronounced in the private equity industry. Would you bite on anything that they have to offer?
Well, right now, M&A transactions are extremely low. The volume's low. The multiples are about half of what they used to be in terms of what sponsors are willing to pay for assets. And importantly, the composition of debt is also low. And so all basically feeds into a very strong technical tailwind for leverage credit and high yield in particular. To the extent that more M&A is on the horizon, and particularly sponsor-driven deals in the form of LBOs, those potentially could be attractive given the parameters I just described in terms of having lower levels of debt and just building in a higher margin of safety to those types of transactions.
Just about a minute left here, St. John, but what is your favorite trade in this market?
Right now, given the events that have transpired over the past couple of days, we do think it's important to start introducing interest rate sensitive securities and instruments, or duration, into portfolios. We've lived through a year of this holding pattern within markets where duration and interest rate volatility have been headwinds to especially fixed rate securities within portfolios. We would expect that that will now turn to a tailwind. At the same time, it's important to have a healthy dose of floating rate securities as well, simply to gather that carry that those offer as we head into the next chapter of this rate cycle.
Must have your vegetables with a healthy dose of floating rates.
That's absolutely
Bowron
right.
from Beach Point Capital Management. We thank you so very much for your time today. Have a great weekend. Still ahead, though, the final spread. The week ahead earnings season is in full swing. We're going to talk about what's next. This is Real Yield on Bloomberg.
Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players. 3,184 hits, 431 home runs, and of course the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. Why are you doing this?
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
There's only one word, winning. You win on the court, you win off the court. And as you do that, you bring people along.
I'm Shonali Bassick, and this is Bloomberg Real Yield. It's time now for the final spread. The week ahead, a big one. Monday, Fed Chair Jay Powell speaking at the Economic Club of Washington with David Rubenstein. You can watch that live on Bloomberg. Plus, more big bank results continuing to roll out with Goldman Sachs reporting on Monday. And Tuesday, we'll get more economic data with U.S. retail sales and Morgan Stanley and Bank of America earnings, of course, very interest rate sensitive. Wednesday, the Fed is releasing its beige book. Thursday, an ECB decision and Christine Lagarde's news conference. Plus, Netflix kicks off tech earnings after the closing bell. Finally, Friday, Fed speak from John Williams and Raphael Bostic. For my final thought, let's take a look at all the companies reporting earnings next week because, of course, yes, we have a lot of banks. Goldman Sachs, Morgan Stanley, Bank of America, a lot of eyes on interest rates, but a lot of eyes on the consumer. Johnson & Johnson, United, really fascinating after what you saw with Delta this week. What is the consumer doing, particularly after you saw the weakness that you saw today in the University of Michigan data? American Express, I'm probably more interested in that than anything else to kick off the week, not just because it's at the end of the week, but also because that consumer is in hot focus. From New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome to Bloomberg Markets. I'm Scarlett Fu. We are roughly halfway through today's trading, so here is where things stand. You look at the S&P 500 and the NASDAQ 100, big cap stocks are in the green once again, with both these indexes resuming their July advances. They're recovering from yesterday's decline. But you look at the Russell 2000, small caps are extending yesterday's surge. Traders increasingly convinced the Federal Reserve will cut rates in September after today's decline in consumers' inflation expectations in the U-Michigan report and yesterday's CPI report, which are more than offsetting a somewhat hotter wholesale inflation print. Now, looking at dollar-yen, dollar weakness here because of the prospect of lower rates, and that's the case against most of the G10 currencies, in particular versus the Japanese yen. And let's take a look at what's happening here, because here's a 5-day chart of the pair, and you can see that the big drop in the dollar yesterday, right around the time that the CPI report was released at 8:30 a.m. Japan's government likely intervened right around then, with Bloomberg calculating it spent around $22 billion to support the Japanese yen. As for company news, earnings season is underway with the big banks publishing their results. JP Morgan announced the highest quarterly profit in the history of American banking. Its investment banking fees soared past analyst estimates, and equity trading revenue jumped 21%. But net interest income fell short of estimates, and expenses also climbed more than expected. Let's now look at Citi. All its major divisions saw revenue gains compared with last year. Quarterly revenue rose 38%, but Citi also warned that this year's costs are likely to be at the high end of its range. And looking at Wells Fargo, it posted its lowest quarterly net income in the past 2 years and also reported higher than expected costs, weighing on shares. So let's unpack all these results and find out what it says about results from Morgan Stanley and Goldman Sachs with Bloomberg Intelligence senior bank analyst Allison Williams. Allison, great to speak with you. Great to have you here in New York. Let's start with the bread and butter business of banking, which is lending, whether it's to consumers or businesses. That makes up the lion's share of business at all of these big banks. How does the bread and butter business look, that lending business, compared to the Wall Street businesses?
So, not great. I think that's where we saw the weakness at Wells Fargo this quarter. The big negative news is just that they're going to have less net interest income going forward. And part of that is that loans are coming in weaker than expected. So they came in weaker and they expect that to continue, especially on, as you said, sort of the bread and butter, which is the commercial business. Card is the business that continues to grow. So we're seeing good loan growth there. But we're also seeing banks setting aside provisions. Part of that is just you see growth, you see provisions. Yeah. But we are seeing some weakness at Citi. We are seeing, the specific area where we're seeing weakness tends to be a lower income bucket. So I think that is a concern. That's seasonally better in the second half, but I think some of the numbers there, don't give us the most comfort that that's going to improve. By contrast, as you said, capital markets really booming.
So that's the interesting thing, because certainly that's bounced back in the first half of 2024, but is it sustainable? Because at Citi and at Wells Fargo, fees were up year over year, but down quarter over quarter.
So there is a seasonality, and the seasonality starts the strongest in Q1 and ends the weakest in Q4. So there is a seasonal element to your point. But we have looked at trading, and it is resilient when you look at on a year-over-year basis. So some weakness quarter to quarter, but the equities markets are booming, and that's really helping the equity side of things. Prime brokerage has really helped. Credit trading also doing well. We're getting some help from the primary calendar, right? So investment banking fees are good, but that's also helping trading activity. And then the markets are good for the wealth and asset management business. That's, sort of just the math goes into higher assets, and then the hope is that also bring flows into it. On the fee side, there still is a lot of room for M&A and IPOs to get better. I think a lot of that will depend on the Fed in the second half.
All right, great stuff. Bloomberg Intelligence senior bank analyst Allison Williams taking us through the start of bank earnings season. Let's build on this discussion and now bring in Betsy Duke, who's worn a number of hats through her career. She's a former Fed governor, the former chair of Wells Fargo, and the former chair of the American Bankers Association. Betsy, it is so good to speak with you, and we're both wearing red, so we match. I want to start with banks in our conversation here. The Fed's rate hike campaign has been really good for the industry because higher rates increase their net interest income and their net interest margins. But the first quarter and second quarter numbers suggest we might have seen a peak in net interest income. Why is the industry no longer benefiting from persistently higher interest rates?
Well, you have a couple of things. You have different timing in the repricing. So when rates are moving very quickly in one direction or another, that's going to kind of scramble net interest income. But as rates begin to stabilize, then the balance sheet effects will begin to move. Assets will reprice to current rates and liabilities will reprice to current rates. So one of the things that the banks have had an issue with is how long it has taken them to get their deposit rates back up closer to market.
Yeah. What would the start then of a rate cutting cycle mean for the profitability of these banks' lending business, whether you're a big bank or perhaps a smaller bank?
I don't think right now you're looking at enough cutting to make a big difference one way or the other.
Okay. Yeah. I mean, and first we have to get to that cut, right?
Exactly.
Loan loss provisions at JP Morgan and Citigroup rose. Wells Fargo reported higher charge-offs, mainly due to commercial real estate charge-offs. What's your initial read right now on credit quality, given where we stand in the economy?
To be honest, I'm not watching I'm not watching any individual bank that closely, so it's hard for me to say.
Okay.
I think the credit quality generally is pretty good, and I don't really worry about the drag that office markets will have on bank earnings, because the loans for offices, while they're out there, they're not huge parts of any of the large bank portfolios anyway.
Okay, let's talk about one of your other hats, which is as a former Fed governor, and talk about inflation, because yesterday's cool CPI data sparked a massive rally in small caps. Today's UMichigan survey showed a drop in inflation expectations. We know that Chair Powell told Congress that Fed officials need to gain more confidence before cutting. Did these data points provide that confidence, do you think?
I think it's going to take a few more, but certainly every good data point provides a bit more confidence. If you looked at the confidence or the uncertainty that they had in their last projections, they were, at least half of them were pretty confident in their projections on growth and their projections on the unemployment rate. So they had confidence there. Where they didn't have confidence was in their projections on inflation. And the movement in those projections, I went back and looked, June of 2023, the projection was 2.6% on core PCE, dead on the last reading that we had. It came down to 2.4% in December. then went back up to 2.6 in March and 2.8 in June. And in June, only about 2 of the participants said that they had normal levels of uncertainty, and more than half of them said that they thought the risk was too higher inflation. So we've got time between now and September to get good solid readings at 2.6 PCE or better. And I think if you get those, that you will have a strong majority feeling comfortable in beginning to move on rates. I don't expect it to be teed up after the next meeting, but I would expect the door to be open to a rate decrease in September if the data continues to come in right around where it is now.
So they may not set the table for a September rate cut in July. So that puts the onus on whatever Jay Powell says at Jackson Hole, doesn't it?
I don't think he's going to make news at Jackson Hole on their intention. I think it has a lot more to do with how the readings come in, and I can't remember if they have 2 or 3 readings between that meeting and the September meeting, but that's what it's going to depend on.
Got it. Betsy Duke, really appreciate your joining us as always. Betsy Duke, a number of impressive titles in her past, including former Fed governor and former chair of Wells Fargo. And banks, by the way, can take some comfort in the rest of their prime brokerage business following the conviction of Bill Hwang of Archegos, according to Bloomberg Opinion's Paul Davies. We're going to discuss all of that with him later on in the program. But first, AT&T shares are down after the company was hit by a massive data breach. We're going to have all the details next for all you AT&T customers. This is Bloomberg.
In global leadership are on Bloomberg.
We are 40 millions. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
For years, people told me, why are you invested in Apple? Everybody talks about Apple. I actually think that sometimes because someone speaks a lot about something, it might be actually a good sign versus the overhyped sign.
This is Bloomberg Markets. I'm Scarlett Fu. It's time now for the stock of the hour, which is AT&T. It is lower after the company announced a massive hack of customer data. The breach included records of calls and texts for nearly all of its mobile phone users for a 6-month period in 2022. Joining us now is Bloomberg's Brody Ford. Brody, this happened 2 years ago, a year and a half to 2 years ago. How did we learn about this? Did AT&T make a big announcement, or was it kind of just under the radar?
Yeah, 6:30 this morning, checked the 8Ks on Friday, right? In a filing, they said that, hey, you know, nearly all of our customers' call data was revealed. And that's not like, you know, exactly what was said, but who called who and when, right? It's not hard to see how damaging this can be, right? Who called a lawmaker before a specific bill? Who called an executive before a decision was made? I mean, this is pretty sensitive stuff that, you know, a bit of a nightmare scenario as it relates to disclosure of information.
And now the FCC is looking into it, and you've got national security experts talking about how this is a breach, an undermining of U.S. national security.
Yeah, absolutely. Because again, like, think about the government use cases. I mean, journalists, right? Who called us before a big story went out? And what's interesting here is that with this AT&T hack, it's part of a larger campaign targeted at customers of Snowflake, right? A company where they help you store and analyze some of your most important data. We've seen folks like Ticketmaster, Neiman Marcus breached. And it's been this kind of like slow drip of customers impacted. They count many of the world's largest, most important corporations as customers. And so it's hard to not think, man, who else has been breached that we don't know about yet?
Do we have any idea who might have done this?
Yeah, I think it's currently unclear if this is exactly the same hackers that have breached the other folks. It is unclear exactly who they are. Researchers from cyber firms have said it appears to be folks in the US doing this. They have tried to extort folks for money. Right. I think they were requesting like $2 million from Ticketmaster to stop all the chaos. So it appears to be profit motivated at this point, but still, are they going to go sell that data to somebody who might use it for more nefarious purposes? Again, thinking about government security, it appears on the table.
All right, so nothing is off the table just yet, but clearly some bad actors at work. Bloomberg's Brody Ford, thank you so much for getting us the latest details on this. Speaking of bad actors, let's turn to today's big take, which focuses on the destruction of the undersea research cable off the coast of Norway that was destroyed back in 2021. Bloomberg investigated a worrying pattern of missing underwater cables. Our Jordan Robertson looked into whether Russia may be behind it.
In 2021, an unexplained incident occurred off the coast of Norway. An important undersea data cable had been damaged, and no one could explain why.
Something was obviously seriously wrong. Nothing worked anymore. No instruments, no sensors. Where the cable was supposed to be, there was no cable. You just see mayhem.
At the bottom of the world's oceans lie an essential network of data cables. They stretch hundreds of thousands of miles around the world.
Information flow, communications, banking system, financial communications. It's a vast network and it's extremely vulnerable.
Damage to any of them could be catastrophic.
It could spread a panic, disrupt the normal functioning of states.
In the last few years, there have actually been a whole series of incidents involving undersea cables. These may not be freak accidents. They may actually be a sign of something more sinister. Sabotage.
That was Bloomberg's Jordan Robertson, and you can catch the full story on Bloomberg.com, or you can listen to more of our reporting through the Big Take Daily podcast. This is Bloomberg.
From our world headquarters in New York, I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. The top names in global leadership are on Bloomberg.
I envisage not only some kind of a bridge towards membership or language linked to the irreversibility of Ukraine's membership in NATO, but also some kind of a broader package of military material, of financial aid. The more we support Ukraine right now, the sooner the war will end.
Nobody covers the top global leaders like Bloomberg Television and Radio.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This is Bloomberg Markets. I'm Scarlett Fu. Let's take stock of a big verdict this week that mesmerized Wall Street. Archegos founder Bill Hwang found guilty of criminal charges stemming from his firm's 2021 collapse that concluded a 2-month trial. Again, captivating Wall Street was responsible for the demise of Credit Suisse. Bloomberg's Sridhar Natarajan reported on the trial.
At 1 p.m. Eastern Time, get US Baker Hughes data, oil rig count, prior 479, and total rig count, prior 585.
Key stocks in the post-pandemic period that he really bet on. And when I say really bet on, he bet the entire house on it. He went from roughly $4 billion in assets to $36 billion in a span of just 6 months, and from $36 billion to zero in about 4 days. So it was one of the most extraordinary Wall Street stories. Here was someone who had made the boldest, most riskiest bets away from plain sight. No one really knew the scale or the size of his bets, and that was the big problem. Not even his banking counterparts, not even his partners in the banking industry who were helping him put on these bets. That was $36 billion of net assets. The entire wager, when you include the leverage, was $160 billion. That is an unfathomable amount, and the fact that you went from there to zero in a matter of days is an extraordinary story that we're not going to forget anytime soon.
I really like how you highlight the scale, because that's what gets everyone's attention. So let's bring in Bloomberg Opinion's Paul Davies, who's written about this. The title of his column, Archegos Couldn't Happen Again. Could it? Maybe it could. Paul, we heard from Sri about how the banks didn't know what was going on. What is the lesson here for banks, that Bill Hwang can be behind some of these big trades and build up these positions and be making these moves without his bankers knowing any the better?
Yeah, I mean, I think there's a couple of lessons. Partly having a counterparty like Bill Hwang is always going to be somewhat down to trust. Banks are never going to allow, other banks to look at their portfolios with certain big hedge fund investors. The hedge funds don't want it. The banks don't want it. It's too much kind of commercially sensitive information. There's going to be some better disclosure, I think, around some of these sorts of trades. But there's always the possibility that somebody will be able to con you. But I guess the thing is that luckily this is a very, very unusual case. It's very rare for somebody to, really be as, dishonest as they've been convicted of being about what positions they had with other counterparties, with other banks. And at the same time, as my colleague Matt Levine has written, his trades didn't even make any sense. It's like, what was the get out? Nobody can really quite understand where he was going with this. And if you can't make any sense of what someone is doing, then it's really hard to spot them.
So I want to preface this by saying I agree with 9 out of 10 things that Paul says. But the one thing I want to be careful about in this instance is, yes, a lot of what Bill Hwang was doing was a man taking on extreme risks and bending a pliant system to his will. But at the same time, we also have to acknowledge the fact that there was very clear Wall Street folly here. If I were to try and get $1 million mortgage at a bank down the street, I can't just go in and say, I make X amount, trust me, you don't need any proof. And here was someone who was giving them vague, verbal, evasive assurances, and the banks were happy to lend out billions and billions and billions of dollars in firepower. That is where I think the system broke down a little bit. It was, now that you see what happened in the trial, some of the documents that have come out, the ease with which the banks believed their client, to some extent wanted to believe him because they were making a lot of money off him and continued to fund his bets, that I think was a problem. And I think that has to change. Yes, you will never get to a place where you will have 100% visibility into what your client is doing across all their prime brokerage relationships, across all their counterparties. But you still would hope that the system will allow for these banks, allow for these counterparties to be able to ask more probing questions. You hope that's what the risk function does, and that's when you will force them to give more real, believable answers.
So it sounds like risk management did not do its job, Paul. These are transactions between sophisticated investors like Bill Hwang's fund, his family office, and sophisticated bankers. Both sides should be fully aware of the possibility of things going haywire, shouldn't they?
Yeah, no, absolutely. And Shri is dead right. I mean, some of these banks were really chasing this business in a very, unwise and even reckless way. I mean, you read the kind of the detailed independent lawyers report into what happened with Credit Suisse, which suffered the biggest loss at sort of more than $5 billion, I think it was, on these trades. And just the kind of the scale of just bad management and bad culture behind what went on at Credit Suisse in particular is just startling. But there were other banks equally who turned down Bill Hwang, who turned down Archegos. They came there looking for leverage and help and
at 1 p.m. Eastern Time, we get our US Baker Hughes data. Oil rig count prior 479 and total rig count prior 585.
You cover the big banks, you cover Goldman Sachs, you cover Morgan Stanley. How has the Archegos disaster and the blow up impacted the way they operate? I mean, do you see them doing things differently as a result of what happened here?
It's hard to get a full window into exactly what they're doing. It's fair to say that in the immediate aftermath of the collapse, obviously all risk management operations must have been on high alert. They were willing to look under every rock carefully. But the question is, as we get further away, now we're already 3 years past the Archegos collapse, and as we get further away from it, how long does this remain in your memory? And how quickly does the lure of new, promising, attractive fees ensure that this fades away in the rearview mirror?
Yeah, always good questions to pose, especially on during bank earnings season. Bloomberg Opinions, Paul Davies and Bloomberg News reporter Sridhar Natarajan on the Archegos lessons that banks may or may not learn moving forward. That does it for this hour of Bloomberg Markets. You can see we have green in equities right now with the S&P and the NASDAQ resuming their advance for this month. Yields coming down here on the 2-year and the 10-year, 4.19%. The latest University of Michigan Consumer Confidence Survey showed inflation expectations dropping down to a gain of 2.9%. That was encouraging following yesterday's cooler than anticipated CPI report. There's a lot more conviction behind the idea that the Federal Reserve may move forward with an interest rate cut as early as September. From New York, this is Bloomberg.
The top names in business are on Bloomberg.
One of the reasons why I'm frustrated, like many Americans, about our choices for president is neither is proposing to do anything about a coming debt crisis in our country. Our debt is already as large as our economy. It's going to go nowhere but twice as big as that. We have an entitlement problem, which is these entitlement programs are going bankrupt by the end of the decade. We have to get ahead of that. Otherwise, we're going to have a debt crisis in America.
Nobody covers business like Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution.
Shortly expecting the Baker Hughes numbers, I'll lead with the oil rig count.
We know the areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything. From the world of politics to the world of business, this is Balance of Power. Washington, D.C.
Joe Biden wraps the NATO summit in political limbo. Welcome to the fastest show in politics. As Democrats argue today over the president's performance, whether he should stay in this race, as world leaders leave Washington now and we prepare for the start of the Republican National Convention. I'm Joe Matthew alongside Kaylee Lines in Washington this day after the big news conference. Kaylee, we've got new polling out as well. Another national poll granted, and one that tends to be favorable to Joe Biden, showing this remaining a tied race.
Yeah, effectively. NPR, PBS, and Marist putting out fresh data, again, a national poll that shows Biden actually leading Trump 50% to 48%. That's in a head-to-head contest, though. And the thing is, when you add third parties in, it's Trump who's
The total rig count coming out first, 584, 584.
Incredibly close race, and if Joe Biden is to be believed, it is a race that he is staying in, despite more defections from within the Democratic Party.
Yeah, Republican analyst Lisa Camuso-Miller with us earlier on Bloomberg referred to a couple of weeks of grace that it appears his party might be giving him as we feel this out. We know Hakeem Jeffries, the House Democratic leader, met with Joe Biden and issued a letter saying that they had an honest talk as he continues to listen to his rank and file. What did we get? 3 more defections after the news conference last night?
Indeed, and one more this morning. Brittany Peterson of Colorado, making it 18 congressional Democrats who have now called for Biden to step aside. We'll talk later this hour.
And oil rig count 478, 478.
We'll also be joined by the Foreign Minister of Poland, Radek Sikorski, keeping in mind that Joe Biden, when he gave that press conference last night, well, very much addressing a domestic audience, was wrapping up the NATO summit that took place.
That's for sure. We have a lot to talk about when it comes to the takeaways for Ukraine and, frankly, Kaylee, the future of this alliance, whether Donald Trump will be in the White House and whether European political changes will impact that. Andreas Kluth, of Bloomberg Opinion, referred to this potentially as the peak moment for the alliance this week.
Wow, and what a moment we are marking. Let's get a check on the moments happening in financial markets today. Charlie Pellet has a look with up-to-date trading in New York. Hey, Charlie.
Oh, well, hello there, Kaylee. Good day to you both. Indeed, we are looking at records right now, not only on the S&P 500 index, also on the Dow Jones Industrial Average, NASDAQ pushing higher, and so is the Russell 2000, building on yesterday's surge, up another 1.2% on the Russell 2000. Right to the numbers, we've got the S&P at a record 56.35, up 50, up by 0.9%. The Dow also at a record right now, 40,105, up 352, up 0.9%. Just about the best level of the day. NASDAQ up 187, higher now by 1%. 10-year 4.19%, the 2-year 4.47%. Gold lower little change, down 75 cents the ounce to 24.14, while West Texas Intermediate crude 82.81 a barrel, up now by 0.2%, higher now by by 20 cents on WTI. Again, West Texas Intermediate crude 82.82 a barrel. Stocks ending the week on a positive note as the latest economic data reinforces bets that the Fed will be cutting rates in September. Unilever cutting a third of its office staff in Europe as the consumer goods giant pushes ahead with plans to slash 7,500 jobs worldwide. Unilever shares are up now by 1.9%. Bank earnings front and center today. Wells Fargo dropping 5.6% after earnings. JP Morgan Chase down 0.6% after earnings. And Citigroup shares lower now by 1.9%. So again, recapping here, records, perhaps the key takeaway right now with the S&P up 49, up 0.9%, a broad-based advance with the Russell 2000 index up now by 24 points. The Russell 2000 up by just about 1.1%. Balance of power continues now. Lots going on. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet with a look at the Friday trade. Thank you so much. Meanwhile, here in Washington on this Friday, it's the day after for President Biden, who seems to be stuck in some kind of political limbo after his news conference last night that by and large focused on foreign policy. He spoke at length about many topics, fielded questions about his age, and almost got through it without gaffing, but not entirely, as this happened in the very first answer he gave at the press conference.
What concerns do you have about Vice President Harris's ability to beat Donald Trump if she were at the top of the ticket?
Look, I wouldn't have picked Vice President Trump to be vice president.
He did have an earlier stumble in which he was introducing President Zelensky. He called him President Trump, quickly corrected himself. Sorry, Putin. Thank you.
We all do it.
See? I keep saying that. And that's part of the story here. And you wonder if these little gaffes that I can get away with on the air like I just did, and Joe Biden has for 40 years, are still part of the problem that we're talking about now when it comes to stamina, signs of aging. None of that is new for Joe Biden.
No.
And people who know him are kind of used to that. So when we try to delineate between what matters here and what doesn't, we look to the likes of Gregory Cordy, Bloomberg politics reporter, who's been knee-deep in all this stuff, including our own polling here. And Gregory, I just wonder, having had a chance to sleep on this, what your view is if Joe Biden's in the same place he was before he walked on stage last night.
Yeah, having slept on it, I kind of think that we're in the same place as we were last night, that he didn't necessarily win over any of the critics from within his own party who have asked him to step aside. But he didn't really do much additional damage either. There were 3 or 4 members of Congress who, after his press conference, did put in their calls and joined the chorus of Democrats asking him to step aside. But you kind of got the impression that those were prepared statements. They were just waiting on the press conference to put those out, and their minds had already been made up. So again, we just kind of have to watch in the coming days to see whether that drumbeat continues. It has been a steady drip, drip, drip over the past couple of weeks. But each time this question comes up to Joe Biden, he is steadfast. He is not getting out of this race. He does not believe that there's anybody who could do any better than him. He does not believe that he's going to lose to Donald Trump at this point. And the polling, as it continues to come in, I think we've seen a little bit of a floor. We've reached a point where the Biden trails probably by no more than 3 percentage points in the national polls, a little bit worse in some of the swing state polls. And so if the bleeding stops, maybe there's only upside as Biden world sees it. But again, we're going to have to wait for more data and more voices to weigh in.
Well, one voice did weigh in kind of today, Gregory, and that would be the House Democratic leader, Hakeem Jeffries, who put out a Dear Colleague letter saying that he met with President Biden yesterday. And to quote Leader Jeffries, in my conversation with Biden, I directly expressed the full breadth of insight, heartfelt perspectives, and conclusions about the path forward that the caucus has shared in our recent time together. What the leader did not say, Gregory, is I told Joe Biden I endorse his re-election run, that others within the caucus want him to stay in this race. How should we read between the lines here?
Yeah, what's really remarkable is that Democrats have given space to dissent within their own party, which is something that you don't see, by the way, on the Republican side. Remember, Donald Trump was indicted, went to trial, and was convicted on 34 felonies, and we heard nary a peep from anyone within the Republican Party that, you know, maybe there should be some consideration that that Trump should step aside for a new nominee. And so this is part of what makes the Democratic Party the Democratic Party. It's a little bit messier sometimes. And what I see in that Dear Colleague letter from Hakeem Jeffries is he's really representing the caucus here. He is trying to play the role of a sort of a good faith interlocutor between some of these critics and the White House, and to go to Biden and give him the full breadth of opinion from his caucus, all the way from he needs to get out right now to I'm a little bit worried, I'd like to see a little bit more strength in the president, to, on the other hand, I'm all in all the way to November. And you see that range of opinions within the Democratic caucuses in Congress.
Gregory Cordy, thank you for joining us. Gregory, reporting from Washington here this day after the news conference that, of course, ended the NATO summit. As we looked at Joe Biden at the podium last night, the big 75th anniversary emblem right in front of him. This is a big moment for the alliance. And there was more at play than just Joe Biden's acuity. And we're going to get into a lot of this now. As we heard from the president last evening, he spoke for roughly 1 hour, 59 minutes, and he was asked about what he was hearing, about his age, about his status politically here from world leaders at NATO. Here he is.
I'm not had any of my European allies come up to me and say, Joe, don't run. What I hear them say is, you've got to win. You can't let this guy come forward. He'd be a disaster. It'd be a disaster. I mean, I think he said in one of his rallies, don't hold me to this, recently, where NATO, I just learned about NATO, or something to that effect. Foreign policy has never been his strong point.
Joe Biden, of course, making those remarks as he wrapped up the 3-day NATO summit here in Washington. And joining us now is someone who is in town for that summit. The foreign minister of Poland, Radek Sikorski, is here with us in our Washington, D.C. studio. Minister, welcome back to Bloomberg. It's lovely to have you. I wonder what your perception of Joe Biden was, not just in the press conference last night, but over the course of your visit to Washington this week. Do you see a man not only capable of leading a country for another 4.5 years, but effectively leading the free world?
Look, I'm not interfering in your internal affairs. I can tell you that we had a summit with President Biden in March with our president, our prime minister. I was there. We had, I think, 90 minutes of conversation. President Biden was focused, strategic, and quite humorous, actually. Slip-ups happen. You know, I was just meeting with your journalist, and I made a slip-up, and I didn't correct myself. But we need America to lead, and President Biden is leading the effort on Ukraine, for which we are very grateful.
I just used the wrong name on the air before you came in. I did a slip up, and I do it all the time. We're trying to figure out what counts as a slip and what qualifies as deterioration. And I would ask you, you're not a doctor. We don't have to dwell on your view on that necessarily, but this is a very important moment for the alliance. We're talking about the potential for enormous change here domestically, politically, in the United States. There's a lot of noise around the president, as we already know, which could have been a bit of a distraction. But there's also great uncertainty about the trajectory of politics in a number of European nations, having seen elections in France, having seen a change in leadership in the UK. Some are calling this a peak for NATO, that it might not be the same following this moment. How does the alliance survive the uncertainty globally, politically now?
Well, let's unpick what you just said. There's change in the UK, but I am assured by the new government, and the foreign minister visited me at home in Poland on the 3rd day of his of him holding office, that Ukraine will be solid I mean, Britain will be solid on Ukraine, and Prime Minister Starmer reaffirmed that. In France, some people worried that the nationalist side of the politics will take over. That hasn't happened. Putin is constantly counting on our divisions and on our inefficiency, and he doesn't understand our psychology, and he doesn't understand that we are in it for the long haul. Look, as you said, I took part in the summit yesterday. I was impressed at how consistent and powerful and persuasive almost all the leaders of the alliance were in saying we are in it for the long run until Ukraine is a secure, independent nation. And we have some good decisions out of this summit, and President Biden is the author of these good decisions.
Well, we don't know that he'll be President Biden beyond January for...
Well, that's democracy for you.
Certainly. And even the president of Poland, President Duda, has told Joe and I that if it does turn out to be a second Donald Trump administration, he can work with Donald Trump. We hear it frequently from other diplomats such as yourself, a willingness to work with whomever. I guess my question is, do you really believe that Donald Trump will be as willing to work with you as President Biden?
We keep in touch with the administration and with the alternative administration, as we do with any other democracy. We have a cohabitation in Poland. The president is from a more Trumpian side of Polish politics, and he's kept in touch with President Trump all along, and we encourage him. I personally, of course, work with the administration, but I talk to President Trump's people, and some of the things that they tell me about what they plan to do are interesting and creative.
Not frightening.
Politics is a difficult business. Some of these things are very controversial. We were disappointed that the American supplemental took so long, but eventually the good thing happened. We hope that President Trump will want to be a winner, and a winner of...
Shortly expecting the results of the Fed reverse repo operation.
Fair peace in Ukraine, which means Ukraine enjoying its liberty.
Do you worry about the idea of redefining Article 5, as Donald Trump has suggested, based on the level of financial contribution? Is that a creative idea?
Well, he was right to insist that allies should spend more. And I publicly defended him.
And many have.
Even in style. Because when predecessors did it politely, it didn't work.
How about that?
Okay, so the combination of President Trump's and Joe Biden's pressure and the war in Ukraine resulted in the fact that 23 out of the 32 allies now spend 2% of GDP on defense. Poland spends 4%. And we are going to spend 5 next year. We are number 1 in NATO, including the United States, in proportion, obviously, because we are no longer in eternal post-Cold War peace. But to think about, so this is a good thing, and that was needed. But an alliance is not a neighborhood security company. Take Iceland, which is a NATO member. Which
73 counterparties take $406.59 billion at the Fed reverse repo operation.
Assets, its territory, its ability to refuel, to bring. When we rallied around the United States, when countries were spending under 2%, we sent first Poland, 1 brigade to Afghanistan, another brigade to Iraq. Others did the same. So the level of spending shouldn't be the only yardstick.
Just in our final moment with you, something else that came out of this summit was the labeling of China as a decisive enabler of Russia. Is quite hawkish toward China, as is Joe Biden for that matter. And I wonder if, to you, whatever the outcome of orienting more toward that adversary, leaving Europe to be the one who has to step up defense militarily against the threat of Russia?
Sequencing matters. If we enable Ukraine to win, to defend its independence and borders in the next couple of hours, then I think other theaters could become a priority, and actually helping Ukraine win I believe, would also moderate China's behavior. China is respecting our thickest red line, which is not to send arms to Russia, unlike Iran or North Korea. And yes, China could actually bring their vassal Putin to heel and tell him to end this war. And we are making these representations to the Chinese leadership, and I hope they act on them.
We've enjoyed staying in touch with you, and I hope that you'll continue to factor us into your plans when you return to Washington. Thank you for joining us on this NATO Summit Week. The Foreign Minister. Back with us on Bloomberg TV and radio, I'm Joe Matthew alongside Kaylee Lyons. With the summit in our rearview mirror, so too is the news conference that had so many people talking so much going into it. We now have the analysis coming out of it with Rick Davis and Jeannie Shanzano. Our signature panel is up next. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal?
Are markets too optimistic?
How do you worry about the things that are outside your control?
How does the current fighting completely stop?
I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
For years, people told me, why are you invested in Apple? Everybody talks about Apple. I actually think that sometimes because someone speaks a lot about something, it might be actually a good sign versus the overhyped sign.
In global leadership are on Bloomberg.
I envisage not only some kind of a bridge towards membership or language linked to the irreversibility of Ukraine's membership in NATO, but also some kind of a broader package of military material, of financial aid. The more we support Ukraine right now, the sooner the war will end.
Nobody covers the top global leaders like Bloomberg Television and Radio.
It's 1:21 on Wall Street. We do check markets all day long here at Bloomberg. We've got a rally underway on Wall Street. S&P 500 index trading at a record, could see the 38th record of the year at the close for the S&P 500 index. The Dow also at a record. The Dow right now at 40,148, up 393 points. That is a gain of 1%. The S&P also up 1%, while the NASDAQ Composite Index up now by 201 points, up 1.1%. The Russell 2000 2000 index of small cap shares building on yesterday's gains, with the Russell 2000 now up by 1.2%. 10-year yield at 4.19%, with a 2-year that's yielding 4.46%. Spot gold little changed at $24.15 the ounce, while West Texas Intermediate crude is down 0.1%, 82.52 for a barrel of WTI. Bottom line here, stocks hitting fresh records after this morning's economic data reinforced bets that the Fed will be cutting rates in September. Amazon's artificial intelligence shopping assistant, Rufus, is now available to all U.S. customers following 5 months of testing with a subset of consumers. Amazon shares little changed on the day, up less than 0.1%. Big banks in the red after this morning's earnings report from Wells Fargo, JP Morgan Chase, and Citigroup. Citigroup now down by 1.9%, JP Morgan Chase down 0.5. Hardest hit, though, Wells Fargo down now by 5.6%. Recapping stocks higher, S&P up by 1%, the Russell 2000 up another 1.2% with a 10-year 4.19%. Balance of power continues now. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet in New York, thank you so much. I'm Kaylee Lyons alongside Joe Matthew here in Washington, where for weeks, over 2 weeks to be exact, the conversation that has dominated all of political thought is whether or not Joe Biden is sticking it out and will become, next month, the Democratic nominee in this election cycle, as a growing number of Democrats have called for him to step aside. Now, 18 congressional Democrats, as of the last count, have done so. And the question is not just can Joe Biden stop the bleeding, but has there been too much bleeding already? This is something we spoke with Charlie Cook of the famed Cook Political Report about last night, just ahead of Biden's presser.
I think the president's lost control of events here. And, it's not really a question of whether, it's sort of when and how, and I think it's going to be pretty soon. It's just starting to tumble out of control, and I don't think there's any stopping it. I think, it's just a matter of days or hours or something.
Sounding a lot like Rick Davis to me. As we assembled our panel, Rick Davis and Jeannie Shanzano, Bloomberg Politics contributors, it was, Kaylee, the night of the debate when Rick sat with us at this table and essentially said that. Now that we have Jeannie Shanzano back in the fold this week, she too agrees that Joe Biden will eventually need to step down in this case. And I'll point you both. Welcome, Rick and Jeannie. Following a late night here on Bloomberg TV and radio, a Dear Colleague letter sent this morning by House Minority Leader Hakeem Jeffries. He met with the president. Says he expressed the full breadth of insight, heartfelt perspectives, and conclusions about the path forward that the caucus has shared in our recent time together. Jeannie, how difficult was that meeting for Joe Biden?
It had to be terribly difficult on both sides. I mean, imagine being the minority leader and having to share the number of people Kaylee was just talking about. And I was hearing, thinking back, Kaylee last night was saying a dozen, then it crept up to 15. Now it's at 18. It's not going in the right direction. And, I think it's important to put the context here, like Charlie Cook was talking about. This is an issue of a path forward. And I am really struck by this piece by Democrat Doug Sosnick, who is talking about the fact that Joe Biden's path to the presidency for a re-election has all but vanished, and Trump is the clear winner. And you go through the numbers that he's laying out, and again, this is a Democrat, and he says he's never seen such a grim electoral college landscape for Biden, and it gets worse from there. But the bottom line is, this predates the debate, which was horrifying enough. There's a reason that they wanted the debate in June, to stop the bleeding. And of course, as we all saw, it made it worse. And so he is in a position now when his path forward has become just one real path, and that is through the Rust Belt. That's why he's going to be in Michigan today. But it is a very narrow path for him, and opening up for Trump, exactly opposite of what the Democrats want and need.
Well, in addition to his trip to Michigan, we understand, based on a number of outlets reporting, that Biden's going to be meeting with a number of key groups on the Hill today as well, or at least virtually: the Congressional Hispanic Caucus, the Congressional Asian Pacific American Caucus, the New Dems. It seems that he is still trying to do this outreach, Rick, but is it too far gone, considering that the majority of those 18 that we have talked about who have publicly called for him to step aside generally are white. They aren't these coalitions of color that we know were key to Joe Biden's victory in 2020.
Yeah, it's really phenomenal. Rearguard action 1 month from your convention. It's amazing that we find ourselves in this position with an incumbent president. All the advantages of incumbency has vanished for Joe Biden. If anything, it's a burden. And he's carrying that burden around, frankly, a burden he can't lift. So this is really phenomenal. I mean, you got a guy who is struggling to prosecute a campaign against Donald Trump and has struggled all year with that, and now has the additional burden of having to backfill his support amongst core constituency groups. These are people who should be voting for Joe Biden 95% of the time. And he's using scarce resources, his time, campaign efforts to try and shore up his base a month before his party's convention. It's a phenomenally difficult position, one I have not seen in modern political history. This was, Ronald Reagan never had this problem. George Bush never had this problem. Bill Clinton never had this problem. I mean, there were people who had to firm up their base, but never to the degree where you spend a Friday afternoon after a NATO summit, basically begging, the various caucuses in Congress not to bolt on you. It's really shocking and historic. What we're seeing is the melting down of an entire party to the degree that Joe Biden can take them down with him. And that's why people are coming out publicly and saying, please reconsider, get out of the race, because they see the drag on the party writ large, not just his campaign. And that is even more important, that if Donald Trump is president, the congressional Democratic Party needs to be healthy.
This is all happening, of course, Rick, as MAGA packs up from Milwaukee. We've got a convention that starts on Monday. I suspect we could get some news this weekend, potentially, on a vice presidential pick. This whole convention is beginning to take form. Reports suggest Donald Trump Jr. will have a primetime speaking slot to introduce the VP, whoever that may be. He's good friends with a senator from Ohio. I know that much. The mayor of East Palestine, Ohio, Trent Conway, is going to be speaking. So, too, apparently, well, at least attending, will be Melania Trump. It's unclear if she's going to actually have a speaking role. Dana White, another name that we're hearing about. Jeannie, Joe Biden's going to be sitting down with Lester Holt, NBC News, on Monday. He's got travel plans throughout the week. Does he stick with them?
I think he absolutely should. He should be out as much as possible. My view is he should have been out before and after the debate performance in that way. I don't know that it is going to stem the tide. I do think it is very interesting to hear that Donald Trump Jr. is going to be introducing the VP nominee, which leads me to conclude, although I have no basis for this, that it won't be Marco Rubio, because, of course, Donald Trump Jr. has said that would be a choice to give Republicans in the Senate incentive to impeach his father so that they could get Marco Rubio in the seat. I mean, just shocking thing to say. But you've got to imagine that if Donald Trump Jr. is doing this introduction, that Marco Rubio may not be amongst the top three that we've been hearing about. I don't know, but that's my conclusion, hearing he's making that introduction.
Of course, we just still don't know. We don't know when we will find out. We do know the convention starts Monday. What we also don't know, Rick, is whether or not this ticket, Donald Trump and whoever, is actually going to be up against a Biden-Harris ticket, or if something could realistically change. We touched on this a bit during our special coverage last night, Rick, but how unusual is that? If you're the Trump campaign, you're attaching someone else to your ticket and not knowing that this is actually the ticket that is going to do as well against whomever if Biden doesn't become the nominee.
Yeah, it's kind of like running against a ghost. You really don't know who's going to walk through that door, come their convention. So, yeah, you just got to package the best you can. Look, they've sliced and diced the electorate that's available to vote for Trump, right? I mean, these are very slim margins that will determine this election. So, certain kinds of suburban voters, certain kinds of, young male blacks, certain kinds of Hispanic voters, and they've matched up the various contestants against those voting groups that are most likely to go for Trump in a competitive election. They may leave something out because the ticket may change, but this is a pretty well-defined election, regardless of who's at the top of the ticket, on the Democratic side. So they can be very confident that they're putting together a package that they think is the best, ticket to go forward and try to appeal to these constituencies. So I don't think they worry about it a lot. Frankly, they're probably high-fiving each other right now as they roll into Milwaukee, because they've got a situation where today, as we've been talking about, Joe Biden is spending more time trying to shore up his base than attack Donald Trump. And that's a good day for Donald Trump. Every single day that occurs between now and Election Day, that is the standard. It's advantage Trump.
Advantage Trump with some counter programming from Joe Biden. It'll be interesting to see what takes place next week. It'll all unfold right here on Bloomberg TV and radio. Both Rick and Jeannie are going to be traveling with us this weekend for special coverage that will last through the week. We're going to be meeting you back here noontime Monday from Milwaukee. Kaylee Lyons, myself, our signature panel, and we'll have special coverage on the nominating speech Thursday evening when we actually see Donald Trump on the stage. Rick and Jeannie, safe travels. We'll see you a little bit later on the late edition of Balance of Power, and of course again in Milwaukee on Monday. We're going to be talking, by the way, with a Democratic member of the House coming up. Let's go to the source here, and in this case, a Biden supporter. John Garamendi of California will join us after we check world and national news. For that, we turn to Nancy Lyons in the Bloomberg 99.1 newsroom in Washington. Hi, Nancy.
Thanks, Joe. President Biden will be looking to shore up support in the battleground state of Michigan today. He is holding a campaign event there this evening. He showed his strength on foreign policy last night, but still made a couple of gaffes during the hour-long news conference. Senator Jim Clyburn appeared on NBC's Today Show and says Biden has his full support.
I am all in. I'm riding with Biden no matter what direction he goes, no matter what method he takes. I'm with Joe Biden. And if he were to change his mind, I'll just answer the question that I would be all in for the vice president.
Senator Clyburn again was on the Today Show. Republicans, like Senator John Cornyn, says going with Kamala Harris at the top of the ticket would be like rearranging the deck chairs on the Titanic.
The polling that I've seen indicates that she's about as unpopular as President Biden, so I don't think she's exactly a powerhouse alternative.
Cornyn says Harris has been the administration's point person on the southern border, which would likely doom her campaign. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
In tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself, actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV.
US Treasury 2-year yield hits the lowest since early March, last down 4.1 basis points at 4.4661%.
Ways of making a living without destroying their environment, conservation won't work.
The top names in business are on Bloomberg.
One of the reasons why I'm frustrated, like many Americans, about our choices for president is neither is proposing to do anything about a coming debt crisis in our country. Our debt is already as large as our economy. It's going to go nowhere but twice as big as that. We have an entitlement problem, which is these entitlement programs are going bankrupt by the end of the decade. We have to get ahead of that. Otherwise, we're going to have a debt crisis in America.
Nobody covers business like Bloomberg. Context changes everything. The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks continue to push higher. We're looking at records right now on the Dow, the S&P 500 index, and right now we have got NASDAQ advancing, no record, but right now higher by 237 points, up 1.3%. S&P, by the way, on track for its 38th record so far this year. NASDAQ 100 index up now by 1.3%. Perhaps the bigger story is the broadening of this market with the Russell 2000 index continuing to advance, up now for a second day. That's on top of yesterday's 3.6% gain. Right now we have got the Russell 2000 index of small cap shares up by 1.3%. Bottom line, records for the Dow and a record for the S&P 500 index. The 10-year after this morning's PPI data, 4.18%. The 2-year, 4.46%. Gold up $1 the ounce to $24.16. Little change there. West Texas Intermediate crude down 0.3%, 82.36 a barrel on WTI. Novo Nordisk's Ozempic drug is being linked to lower rates of dementia and a range of other mental problems in a University of Oxford study that raises expectations about the diabetes drug's potential ancillary benefits. Novo Nordisk up today by 1.9%. Again, recapping, we got stocks higher. S&P up 62, now at 56.47, a gain of 1.1%. Balance of Power continues now back. We go to Washington once again. Your hosts, Joe Matthew and Kaylee Lyons.
Okay, Charlie, thank you. Charlie Pellet helping us through the Friday session here on Balance of Power with our eyes on politics on Bloomberg TV and radio. Indeed, Kaylee Lyons with us from Washington as we read the Dear Colleague letter from Hakeem Jeffries, who met with Joe Biden last night. and pretty clear that this probably was not a very fun meeting, as he expressed in his words the full breadth of insight, heartfelt perspectives, and conclusions about the path forward that the caucus has shared in our recent time together. He did not call on Joe Biden to withdraw from the race. And Kayleigh, he's said repeatedly, including at the podium yesterday, that he is not going to betray the trust of his members as long as this conversation is ongoing. He's going to essentially remain on the sidelines as he's dealing with a couple of different factions. And by the way, the faction calling for Joe Biden to step down remains pretty small.
Yeah.
At a 213, we're still not even at 20.
No, only 18 congressional Democrats have called for Joe Biden to leave the race, at least publicly. The question is, what is the true nature of the conversations that are happening behind closed doors and within the family, as the Democratic leader was alluding to in that letter?
Yes, absolutely. We have to acknowledge, though, that there were reports, including some here at Bloomberg, that a letter could be sent today following the NATO summit with dozens of Democratic House members on it. And Kayleigh, we have not seen that yet.
No, we haven't. And we have a lot of questions for the Democrats in the House that we haven't heard call for Joe Biden to resign, including the one we're speaking to next. I'm pleased to say joining us is Congressman John Garamendi, the Democrat from California. Sir, welcome back to Bloomberg. Always lovely to have you on Balance of Power. First, we'd like to wish you well, as you've shared this week that you have been diagnosed with cancer. How are you feeling?
Excellent. Ready to go. Just have to be away from people to avoid getting an infection. But I'm in great health, and we're going to whip this thing in the next 3 to 5 months. The really good news is extraordinary progress has been made dealing with multiple myeloma as well as others. And guess what? Using the president's words, guess what? Remember the Biden moonshot? It is one of the ways in which the research is helping me. So thank you, Joe Biden.
Well, that's remarkable to hear. Congressman, you've been on our minds as a frequent voice here on Bloomberg TV and radio, and we appreciate you sharing that with us. And we do hope that you're well, because we're having a difficult conversation about aging right now in Washington. Yep. You are supporting Joe Biden through this time, and I wonder if you can explain to our viewers and listeners why, because we're hearing from voices, Congressman, every day telling us that it's already over.
Well, it is not over at all. In fact, anybody that's been paying attention and not listening to the feeding frenzy would realize, yes, Joe Biden had a very bad debate, no doubt about it. However, Donald Trump had a worse debate. He refused to answer any questions, lied repeatedly, as is his tendency to do that. Remember during his 4 years in office, 30,000 lies? Well, he added up a few more during that debate. The fact of the matter is, after that debate, the president has been very, very strong, both on the stump, ad-libbing, off of the teleprompter, absolutely strong, and 3 days with NATO leaders. We're talking about an assembly of more than 25 NATO leaders that worked with the president over the previous 3 days, and then the press conference yesterday. If you were looking for problems in the press conference, hey, you found 2 flubs. Big deal. We'll undoubtedly have a flub or 2 of my own on this, and maybe even 1 or 2 of yours. But the reality is he went through an entire litany of international affairs, from China to Russia, the Philippines, the Pacific, and NATO. He did all of that in depth and proving that he's on top of the issues, including the domestic issues. So what's the problem here? The problem here is a bad debate and a whole bunch of willy-nillys that are scared to death of their own shadow. We have a very seasoned president that can carry on. Can he do it for 4 years? Tell you and I, are we going to be around for 4 years? We never know the day. But we do know that we have a great team, because we have a vice president that is ready to go should it ever be necessary.
Well, Congressman, I appreciate what you're saying about the debate being a singular bad night. Certainly, that is what we have heard from the president. The fact is, though, polling has showed and has done consistently that the vast majority of Americans just think President Biden is too old to serve. Many more than think the same about Donald Trump, who is just 3 years younger. And I wonder if it's a question of whether these all need to be mutually exclusive. Is it not possible that President Biden could have the chops on foreign policy, could be an honest, good man, as clearly you believe him to be, and still not be the best person to beat Donald Trump in November?
No, that's incorrect. What we have is a president that over the previous 3.5 years has proven that he's on top of all of the issues, including this week. This is not something that is new for him. This week, dealing with the heads of state, NATO heads of state, he proved to them and anybody that cared to listen to what the outcome of that meeting was, he proved that he is on top of the issue and that he is the leader for the free world. Bottom line, he proved that to all of those heads of state that attended the NATO conference. That's this week. Now, going forward, he's also shown that he can handle the press. He did that with skill, with determination, and with a great deal of insight and information. For more than an hour, he stood. Now, just 3 weeks ago, we had the White House picnic. We're talking about 90-degree heat. We're talking about Republicans with their families, Democrats with their families, lined up to greet the president. And he worked that rope line for more than an hour and a half. And those that were last in line got the same effort, the same energy, the same greeting that those that were first in line. This man can do it, and he has shown it. What he has not been able to overcome is the feeding frenzy. But that will also happen in the days ahead as he continues, probably in the next couple of hours, in Michigan. Once again, showing anybody that cares to listen and honestly evaluate that he is capable, that he's on the game. Now, what is not being considered is that he has a team. Not only his staff, but he has a vice president who has been with him for 3.5 years now, and has proven herself to be very capable. International affairs, international travel, understanding the world around her, understanding domestic, and importantly, pointing out that Trump will take away the fundamental rights that women once had before Trump put into office the most conservative Supreme Court perhaps in the history of America. That's what Trump did. And Kamala Harris is out there pointing out to the world and pointing out to American women, beware. Beware of another 4 years of Trump, because Project 2025 has clearly stated that they're going to take away nationally the right to women's health care.
Well, and that's something that Joe Biden's talking about today in Detroit is 2025. You mentioned Kamala Harris, obviously from California. A lot of folks are looking at the vice president now for obvious reasons, Congressman. You can speak to her veracity as a candidate, but I have to ask you, and I wouldn't say this, wouldn't ask this of just anyone, but if we're being honest here, you're right in the middle of these two guys when it comes to age. Donald Trump is 78, Joe Biden is 81. And this has been compared, this idea of a cognitive test, to taking away the car keys from an older member of your family. And I think a lot of people can relate with how complicated and difficult that is.
Wait a minute.
Do you think that both of these candidates should agree to a cognitive test? What's good for one is good for the other.
If there's going to be a cognitive test, let's not have a kindergarten cognitive test, which is what Trump continually talks about. If there's going to be a cognitive test, yes, both should. But I would like to see Donald Trump stand in front of the international press corps as Biden did yesterday and answered the questions, answered the detailed questions about international relationships, detailed questions about national security. And I'd like him also to explain to the international press why he spent 4 years as president, basically tearing apart NATO and handing the keys to Putin. And I remember the press conference in Helsinki. I remember what happened there. And all of us, now that we have Russia invading Ukraine, all of us should be aware of what's going on. And oh, by the way, who did Trump meet with yesterday in Mar-a-Lago? He met with Orban. Who did Orban meet with a week ago? Putin. Isn't it interesting that Orban meets with Putin and then meets with Trump? What are those two guys dealing with right now? What are they up to? What do we have to look forward to? Oh, I remember very well what happened to Jimmy Carter when Reagan and his troops cut a deal with the Iran Ayatollah and leaving Jimmy Carter to hang out there. And what happened 3 months after Reagan became president? Yeah, we had the Iran-Contra deal. That's what we had. So what is Trump up to? What is Orban up to? You need to ask those questions of those two characters. And by the way, you and I saw Biden immediately as the run-up to the Ukraine war, rallying the support for Ukraine, rallying NATO, putting NATO back together again, and adding Finland and Sweden. That is what the President of the United States did during his tenure. Can he carry on? He gave every indication yesterday that he can. And if somewhere along the way, and every single one of us is subject to this, whether you are Kamala Harris's age, or whether you're your age or you're 17 years of age, we don't know when our day will arrive. But should it arrive, should it ever arrive, for the very best quarterback that we could put on the field in the run-up to the most important political Super Bowl of all, that would be Biden. But if he can't carry on for whatever reason, then we have Harris. And I've worked with Harris since 1992, when she was the district attorney for San Francisco. We were going after bad guys then, as insurance commissioner and as city attorney. She is competent, capable, smart, and she's not going to be pushed around. And she is out there campaigning today on behalf of American women. So let's look at this. We have a team. We have a great quarterback.
Yeah.
Proven quarterback.
We're just about out of time,
just this
Congressman.
past day. I know I'm going to have to shut this down, but I've only begun to push for Biden and what we need to do.
He's closing the place today. Congressman John Garamendi, thank you, Congressman, for answering our questions. We only ever wish we had more time. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well, because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
And a very good afternoon, everybody. Happy Friday, live on Bloomberg Radio, TV, YouTube, and Bloomberg Originals. This is Bloomberg Business Week. Carol Masser along with Tim Stenivek. Back from Seattle in New York, and we brought the Green Festival to Wall Street because there's a lot of green on Wall Street.
On the screen. A broad-based equity rally, Carol, the S&P 500 hitting an intraday high, on track for its 38th, count it, record close this year.
Unbelievable. You've got about 90% of the names in the S&P 500 or higher. The 11 major industry groups in the S&P, they are all gaining ground today. So we are pretty much at our best levels of the session. Having said that, a lot of it has to do with expectations that the Fed is on track to cut rates come September. So it's really been a change in the U.S. rate narrative, I feel like, again this week. We're going to dig into the trade and that narrative in just a moment.
Yeah, plus we're all in on bank earnings this afternoon. JP Morgan, Citi, Wells Fargo, the quarterly reviews, and the broader commentary, plus a look ahead to next week, which includes Goldman Sachs.
Yeah, a lot of names. I always care what Jamie Dimon, and I think the street does, has to say. So we'll get into that. Then we're going to take a look at EVs. They're on the move today. We're going to get into Rivian, what is going on with that, kind of the Tesla haters, maybe finding an option in Rivian. It's a great Business Week story. That anti-Tesla crowd apparently finding some opportunities. But what is the Rivian business model going forward? We're going to tackle that.
And Carol and I were tuning into that press conference as we were flying back from Seattle last night. A high-stakes moment for President Biden, another one coming up on Monday. We're going to check in with the team in D.C. about what we have to watch for.
And one more thing. Hey, all you flex workers, we've got a home for you. It's on the French Riviera. So we're going to get into that in just a moment.
Sounds good.
All right. Yeah, let's get there. All right, let's get to the trade and your top business stories. Here is Charlie Pellet.
Lots going on with this U.S. stock market as we head toward the closing bell. 2 hours away right now. About 90% of stocks in the S&P 500 index are trading higher. Not just higher. In fact, we're looking at a record right now. As Carol mentioned, will be number 38 of the year. Right now, we got the S&P at 5650. That is a gain of 1.2%. Right to the numbers here. The Dow surging, also at a record up 445, up right now by 1.1%. The NASDAQ Composite Index up 255. That is a gain right now of 1.4%. Your 10-year, 4.18%. The 2-year at 4.46%. Cannot ignore, by the way, the Russell 2000 up again today, building on yesterday's 3.6% advance, up another 1.2%. The 10-year, as I mentioned, 4.18%. Spot gold up $1.86. Little change there, up just about 0.1%, 24.17 the ounce. And West Texas Intermediate crude lower now by 0.1%, 82.48 for a barrel of WTI. Bottom line here, stocks trading at records, number 38 of the year potentially for the S&P 500 index. Banks, however, in the red after earnings reports this morning. Our Sonali Basik's going to have a whole lot more on the banks coming up for you in just a moment. But Wells Fargo down now by 5.9%. JP Morgan Chase down 1%. Citigroup after earnings down now by 2.1%. Recapping, Russell 2000 surging again today, up another 1.2%. 10-year 4.18%. The Dow, NASDAQ, Dow and S&P both at records. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You mentioned the big banks, and you're right. Sonali's here. Earnings season, folks, officially underway. 3 of the big ones already reporting. JP Morgan Chase, Citigroup, and Wells Fargo. They were out this morning before the open. A bit of a mixed bag on what some would say maybe is a bit of a tough backdrop. I'm looking at the stocks. Citi is down 2%, Tim, as we speak. JP Morgan just a little bit lower, down about 1% or just shy. But Wells Fargo really taking the hit. The biggest on a percentage basis, down about 6%.
Yeah, 3 of my decliners that you just mentioned just now, certainly. Hey, all 3 sold off earlier in the session. You just heard from Carol the latest and Charlie when it came to those numbers. With our bank earnings roundup, with us is Bloomberg News global finance correspondent Sonali Basak. She's here in our Bloomberg studio. Also, Cheryl Pate, senior portfolio manager at Angel Oak Capital, joins us as well. Cheryl joins us from Atlanta. Okay, Sonali, the good, the bad, the mixed, the results from the 3. Give us the highlights.
Wow. So the good news is that you did see a tick upward, for example, in investment banking fees at a lot of places. JP Morgan, that was 50% higher. The bad news is that, for example, at Wells Fargo, you saw weakness compared to what was expected in net interest income.
We knew that was coming, though.
Yes, but the thing here is you did see, interestingly, yesterday, for example, when the CPI print was released and you saw that sharp move lower in yields, you actually saw the biggest U.S. banks sell off and the regional banks rally. And the reason you saw that was because even though you're seeing rates potentially come down, I think there's a massive question on what does this mean for that mix that banks have. What happens to the deposits, but also what happens to the money that's being made from the loans that are being put out. Remember, we're looking at consumers with tons of credit card debt right now. You're seeing charge-offs starting to rise. Provisions for loan losses were higher than expected at JP Morgan, Fortress JP Morgan. It's not that people are really worried about, the health of JP Morgan. What they're more worried about is, okay, well, what does this say about the propensity of consumers to both take on more debt and pay that debt back?
Right, exactly. So is there So is it mixed, do you say, in general, or is there any trend overall takeaway?
Well, think about it. All the big stocks are lower today after earnings, and not by a really small margin. They had a really significant run-off into this moment. You've seen JP Morgan, Wells both up more than 20%, Citigroup almost 30%. Citigroup still trading at around 66% or so of book value, maybe a little less right now. But, the setup was pretty good going into this. The future is super uncertain.
Yeah, that's fair. I think that is so fair. Let's get to Cheryl. Cheryl, come on in on the conversation, listening to Sonali, who is usually up, at the wee hours and breaking it down and sending us all messages about the results. What's your takeaway about the three big banks that reported today?
Yeah, no, I think it's a similar perspective here. I really think a lot of the reaction today really hinges on the forward guidance. And I think, there may have been some expectations that there may have been some upside to some of the guidance. The fact that JP Morgan reiterated, I think, was a little disappointing. And then, Wells on the other side guiding to the high end in terms of NIM compression or NII compression certainly was disappointing. So we've been focused on guidance, on NIM, and on credit. And I think that the question mark really is on the forward guidance, and we didn't get a lot there.
Sonali, Jamie Dimon, we always listen when he speaks, whether it's a letter to investors, an annual report, or an earnings call. Commentary from Jamie Dimon, anything of note?
He wasn't there today. He was out celebrating the bank's 100th anniversary in Germany. He was in Frankfurt.
Is that notable?
It's interesting. When Jamie Dimon sneezes, everybody catches a cold, right?
Is that what happened to me? Is that why my voice
If
is
he
like
doesn't
this?
sound like Tim Stenovic, a deeper Tim Stenovic, it is Tim Stenovic.
People want to look for a deeper meaning. You look at Morgan Stanley, for example, and just kind of how sluggish the stock has been relative to the other banks. Given that there has been a big change in leadership there, so much confidence in James Gorman, people are looking for direction from Ted Pick and who he is as a leader.
Yeah.
And if Jamie Dimon were to step down, then the same questions arise for JP Morgan, perhaps on a bigger scale. So people do look for direction, but perhaps, like many leaders are doing right now, giving deputies time to breathe and make their mark is prudent coming into the next cycle.
So, Sonali, is that another sign that you know where I'm going with this?
You can't read into things, though. That's the thing.
We can't read into this?
I don't think so. He steps down when he steps down.
He does, but he's also made some moves in the past few months about potential successors, and
But
also
I've got to say,
talked for the first time.
For 10 years, man, this guy has been making moves.
But didn't he say something different a few months ago?
He said that, that 5 years, 5 years, 5 years thing that he always said, that has gone away. The horizon is certainly smaller.
Okay.
The bigger question for me is, are his deputies ready? Is Jen Pipsack ready? She's the one that people are watching the most.
Some would say he's being, maybe really responsible as a leader to make sure that bench is ready to take over. I want to bring Cheryl back in. You're hearing us talk about Jamie Dimon, and we know there's more than JP Morgan, but we do focus on it. What is your thinking about the outlook for this company, and then kind of who takes over and when they take over from Jamie Dimon?
Yeah, I think that's been a question for a number of years, clearly, as some of the commentary already. Look, I think this was a good opportunity to have some more people in the forefront, and I think it was done well on the conference call today. Timing, I think, is still uncertain, and perhaps maybe it's dependent on where we go from an economic perspective here too. The data now is somewhat supportive of moving towards rate cuts and hopefully a soft landing, no landing type scenario, which may be more opportune than a more hard landing scenario.
Cheryl, I want to shift gears to Citi a little bit. Citi's down 2%. It's off its lows of the day, down 3.6% at its lows today. Citi warning that costs likely to be at the high end of the forecast. What was your takeaway on Citi? What do we need to know about Jane Fraser and her team and what they're doing? And as Sonali mentioned, this is another one up 25% so far this year.
Yeah, no, I think the execution so far has been good on the restructuring plan, and we are positive on the name for that reason. I think this loops into the forward guidance, and expenses have been troublesome for the whole sector for some time, and moving to the higher end of the range again here, I think puts more uncertainty onto the forward look. I think more of what will drive Citi looking forward, though, is going to be execution on restructuring and also working to deploy some of that excess capital. And I thought the buyback commentary was helpful from that perspective today.
Cheryl, what is your favorite choice among the banks and why?
I think today we would say JP Morgan would be our top pick. We do like the large cap banks generally, given more diversification. We clearly saw that come through in the capital markets revenue. And I think, JP Morgan was the standout winner there today. But also in case of looking towards any wobbles in credit going forward, the prudence, the fortress balance sheet concept, I think really stands the test of time in a more difficult environment. So that's, where we would put our top pick today.
Hey, just to wrap up, guys, just got about 60 seconds. Cheryl, let me start with you, and then we'll go to Sonali. Next week, Goldman Sachs, Bank of America. What is on your radar, Cheryl?
I think we're mostly watching for credit, particularly from Bank of America, and then starting to get in some of the regional banks. We've clearly been concerned about commercial real estate exposure, but also some weakening in the consumer side. I think we were encouraged today with the comments from JP Morgan on credit card and also Citi that it's just regular sort of normal course normalization, seasoning of vintages. But I think that'll be important to see out of Bank of America. And then, the Goldmans and Morgans of the world, clearly it's been a good quarter for capital markets, particularly strong investment banking revenues and equity trading.
Sonali, very briefly, next week, Bank of America, what are you looking for in Goldman Sachs?
In addition to what Cheryl was saying about credit quality, I'm also watching for trading because if you saw fixed income coming in a little light at JP Morgan and even Citigroup, that's a big, big, big business for Goldman Sachs. They have been leaning in on prime brokerage. And of course, Morgan Stanley equities trading as well was a huge bright spot this quarter so far. Let's see how that competition plays out.
All right, great setup of what's going on today and then, of course, into next week. Sonali Bostic, thank you so much. As always, we always appreciate your input and the research you send us.
Pre-5 a.m. arrival this morning.
I know. This kid doesn't sleep. Yeah. Global finance correspondent at Bloomberg News. And Cheryl Pate, our thanks to you as well in the analysis. Senior portfolio manager at Angel Oak Capital Advisors there in Atlanta. The KBW Bank Index, little change. And actually, most of the names are higher in today's session.
Okay, so now to our other big focus this week, and that was two prints on inflation. Fed Chair Jay Powell updating U.S. lawmakers on the economy and monetary policy, and then how it all played out in moves along the Treasury curve. Carol, safe to say, a reset on rates again, which makes us wonder, have we topped out?
Yeah, it's a great question, and we've got a great person to answer it. Back with us is Bloomberg News rates reporter Michael McKenzie. He's out there in New Jersey. All right, Michael, another inflation print today. We had one yesterday. We definitely did see the Treasury curve move. How are you kind of adding it all together? Have we topped out when it comes to some of the levels that we've seen on the Treasury curve?
I think that's a pretty reasonable conclusion to draw, Carol. I think some of the rally you're now seeing this week has actually, one investor described to me as a bit of FOMO. People who missed the top in yield back in April when we were around 475, for example, in 5 years, are now having to buy because the data is slowing and the inflation print we got yesterday on CPI was really important because there was a bit of anxiety going into that. But the fact that it came below expectations, the fact that it shows that the Fed has probably done enough here in terms of tightening interest rate policy since 2022, that they are going to win the fight on inflation and they are going to get it closer towards that 2% target. And I think you're now going to get the market beginning. We've seen some big trades go through Fed funds futures today where people are beginning to speculate on whether the Fed will go 50 in September. I think that's not on the table at all at the moment. But it is interesting to see when you look at rate cut expectations for 2025, they're beginning to build again. There's this expectation in the bond market that the Fed's going to do a lot more easing than people think, or at least what the Fed says they're going to do by next year. So I think there is a bit of FOMO going on. Retail sales next Tuesday will be an important piece of data. And I think really it'll be the next couple of payroll numbers that we get, because if the labor market softens further, then I think you definitely get the cut in September. You might even get another one in November.
Michael, we often ask you about a peak on the 10-year, but how low could the 10-year go this year? What are the traders you speak to?
Chatter today that you're going to see a 3 handle on the 10-year. I think.
Wait, you said 3 handle? You said a 3 handle.
This year. Get below 4%. I think, again, we're in this tricky period now where the inflation number was such a good number for the bond market. You just cannot really assess just how big this buying is going to come in to drive prices down. Or actually drive prices up and yields down, sorry. So, and we have been here before. We've had these big pivot trades that have been put on the last couple of years. But the CPI was also, it came after 2 days of testimony from Chair Powell.
Right.
And he kind of brought back the dual mandate for the Fed here. He said, we're watching employment. And I think if you get cracks in labor over the next couple of months, you're definitely going to see the bond market rally harder.
So I am thinking, we all are thinking about Monday at 12:30 p.m. Wall Street time, when Fed Chair Jay Powell will be interviewed by David Rubenstein at the Economic Club of Washington, D.C. Powell asked for this conversation. Is this kind of a victory speech? A little bit, or I don't know. How are you?
I don't think he's going to play it that way. I think he's going to continue to be pretty careful. The one speech you really got to look forward to, I think, is the end of August at Jackson Hole, because that'll be about 20 days before the September 18th Fed meeting, and that's going to be the pivotal one, because then he'll have seen more data. Don't forget, they're very data dependent. They keep telling us they're data dependent. I think Monday he'll stick to the script, the recent script. They're looking at both the labor market, they're looking at inflation. He's probably has more confidence that inflation's coming down. Don't forget, this week he said they didn't have enough confidence. So he could get the market fired up again if he says we do have confidence. But I think he's going to be pretty cautious still. But I think that Jackson Hole speech he makes at the end of August, that's going to be the big thing, the big event for the market.
Michael, just 30 seconds. What about the July 31st Federal Reserve meeting? Is there any chatter of a rate cut there?
No.
Why not?
I think you just haven't seen enough data. I think the Fed has made it pretty clear they want to see a series of data prints. The inflation is moving in the right direction. Labor market, unemployment rates ticked up over 4%. That's not enough to get the Fed to really think about, bringing rate cuts forward. They want to give themselves plenty of flexibility still. But everyone I've spoken to this week, even people who didn't think September was in play before, now say it's in play, and they expect a cut in September based on what we're currently seeing in the data.
What an amazing week. Again. Michael McKenzie, have a great weekend. Bloomberg News rates reporter Michael McKenzie out there in New Jersey. Coming up next, everybody, the EV maker for the anti-Elon group. Yes, there is one, and yet, can it really make money? We're going to get into this Bloomberg Business Week story. That's next.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
For years, people told me, why are you invested in Apple? Everybody talks about Apple. I actually think that sometimes because someone speaks a lot about something, it might be actually a good sign versus an overhyped sign.
The top names in global leadership are on Bloomberg.
I envisage not only some kind of a bridge towards membership or language linked to the irreversibility of Ukraine's membership in NATO, but also some kind of a broader package of military material, of financial aid. The more we support Ukraine right now, the sooner the war will end.
Nobody covers the top global leaders like Bloomberg Television and Radio.
Good morning from our world headquarters in New York. I'm Menace Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. The top names in business are on Bloomberg.
One of the reasons why I'm frustrated, like many Americans, about our choices for president is neither is proposing to do anything about a coming debt crisis in our country. Our debt is already as large as our economy. It's going to go nowhere but twice as big as that. We have an entitlement problem, which is these entitlement programs are going bankrupt by the end of the decade. We have to get ahead of that. Otherwise, we're going to have a debt crisis in America.
Nobody covers business like Bloomberg. Context changes everything.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. S&P 500 index at a record 5648, up right now by 1.1%. Dow Industrials 40,201, also at a record, up 1.1%. The Dow now rallying by 447 points. NASDAQ is gaining as well, up 241, up 1.3%. Perhaps the big story, though, today is the broadening of the rally and also another move higher today for the NASDAQ 100 index. That is up by 1.4%. The Russell 2000 up an additional 1.3% after yesterday's surge of more than 3.5%. 10-year on this PPI Friday, 4.18%. The 2-year, 4.46%. Spot gold flat on the day now, $24.15 the ounce. West Texas Intermediate crude oil down 0.3%, $82.34 for a barrel of WTI. Novo Nordisk's Ozempic has been linked to lower rates of dementia and a range of other mental problems in a University of Oxford study that raises expectations about the diabetes drug's potential ancillary benefits. Novo Nordisk rallying today by just about 2%. Bottom line here, we're looking at a potential 38th record of the year for the S&P, now at 5646, up 1.1%. We've got the Russell 2000 up 1.3%, and the 10-year 4.18%. I'm Charlie Bellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. All right, folks, Tesla, always on our radar, it feels like. Shares of Tesla did sell off earlier today. I think I'm just going to take
they've turned around. They're up 3.8% now.
Yeah, we've definitely seen like a rally. I feel like the whole market, right? A little bit. Yesterday, we did see the trade, though. There was some pressure. The stock today was downgraded by UBS on concerns that the U.S. electric car maker shares have risen too much too soon, that's their words, on optimism over its artificial intelligence plans. In the meantime, Tim, we've got another story on our radar when it comes to Tesla, or should I say the anti-Tesla crowd.
Yeah, the other EV startup that's persuading buyers to drop $70,000 on its EVs, but still has a big hurdle to get over, and that is making money. The story is in the upcoming issue of Bloomberg Business Week. It's coming out next week. It's the August issue. We've got with us Bloomberg Technology co-host Ed Ludlow. He joins us on his Business Week story in our San Francisco bureau. Ed, you know a lot about Tesla. You know a lot about Rivian. This is the focus of the story that you wrote with Max Chafkin. How is the company doing?
It's hard to say, and we wrote 4,000 words, so you'd think we'd come to a conclusion.
It's a great story.
You know, so thank you guys. Where have you two been? All over the place, West Coast, East Coast again. Look, you guys kind of teed it up really well.
Riding in a lot of EVs we have been, I will say that. Different types.
And I'm really grateful for you guys getting hands-on with that world. Like, the point or the open of the 4,000-word Business Week article is that Rivian, or the first iteration of it, was like the anti-Elon, anti-Tesla. Tesla had small form factor cars, Model 3, Model Y. They have Elon, and we, you know, Elon is divisive. I think that's a fair and objective thing to say, frankly. And so in the first instance, Rivian was able to sell its kind of very large SUV and very large pickup to that kind of market. Somebody that didn't want a Tesla but wanted an EV, or just didn't like to be associated with Elon's products. But it had a super limited shelf life. Now they've hit reset. They are on Rivian 2.0. And we went super detailed on the strategy to actually stop burning through billions of dollars and start making some money down the road.
Okay, Ed, I have a sort of a how the sausage is made question for you, because I imagine while you were reporting this story, news of that $5 billion investment from VW came in.
Oh, so without betraying confidence, it's brilliant timing. It gives the story new life and energy. Like the way that I would put it is like Volkswagen almost comes in at the 11th hour. And because an injection of $5 billion certainly helps. Even if the story is that you're burning through billions anyway, having some more billions is good. But Max and I certainly got the sense a few weeks ago that something was happening. And I've got a pretty good track record, right? I've broken quite a lot of news on Rivian, frankly, and I just had no idea. I didn't see it coming. You know, we did learn the backstory, which is that Oliver Blume and Volkswagen were admirers of Rivian. RJ Scaringe, the CEO of Rivian, met with Oliver Blume about less than a year ago, but like last summer in Atlanta, Georgia, where Porsche has its kind of excellence center. It's somewhere you can visit. And he rocks up, and in the parking lot, they've got some Rivians. And he's like, oh, that's kind of neat. But the idea is like all car companies benchmark against each other by testing other people's vehicles. And they kind of went from there. And the main thing you need to know is that Rivian needed money, and it has some access to that now. But it's also kind of a big vote of credibility for Rivian, that Volkswagen would turn to them to fix some of Volkswagen's own problems in this kind of shift we're seeing to electric drivetrain.
And yet, Rivian, if you go back to late 2021, was a $172 a share stock. It is down more than 20% this year. I said it used to be $172 a share. It's $18.52 a share today. So if it seems like it has so much potential, how come investors aren't really necessarily, you know, buying up shares?
Yeah, the concern has been, does it ever move beyond being a niche player? You know, it built 52,000 EVs across its 2 consumer cars and a van for Amazon last year. It will probably do 57,000 this year. How does it get to the 400,000 that Tesla does each quarter? And at one point, its market cap was lower than the cash it had on its balance sheet. And one way of interpreting that is that the market values the car business at basically zero. And so cue the R2. The R2 is a smaller form factor SUV. They have a new plan on how they're going to build it. It's going to go from their existing plant in Illinois instead of Georgia, where they still plan to build a factory in the future. That's going to be, they hope, the Model 3 moment, like Tesla went through. Finally, a mass market car. And the question that we pose, or at least like, you know, Brad Stone says now that we want to answer questions in Business Week. I think we explain how the R2 is going to get Rivian there based on interviews with RJ Scaringe, the CEO. And it's not going to be easy, but they have really thought about it.
Can we think about it, the R2 being like the Model 3 for Tesla?
Yeah. So like in scale. But I think, like, go back to what we started the conversation on. The initial buyers were like the early adopters, the people that didn't want a Model 3, so they wanted an SUV. And Rivian had the only 3-row SUV on the market. But most people just want, like, the RAV4, Toyota RAV4 or Honda CR-V equivalent. And it doesn't really exist yet. The problem Rivian's got is that they've said, here, we have it. It's $45,000, the R2. Them and everyone else. Everyone's going to have like this little SUV in the $35,000 to $45,000 range coming in the next 2 years. So it's about kudos to Rivian for also being quite good at technology. You know, the products are really good. They've just not been very good at building them. They're a startup, right? That's growing super fast. And time to grow up, get rid of the teething problems.
But that, like you just hit on it, right? That's the holy grail, though. Whether you're Tesla, whether you're Rivian, it's not about spending $70,000 or $80,000 for an EV. You want, I mean, if you're really going to build out your business, you've got to get to that middle market, right? Or less expensive market. That's where you scale up.
Yeah, and I think that the reason I really enjoyed the process is I covered Rivian starting when it was like 40 people or whatever, and now it's 13,000. And we kind of really get into the head of CEO, RJ Scaringe. And, you know, he was generous with his time in terms of interviews and of course, like, spoke to a lot of sources. But I think the penny dropped for him that he needed this R2 to materialize more quickly. And that's why they're going to build it at their existing factory in Illinois, not Georgia, because they can do it 6 months faster than they had originally planned, knowing that all that competition is going to do something at the same time.
Ed, very briefly, because there's a lot we want to get to in the last 3 minutes with you. Last question on this. One of my big takeaways was RJ Scaringe really finds himself in the right place at the right time. whether it's MIT or whether it's with Lauren Sanchez.
Oh, sure.
Tell us about that.
So, in short, RJ is an incredibly impressive person. He is kind. He is held in high regard by everyone that I've spoken to, takes incredible care of himself physically. He's a micromanager from an engineering standpoint.
NYMEX diesel August futures settle at $2.50 a gallon. NYMEX gasoline August futures settle at $2.51 a gallon.
And so I also kind of explain in the magazine he's been an unreliable boyfriend.
NYMEX natural gas August futures settle at $2.32.
What happened to those? And so now with VW, he gave me a pretty strong response when I put that to him about why VW is going to work. And the answer basically was like, we've proved that we're good at this. We'll see.
NYMEX WTI crude August futures settle at $82.21 a barrel. That's down 41 cents or 0.5%.
Next week. Having said that, we also want to get to an exclusive from you and Dana Hall yesterday about Tesla postponing its robotaxi unveiling to October.
Okay. Ed, when Ed joined us to talk about this a few months ago, we said, Ed, is this really going to happen in August? Because next year, autonomous has been the big joke for about 8 or 9 years when it comes to, well, a decade at this point, to Tesla. So it surprised the market. We saw shares close down by more than 8%. Was it a surprise to you?
Well, it wasn't a surprise to me because, like, it's our job, right? In the course of our reporting, we spoke to sources and they said, yeah, it's delayed to October. The reason, according to the sources, is that I think Tesla and Elon wanted more to show. They wanted more prototypes to actually unveil when the event happens. One source told me that even as recently as this week, Elon requested that the design team make changes to the design of the robotaxi. So as we always say, Elon's often late on the timelines or deadlines he publicly states, but he also often gets there at the end. And I think the anxiety in the share price was it had been on an 11-day winning run. RSI for the technos or technicals out there was like in the high 80s. And so much emphasis has been put on this pivot. That Tesla, in the long term, making EVs and selling them to consumers will be a small part of the business relative to software sales or running on autonomous robotaxi business.
Yeah, fascinating. I'm looking at RSI too, Relative Strength Index, and it's still pretty much overbought at this point. So you're right, it has had quite a run as of late. Ed, so great to go around the world when it comes to EVs with you. So appreciate it. Have a great weekend. Our Ed Ludlow, he is co-host of Bloomberg Technology on Bloomberg Television. Catch them every day at 11 a.m. Wall Street time on Bloomberg TV. And I'm looking at Tesla shares up 4% today. Little change though. Year to date, but as Ed has mentioned, quite a pop in the last couple of weeks or so.
Well, speaking of a pop, Rivian shares up by 11.5% as we speak.
All right, so something to keep on our radar. Hey, still ahead, we're going to get to the latest test for President Biden and his political future as Bloomberg Business Week continues on radio and on television. We'll be right back in just a moment.
For more, though, let's get on checking the latest world and national news. We got Nancy Lyons in the Bloomberg 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. President Biden is hitting the campaign trail today, heading to Michigan for an evening event. During last night's hour-long news conference, Biden spoke confidently about a range of complex issues, from the tax code and trade policy to Russia and the Israel-Hamas war. He did, however, have a few gaffes, which is still worrying some Democrats. Biden says he plans to stay in the race to finish the job he started. Following this week's NATO summit, questions are lingering about the future relationship between the U.S. and the alliance. If Donald Trump is elected president, he's made no secret he does not see NATO's value. But NATO Secretary General Jens Stoltenberg tells Bloomberg he expects the U.S. will stay the course.
The United States will remain a strong NATO ally because this also makes the United States safer and stronger. The United States is big, 25% of the world's GDP, but together with NATO allies, we are 50% of the world's GDP.
Again, NATO Secretary General Jens Stoltenberg. President Biden has posted on X that Israel and Hamas have agreed to a, quote, framework for a ceasefire deal using the plan he laid out in May that would result in the release of hostages. The details now being worked out with help from administration officials. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything.
I decided to acquire Indeed 12 years ago when I was 36. I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big American company. But I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the place to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right.
So whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal?
Are markets too optimistic?
How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ 100 index, Russell 2000, all pushing higher. Records right now for both the Dow and the S&P 500 index. The Russell 2000 building on yesterday's surge. Yesterday, you recall that index was up 3.6%. Right now, we've got the Russell 2000 up by 1.3%. Here's where we stand. S&P now at a record 56.49, up 65, close to session highs, up 1.2%. The Dow is advancing 427 points, up 1.1%. NASDAQ Composite Index up 255, a gain right now of 1.4%. 10-year 4.18%, the 2-year 4.46%. Gold lower a little, change down 75 the ounce to 24.14, and West Texas Intermediate crude down 0.6%, 82.10 right now for a barrel of WTI. Bottom line here, stocks climbing to records as the latest economic data reinforces bets that the Fed will be cutting rates in September. Broad-based rally with roughly 90% of the shares in the S&P 500 index pushing higher. The one notable exception, bank stocks after earnings, they're lower. Wells Fargo down now by 6.2%. JP Morgan Chase down 1.1%. Citigroup down now by 1.6%. Again, recapping, stocks higher, S&P up 65, up 1.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
It is indeed. All right, Charlie, thank you so much. Well, safe to say it was one of the most politically anticipated events in a while. No doubt about it. I was watching on the plane last night. I had my phone watching Bloomberg, and then I flipped to one of the networks on the TV screen once we took off.
Okay, you were a few seats away from me.
Yes.
Everybody in my row was watching it. And what we're talking about is the press conference that was very late for President Biden.
Yeah.
Scheduled for 4:30. Then moved to 5:30, then moved to 6:30, and then finally it happened.
It took a while. Joe and Kaylee were like counting it down and doing all the prep into it. You have to remember, though, this is coming just after, a couple of weeks after another very much anticipated political event. 2 weeks ago, it was the first presidential debate between Joe Biden and Donald Trump. Last night, of course, it was, as Tim mentioned, President Biden's news conference at the NATO summit. Really a make or break moment, many are saying, in his quest to really quiet what's become a drumbeat, a growing drumbeat of concerns at home and abroad about his 2024 presidential campaign.
I'm determined on running, but I think it's important that I allay fears by let them see me out there. Let me see them out. For the longest time it was, Biden's not prepared.
And Brent crude futures settle at $85.03 a barrel. That's down 37 cents or 0.43%.
A lot of questions about whether or not he's going to continue or is fit to continue.
Hey, with more, let's get to Bloomberg News White House and politics reporter Gregory Cordy, who joins us from our Washington, D.C. bureau. So, Gregory, win, lose, or draw last night for President Biden and his performance and his hope to allay fears about his capacity to be at the top of the ticket?
Yeah, I'm always reluctant to be definitive on these kinds of things and kind of stay within the reporting and not the punditry. And I'll have some caveats that the data is still coming in. We're still looking at members of Congress continuing today to urge him to drop out. We're going to want to look at the polls. But my first reaction was it's probably a wash. He didn't win back any of the critics that had called for him to step aside and let somebody else carry the top of the ticket. But on the other hand, he probably didn't do himself a whole lot of damage either. He stood for 59 minutes, asked questions from 11 different reporters, had some notable misstatements and stumbles, as he always does, trailed off his train of thought often, but for the most part, talked about policy, talked about his age, talked about him being in the race. He didn't really address his critics head on very often. His answers to the age questions were a lot shorter than his answers, for example, to the Ukraine and NATO questions, which went on for several minutes. But the world was watching to see if this guy could stand up and hold a press conference for an hour, and he did.
Yeah, he certainly did. I actually, we were a little tired on our trip in Seattle, and I did nod off towards the end of the press conference. Nothing to say. I was
truth
just
comes out.
So Biden kept going, but I did not. Having said that, Gregory, I do wonder, what are the clear narratives? I feel like there's very clear narratives coming from D.C. and really the media in terms of President Biden and pressure for him to step aside. As you said, the polling is starting to happen. I'm just curious about the electorate, and the citizens who will actually go and vote in November. What are we hearing from them? Is there some disconnect?
It is July, and so really, most voters are not super plugged in, although this has been a story that really has been unavoidable over the past 2 weeks. What we have seen in the polls is that after that initial debate that he had, that everybody concedes was disastrous, He stumbled in the poll. He slipped a little bit in some of the major polls. I'm talking about the New York Times Siena poll, the Wall Street Journal poll, slipped 2-3 points in those national polls. He did better in our morning consult poll that we do of swing states, but it seems to me, my reading of the polls right now is that we've sort of felt the bottom now, and that Biden is still trailing Trump nationally and in the swing states, but the slide in his ratings has abated somewhat. But having said that, when you talk to Democratic voters and you say, who will you vote for? They'll say Biden. If you ask them, would you rather have somebody other than Biden at the top of the ticket? Growing numbers, perhaps even a majority, are now saying yes.
So let's talk about more data and the data that we're starting to see. Kamala Harris, the vice president, President Biden was asked about her last night. He had very complimentary things to say about her. Gregory, how is she doing in the polls against President Trump?
Yeah, it's sort of a trick question, right? Because Biden can't say, well, she's not ready to do the job yet because he picked her. And her whole job description is to be ready to step in for him. So, yeah, he did say that she would be ready. The question in his mind is, would I lose against Trump? And if I would somebody else do better? And the data on that is a little mixed. Depending on what the poll you look at, she's either trailing further or maybe even surpassing Biden. There's a little bit of a mismatch in these. Sometimes these are hard to read because there's a difference in name recognition. Obviously, everybody knows who Joe Biden is. He's been a mainstay of American politics for 50 years. Clearly, everybody knows who Donald Trump is. Kamala Harris has been the sitting vice president for 3.5 years. She's not an unknown commodity, but people are still sort of not quite sure how she might govern differently than Joe Biden should she take office. And so there's a little bit of an unknown factor when you get to Harris. And then certainly when you get to some of the other alternatives that have been mentioned, Gavin Newsom, the governor of California, Gretchen Whitmer, the governor of Michigan, candidates like that, their name recognition is far, far below any of the other national candidates, Trump, Biden, or Harris.
Yeah, it was interesting, too. The New York Times has a story out. The Biden campaign is quietly carrying out a head-to-head survey of voters between Vice President Kamala Harris and Donald Trump in a sign of uncertainty, even atop the Democratic Party. So they apparently are doing a survey conducted this week, and it was commissioned by the Biden campaign's analytics team. What are you watching out for to get an idea that there is indeed a shift and that maybe the mechanics are going to be starting for maybe a way to smoothly have President Biden say, I'm not running anymore, and Kamala Harris is it?
Certainly continue to look at the polling, although one thing I will say about Joe Biden, and this is not uncommon to a lot of politicians, is they tend to take a rosier look at the polling than the rest of us do. Joe Biden has a history of cherry picking just the polls that he wants to look at. And so I'm not sure that the polls will be particularly persuasive to him. We're continuing to look at congressional leadership and how they weigh in. Now, Hakeem Jeffries, the House Democratic leader, went to the White House last night and talked to Joe Biden.
Right.
And came away, told his caucus this morning that he relayed the whole panoply of concerns from within the caucus to the president. Did not seem to put his finger on the scale anywhere to say that Jeffries himself thinks that Biden should step aside or that he should stay in the race. So we're watching Chuck Schumer, the Senate Democratic leader.
Right.
But this is going to be, I think, in the end, it's going to be a closely held family decision by the Biden family.
Yeah, totally get it. That makes sense. And we're also keeping a watch. I'm curious about fundraising and starting to see any impacts there. So
yeah, we know that PAC is withholding $90 million, according to the New York Times.
Yeah, so that's significant. All right, Gregory Cordy, as always, Bloomberg News, White House and politics reporter. Great stuff. Next hour, more on the president and his NATO allies and what it means for Ukraine and Russia.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg.
Now, your company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. AT&T suffered a massive hack of customer data separate from one reported earlier this year that included records of calls and texts for nearly all of its mobile phone users for a 6-month period in 2022. It is one of the biggest breaches of private communications data in recent memory. It is under investigation by the FCC. We do have AT&T shares now lower by 0.4%. The company said it learned in April that the information was illegally downloaded from a workspace on a third-party cloud platform, which a spokesperson identified as Snowflake. Snowflake shares down right now by just about 2.5%. Bank earnings front and center today, and stocks of JP Morgan Chase, Wells Fargo, Citigroup all lower. JP Morgan Chase did report record profit as investment bankers and equities traders at the biggest American bank smashed expectations, and the firm took a multi-billion-dollar gain tied to a Visa share exchange. Right now, we've got JP Morgan Chase down by 1.3%. Wells Fargo shares, they're down 6% right now. Wells has warned that it will not be able to cut costs as fast as it previously forecast this year after the banking giant posted higher than expected expenses in the second quarter. Also reporting this morning, Citigroup, it said costs for the year are now likely to be at the high end of the range it previously provided after the bank faced a series of regulatory penalties in recent months. Amazon's artificial intelligence shopping assistant, Rufus, is now available to all American customers following 5 months of testing with a subset of consumers. We've got Amazon shares advancing today. Right now, Amazon up by roughly 0.3%. Those are our top company stories, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
It is Bloomberg Business Week, live from New York City and not the French Riviera. Let's get a check on the latest world and national news. We've got Nancy Lyons in the Bloomberg 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. A key ally of President Biden says he is standing by the president's reelection bid. South Carolina Democrat Jim Clyburn told NBC's Today Show the conversation needs to end over whether Biden should exit the race.
I always say the best predictor of future performance is past behavior. Let's continue to compare the past behavior of Joe Biden as to the past behavior of his opponent, Donald Trump, and let that be a guide to our reactions going forward.
At least 17 of Clyburn's colleagues in Congress have urged Biden to drop out. Just a few days left to go before the Republican National Convention, and the presidential race still seems very close. The latest NPR PBS Marist poll shows President Biden's support is relatively unchanged from last month, despite questions about his mental fitness. If the general election were held today, the poll found 50% would go with Biden, 48% would vote for Donald Trump. That's still within the margin of error. Last month, the same poll had the two tied at 49%. Well, following last night's news conference, House Minority Leader Hakeem Jeffries met with President Biden. In a letter, Jeffries says he directly expressed the full breadth of, quote, insight, heartfelt perspectives, and conclusions about the path forward, but he did not provide any specifics. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. Now back to you, Carol and Tim.
All right, Nance, thanks so much. Nancy Lyons there in D.C. So I could totally see our bosses signing on to this. You guys want to work from home, do the show, somewhere else? No problem. Sometimes it's Seattle and the Bloomberg Green Festival, or perhaps we do something on the French Riviera.
The reason we're talking about this is because one of the most read stories on the Bloomberg terminal is about affluent Americans who have the flexibility to work remotely buying up expensive real estate on the French Riviera. It sparked a surge in property prices in a region known for stunning beaches, fancy yachts, and the glamorous Cannes Film Festival.
Yes, indeed. So here's some stats for you. Prices of homes valued above $16 million U.S.
I think that's our first problem. That's the first obstacle. Yeah, that's the first obstacle preventing us from doing this.
All right, so this is along France's southeastern coast, rose between 15 and 20% in the 5 years through 2023, outperforming the 13% gains in London in the same period. This is coming from the broker Beauchamp, or is that how you say it?
Did you take French in college? No, I can tell. Before we move there, you're going to have to brush up on that.
Anyway, apparently the prices are surging if you compare it against what's going on in London.
Okay, so this increase has been driven by a resurgence in international buyers after the pandemic. Those from the U.S., the Middle East, looking for second homes where they can work. According to the research, the demand for such so-called super prime homes, it's unlikely to be dented by the political turmoil that swept France following the recent snap elections. This is according to the managing director of Beauchamp in Cannes.
Thank you, Beauchamp. Very nicely done.
I don't know.
So apparently they're looking in the French Riviera, also Dubai and Miami, where they can live for long periods of the year.
What about the time zone shift? Does it mean you're working late at night?
Does it really matter that you can then walk out and be on the French Riviera? Yeah. Anyway, as we continue to have, it was interesting because we saw, all right, total contrast, what was in Seattle. We saw a lot of retail, empty retail space, a lot of occupancy in office space because people are still remote working, certainly in a city like Seattle.
A city like New York, a city like San Francisco as well. Los Angeles seeing it too.
Yeah.
A reset.
You sure,
a reset
bosses,
after
we
the
can't
pandemic.
do a remote and
Yeah, funny story. Already got an email from our boss saying we cannot do this. So
I believe it was not going to happen.
Yeah, that's what it says.
What is going to happen if you're watching on TV? The close is coming your way in just a moment. Tim and I consider continuing on Bloomberg Business Week. Much more to come, including an update on the market trade. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
Stocks ending the week strong, even as earnings season begins week. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. It's like yesterday never happened.
Yeah, I mean...
Nor the tech sell-off.
No, I don't want to ignore it.
You didn't see it because it's not here today. All right, let's get checking where our markets stand. S&P 500 is up by 1.2%. The NASDAQ has not recouped all of its losses from yesterday, but it is darn close, up by about 1.4%. Meta is not doing too well, but all the other Mag 7 are coming in pretty strong. The 2-year yield is down 5 basis points. That curve really steepening as we get that 210 spread really coming in there as you have more bets on a Fed cut, which is bringing down the long end of the bond market. All right, let's take a dollar yen here, down 0.6%. It's the constant rumor now of the BOJ, is MOF, I should say, actually intervening as you have that weaker dollar in a mixed G10 space remain.
Yeah, well, for once we have something to talk about other than tech. Earnings season kicking off. We got the big bank stocks earlier today. They are in focus, delivering at least two bright spots. One came this morning from JP Morgan reporting record profits, and two came from BNY Mellon posting better than expected net interest income. But the counterpoint, that came from Citi and it came from Wells Fargo, which each flagged concern about higher expenses. A closer look in just just a second with the CFO of Wells Fargo. A closer look ahead as well of the manufacturing sector with the latest producer price index showing wholesale inflation still problematic for some companies out there. We also had an earnings report from Fastenal showing less pricing power as U.S. manufacturing remains in contraction. A convo ahead with the CEO of HVAC company Ferguson, and a lot of conversations today about that stunning and broadening rally in equities. The broadest rally right now in the S&P since late March, solidifying what looks like it's going to be a second week of gains. But unlike last week, when tech stocks led the charge, this week's gains, they've been dominated by everything non-tech. Real estate as a group up 5% over 5 days. Utilities, Alex, up about 4. Materials up about 3. And even financials getting a modest bid on the day as a group up about 2%.
You gotta wonder, is that sustainable? So let's get back to banks, because those trading heavy, particularly Wells Fargo, this was one of the worry spots for the company. Not only costs, but also when it came to net interest income and net interest margin. So here's the trajectory, right? If you go all the way back to the second quarter of 2023, fast forward to the second quarter of 2024, you see the slight decline there in net interest margin. That was really echoed in the net interest income numbers as well. The loan growth are a little bit of a question, and you also have deposit beta still there. It's less than maybe we had feared, but it definitely is still there, and that's squeezing that margin. The question is, how long does that continue for, Romain?
Absolutely. Of course, 3 of the biggest banks already out with their earnings. Wells Fargo among them. Those shares down about 6%. Some concerns here about higher than expected costs. Some concerns right now here about a slowdown in cost-cutting efforts. Mike Santomassimo joining us right now, the CFO over at Wells Fargo. And Mike, let's start off with the cost-cutting here. Some commentary in the press release, some commentary on that conference call about a slowdown in some of those efforts. Characterize us as to what exactly that means.
Well, thanks again for having me, Romain and Alex. I appreciate it. Look, I think you got to look through into the quarter, and it was actually quite a solid quarter. We saw really good momentum in our fees, revenue-generating businesses that more than offset sort of what we saw as the expected decline in net interest income. We saw, headcount continue to come down, and the core efficiency agenda still in place. We saw good capital return to shareholders. We saw our investments really start to pay off, in terms of that fee income I mentioned. And so there's a lot of opportunity there. On the expense side, it was really 3 things that sort of drove the increase in the full year guidance. First is revenue-related expenses in our wealth management business, which is a good thing because there's revenue that more than offsets all of that. And so as the equity markets stay higher than what we predicted earlier in the year, that is a positive contribution to earnings, but it increases the expense line. Second is related to some remediation costs that we have to put some of these client remediations that are related to some historical matters behind us, and that was in the first half of the year. And the third is the special assessment for the FDIC related to the events of last year. So when you look beyond those 3 things, the core efficiency agenda is still very much the same as it was last quarter, last year, and we continue to execute on it and feel really good about the opportunity we have there.
With regards to the FDIC costs and the other customer remediation costs, in theory, costs that should be temporary, are we sort of at the end of this path? Is there a light at the end of the tunnel when it comes to those issues?
Yeah, well, I think the remediation stuff was related to a couple matters, they're historical, and so we're nearing, we're closer to the end on those than we are otherwise. And on the FDIC, that'll be driven by the losses that we see ultimately through the FDIC fund there, but we've accrued for everything we know about there, and we'll see how that progresses. And so it shouldn't, we don't know that it'll be any higher than it's been, and so we'll get more information each quarter from the FDIC.
Hey, Mike, the other part of the quarter that disappointed the street, though, was net interest margin, net interest income. And a big part of that is going to be that loan demand. Why do you guys still see that loan demand as tepid when a lot of your peers don't see that? What is it specific to Wells Fargo?
Well, I think, keep in mind that the guidance we put out there for the year is the same guidance we put out in January, down 7 to 9%. We just said at this point in the year, we think we'll be around 8 to 9% versus, anywhere else in the range. And so the guidance is still about the same. So most of what was in there actually, was very similar to what we expected to happen. Loan growth has definitely been a little bit weaker than we thought as we looked, at the beginning of the year. And I think that's generally the case in a lot of other places as well. And I think we've been very, very consistent about our underwriting standards and the way we're approaching it. So we're not out there chasing growth by taking more risk. We're actually very much just being very consistent over a long period of time. But underneath the NII trends, you're actually seeing some positive trends. Deposits are up, in all of our lines of business versus the first quarter. That's the first time in a couple of years that that's happened. And so there's actually some positive trends that are happening underneath there as well.
I mean, I hear you, but the stock is still down 6%, and it's even off its lows versus your peers. Like, there's clearly something that is worrying investors, and those cost measures as well as net interest income were those two worries. What do you think happens to loan growth and net interest income as the Fed may cut rates?
Yeah, well, as the Fed starts to cut rates, our deposits will begin to reprice downward as well, particularly on the wholesale side. So that'll be a positive as you start to see, that happen. And I think rates are one part of the equation for what we hear from our clients, right? So you have the election coming up, you have rates still being high, you have some uncertainty still out there in the economy to make sure this soft landing is really going to materialize in the way people think. And so I think as we get through the year, you'll start to see, clients do more from a lending perspective, as well as, consumers, if the stronger the consumer stays, I think you'll start to see some more growth there as well.
Mike, I have to ask you about some of the efforts that Charlie Scharf has made to kind of broaden out this business. Obviously, Wells much more known for the consumer side of that business, the mortgage side of that business, but you've made some decent strides so far in the trading space and, of course, in some of the more traditional Wall Street types of businesses here. How do you accelerate that, though, in a way that is going to satisfy investors?
Well, I think it's not about acceleration. It's about being very consistent in our execution there. And I think, we've been talking now for a number of years about a few areas of investment. First is the credit card business, and I think you see that come through, the new accounts and the growth and balances there. Second is the wealth business, where we've, again, seen growth in the advisory fees. We've seen, our attrition in advisors slow, and I think, we think there's opportunity to continue to grow there. And then it's in the corporate investment bank and the commercial bank, and I think we've been hiring and investing in people and capabilities there for the last few years, and I think you're starting to see that really come through, both in the trading line and the investment banking fee line. And I think that's something that will kind of build, methodically over time. There is no trying to accelerate by taking risk. We have to be very consistent about how we go about it, and I think we're starting to see the benefits of that come through.
Mike, we really appreciate it. I know it's a busy day. Thank you for taking the time. Wells Fargo CFO, Mike Santomassimo. All right, let's bring in Gerard Cassidy for more insight into the bank earnings, Managing Director and Head of U.S. Bank Equity Strategy over at RBC Capital Markets. Gerard, you have a sector perform rating on Wells Fargo, for example, with a $61 price target. What do you make of the shares down 6% right now?
Thank you, Alex. I think what you're seeing is this stock, Wells Fargo, has had a nice run this year, and there's probably some profit taking going on. And as Mike just pointed out, obviously the guide on the net interest income, as he pointed out, it was 7 to 9%, which was the start of the year. They're kind of edging it up closer to 8 to 9, and I think that had a lot to do with why maybe some people are taking some profits right now in the stock. Plus, the guide, slightly higher operating expenses. Again, as he pointed out, not the core expenses, but these ancillary expenses. That was another disappointment, which is contributing, I think, to the weakness in the stock today.
Gerard, the one thing that all these banks didn't have the ability to do with the quarter is look at the CPI on Wednesday and what the market was going to reprice, and Fed Chair Jay Powell 2 day of testimony. If they could go back in time, like, what is sort of a rate cut that comes in September, November, 50 basis points this year? What does that wind up doing to how much money these guys can make?
In fact, I think it's going to be very positive for all the banks, including Wells Fargo. And Mike touched upon it a moment ago, where you're going to see funding costs start to come down for the banks. And so if the Fed does cut in September and December, and let's assume they cut 2 or 3 times in 2025, if we see 100 basis points lower Fed funds rate by this time next year, Wells Fargo and the other banks' funding costs will be falling. Now, what's also important, though, to point out, many of these banks
put on their books back in 2020 and 2021, fixed income securities, as well as some fixed rate loans, anywhere between 1% and 3% coupons. When those loans and fixed income securities pay off, they're going to be reinvested at higher yields. So the margins are actually going to improve, and that would be very positive for Wells, because remember, they still have that asset cap. So the other banks can grow their way through the pressure on the margin. Wells, of course, cannot.
Yeah, absolutely. And this has been a long road. Of course, Charlie Sharfa now in his 5th year there trying to make this turnaround. I do want to ask you about another bank that is sort of trying to make a turnaround, and that's what Jane Fraser has been doing over at Citigroup here. Earnings today, I thought were actually looking pretty good, even though the shares are down. Just give us a ranking here, not only of what transpired in the most recent quarter, but how you kind of assess what Fraser has done so far since she took over.
I think she's done a very good job. She's done much better than her predecessors in trying to streamline and simplify the bank. It's a very complicated, long task. This is not going to be fixed in a 12 or 24-month time period. It's probably a 5-year fix from the day she started until maybe it really is finished. And of course, as you know, next year, they're planning to spin off the Banamex subsidiary, which is their Mexican subsidiary. But so I think we got to give her some real positive credit, even though I know there's criticism out there that it may be not going as fast as it should, but she's made real progress. And there was a setback this week, of course, as you saw with the regulators coming out, not being pleased with the progress they're making in some of the controls and procedures area in data management. And that was, I think, part of the reason the stock is down today.
We only have about a minute or so left here, Gerard, but I do want to push ahead to next week. We're going to get Goldman, Morgan Stanley, and Bank of America. Is it going to be more of the same, or is there a different narrative coming out of those stocks?
No, Romain, I think one of the highlights today that we really haven't talked about is the strength in investment banking and trading. And as you just pointed out, Morgan Stanley, Goldman Sachs, Bank of America, we expect to see really good numbers from those companies. The investment banking numbers year over year, we're seeing 30, 40, 50% gains. And in trading, what's interesting is the trading numbers are coming in better than expected. That's both fixed income and in equity, and especially in equity trading. And even for Wells, as they pointed out, their equity trading numbers were quite strong on a year-over-year basis.
All right, Gerard, got to leave it there. Always great to talk to you, and thanks for honoring our Searsucker Friday dress code here. Gerard Cassidy, the best in the business, Managing Director and Head of U.S. Bank Equity Strategy at RBC Capital Markets. A lot more coming up here on the big program, including a closer look at AT&T disclosing a massive hack attack that actually took place last year, but now a lot of questions here about what it could mean for customers and, more importantly, shareholders.
Plus, we're going to get a read on the economy from Kevin Murphy, CEO and Executive Director of Ferguson, the wholesale distributor of everything from ventilation to heating systems for residential and office buildings.
And Alex, if you had a chance to work from home, would you work from New York City or would you work from the French Riviera?
Obvi, the French Riviera.
Affluent Americans with that flexibility are finding that, well, they are snapping up luxury homes out there in Saint-Tropez and other cities along the French Riviera. We're going to take a look at, well, what that's doing to housing prices out there. That's coming up in just a bit, right here on The Close on Bloomberg.
The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Season is here.
We're skating into another earnings season.
The expectation for earnings going forward are quite high.
Bloomberg is first to break the numbers.
Adobe earnings crossing
earnings out of Broadcom.
JP Morgan, we get Citigroup, we get Wells Fargo.
There is something for everybody.
With the smartest insights.
Now banks have earnings power.
There's a resilience in the bigger cap companies.
We're not talking about a collapse in earnings for technology.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Seeing buying in the front end of the curve here. The 2-year yield down 17 basis points in just the last 4 days. Barclays now saying, though, the 5-year Treasury is what you want to be shorting right now, saying that markets are pricing in too many Fed rate cuts. They specifically go on to say that the continuity or cumulatively, which is not consistent with the resilient economy and inflation risks following the U.S. elections, adding that 200 basis points of rate cuts are priced in, implying an endpoint well below prevailing estimates of the real neutral rate. Here with her perspective is Tracy Chen, portfolio manager over at Brandywine Global. Tracy, do you agree? Time to short the 5-year?
I disagree. I think their theory pricing too much of the cut. I do think that this round of cut will be shallow, and because the U.S. economy is just probably experiencing a soft patch, and I don't see a recession imminent at the end of this year.
Do you feel that so when do you think we're going to get that rate cut, and how many this year then? Because it looks like we're starting to fully price one for September and 2 fully priced in by December.
Yes, the market priced in probably 2 to 3 cuts. Given the tamer inflation and softer growth, I think probably one cut or 2 cuts. I think 3 cuts is a little too much.
I'm curious that when you look at some of the moves that we've seen this week, particularly in the fixed income space, presumably on the back of that CPI report, presumably on the back of some of the comments that Jay Powell made at that testimony here, do you think we are now finally going to see that upswing that we've seen, the disinversion of the curve, the idea that rates will now reprice to something that, I don't know if it's in line with the Fed, but certainly a little bit more appropriate to economic conditions?
Yeah, I think we do believe there should be a steepening of the curve, and because the long end of the curve will face a lot of pressure. So cyclically, we do believe Treasury rate should have a strong rally, but in the medium term to long term, I think the long end of the curve will face a lot of structural forces in terms of headwinds. For example, if in the medium term, if Trump wins the election, I think there will be deregulation and more tax cut, and then more tariffs, and those are mostly inflationary. And structurally, for the long term, I think the fiscal indiscipline will have to be fixed. Otherwise, there will be a lot of supply on the long end, and also the short end. So, and in order for investors to be attracted to the Treasury market, you do need a higher term premium, which are not priced in yet. I don't think the market fully priced in a higher tariff environment.
Yeah. Why don't you think we've seen that term premium come back, or at least come back to a level that's a little bit more satisfactory to investors? Because everyone brings this up, but no one seems to have a reason or explanation as to why it continues to just sit where it's at.
I think people more focused on the cyclical, the short-term cyclical forces, because if you look at the Citigroup Economic Surprise Index, it dropped very sharply to a negative 43. I think we do compare the three economic regions like Europe, China, and U.S. U.S. Economic surprise dropped the hardest, and mostly driven by soft data rather than hard data. So the sentiment really dropped a lot. But if you look at Europe and China, they all dropped, but not to the degree compared to the U.S. So the U.S. exceptionalism is in doubt right here. So we do see a converge of the global growth. The slower growth, Europe might catch up with the U.S. and U.S. growth might slow down more than other economic regions.
Going back to the spread now, just sort of encapsulating what we've seen this week, because we have a lot of moves in the bond market, particularly that front end. 2-10 spread is just negative 27 basis points. If you look at the long-term average, it's a positive spread of something like 87 basis points, something along those lines. What do you think that spread realistically gets to with the outline and the growth perspective that you just talked about?
I think they will eventually go positive. If not this year, probably early next year. And I look at each different segment of the rate curve. I think originally 6 segments of the rate curve, they were all negative, and now 3 of them turned positive, and we have 3 more to go. So I do think the curve steepening should go on. Actually, my conviction on curve steepening is stronger than the absolute level of the rate itself.
Interesting.
All right, Tracy, great stuff. Always great to talk to you. Tracy Chen, portfolio manager over at Brandywine Global. And this gets to this idea now here of like whether the bond market is going to really start to drive the narrative a lot more for the equity market. Because it seemed like for the last few weeks, maybe the last few months, the equity market was kind of left to its own devices. And it was just basically just like a frat party for the last, 2 months.
I know, but the frat party continues today.
Yeah.
Like you got the Russell, so okay, you can make the argument for the Russell and for the bond market, but that frat party for tech, that still continues.
Yeah, absolutely. Here, you're definitely seeing that here on this day with stocks right now near the highs of the day, setting up for what's going to be a pretty stellar week across the board for the major industries. We are taking a look at some of the individual movers on the day, and there are some that aren't participating, and that includes names like HubSpot. Those shares extending declines on a downgrade and a street low price target over at Key Bank. We're going to have more on that in our top calls after the break, right here on The Close on Bloomberg.
Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players. 3,184 hits, 431 home runs, and of course the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. Why are you doing this?
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
There's only one word, winning. You win on the court, you win off the court. And as you do that, you bring people along.
All right, let's get a view from the sell side with our top calls. The big movers on the back of analyst recommendations, and we're going to start off with HubSpot. Having a rough go of it today. Shares of the software company down for a sixth straight session, with KeyBank today slashing its price target to a street low $460 a share. The analyst citing management departures and cuts to partner resources, and that decision by Alphabet to walk away from plans to buy the company isn't helping perceptions either. Those shares down about 4%. Next up, Booking Holdings flying higher today after an upgrade to buy over at Benchmark. The analyst says increasing resilience in Europe and the Middle East and better than expected growth in Asia and Latin America, fueling confidence that Booking can outperform consensus. The price target, which they actually haven't had one over at Benchmark since 2017, set at $4,700 a share. That implies about a 16% upside from where it is today. And finally, let's take a look at Eli Lilly. UBS raising its price target to a street high $1,100 a share. The analyst expects expanded consumer access for weight loss drugs and for Lilly to improve its supply chain enough to meet that demand. Those shares up about 1.7%, 949.83. That's a record high, and those are our top calls.
Just coming across the terminal right now, everyone. Barclays is changing their Fed forecast to 2 cuts now in 2024.
Noting that Barclays changes the Fed forecast to 2 2024 rate cuts from 1.
September from November is starting to trickle in. So staying with the economy, we're going to talk to Kevin Murphy, CEO and Executive Director of Ferguson next. It's an HVAC company for residential and non-residential. We'll break down what he sees on the inflation and growth front. This is The Close on Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
For years, people told me, why are you invested in Apple? Everybody talks about Apple. I actually think that sometimes because someone speaks a lot about something, it might be actually a good sign versus the overhyped sign.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Boston.
And I'm Alex Steele. Yes, it is the kickoff of Banks Day, but one company that we both like, Fastenal. It's literally nuts and bolts.
Yeah, I mean, they're basically, if you own a factory or a warehouse or something, you're probably buying stuff from them, nuts, bolts, racks, whatever.
Yeah.
So it's always a nice read on the industrial economy. And we talk about an industrial economy, at least a manufacturing economy. It's effectively been in contraction now for at least a year and a half. I was looking at the ISM data, something like 19 of the past 20 months we've had contraction readings. And the one interesting thing, though, about the Fastenal earnings, they weren't great, but it seems like people are hanging on to this idea that maybe we're at that proverbial trough. Maybe there is a
Seeing some
rebound.
downside in the S&P 500.
Like that was definitely the takeaway. And also, you had a better volume, but not as great pricing. Okay, a little bit on the top line, even though the pricing that they could take wasn't that great, but less bad.
Because I thought it was interesting when they talked about how their own pricing power was eroding, but then it came on the same day we got that PPI report that seemed to suggest wholesale pricing to a certain degree is still kind of problematic for other businesses.
Margin crunching.
It's interesting to see where they kind of fall into that in that balance.
Well, let's see what another company falls in that balance. And this is Kevin Murphy. He's the CEO of Ferguson, the perfect person to talk to about this. It's basically an HVAC company that makes everything that you need inside a building for residential and non-residential. Kevin, let's pick up on that on the pricing part. So we had PPI that came in hot, CPI coming in weaker. That says to me that's going to squeeze your margins. What are you seeing?
Yeah, first, thanks for having me. And yeah, the macro markets are a little bit challenging. You look at our business, we're a little over half residential, a little under half non-residential. And from a pricing perspective, we've actually seen our product categories move into deflationary territory. So we had roughly 2% deflation during the last quarter, but we were really pleased that we're back to volumetric growth. And when you talk about the ability to pass price through and pricing power in the market, we were pleased to see gross margin expansion, even though we were in price deflation. So we believe we're back into a place where we can start to grow volumetrically and build that organic curve.
Why? How? Is it because the demand is so strong, so you have that pricing power? Is it because that disinflationary impulse has come in so much? What do you attribute that to?
So the deflationary pressure that we're seeing actually comes through in commodity-based input products. So think about PVC pipe, copper tube, iron pipe, steel pipe that we use across residential and non-residential applications. And if you look back to, call it the fall of 2020, before the inflationary pressures really started, that's what led us into that inflation. We saw it in, call it September of 2020. Well, now we're seeing those commodity-based inputs go into deflationary territory. And so it really is just getting back to a reset, back to an equilibrium. And so from a pricing perspective, we're still able to charge for the value that we provide to the contractors in the marketplace. And so we were really pleased with that margin performance, and especially now that we're back to volumetric growth, even though the markets still have a little bit of chop left in them.
Kevin, I am curious about just what the mood is among some of your clients in general. I mean, we can look at the numbers and get an assessment of where we stand in terms of production or lack of it thereof. But like, what are they feeling right now when you talk to those folks or your team talks to those folks?
So both residentially and non-residentially, the contractor base still feels like they're in a pretty good place. And part of the reason for that is we have a serious deficit of trade professionals inside of America. We're over 300,000 workers short in terms of trade professionals in this country. So that's a real challenge as we look to grow our economy in the future. And so their business is still in a reasonably good place. And if you look at the markets that we compete in, yeah, we've got some pressure with interest rate and overall housing price, for example. But we're underbuilt in the United States by, call it, 3 to 4 million units on the residential side. The average housing stock is 40 years old. And then on the non-residential side, with stimulus from fiscal spending and what we're seeing with onshoring, reshoring, and data center activity, there's really good tailwinds that are going to be supportive, despite what you're seeing with office and knock-on commercial construction. So they're feeling pretty good about where the market is. We've just got to get through some near-term chop as we start to make our way.
Yeah, it's interesting. There is a lot of optimism about some of that build-out, certainly in terms of the money that's been committed to it. I do want to go back to what you were alluding to on the labor side of it, because there is some concern about having enough skilled workers to fill up some of those facilities once they do get built. What sense do you have that, whether it's at the corporate level or the government level, that there is a plan in place to, I guess, fill that void, if you will, whether it's training up folks here in the U.S. or finding workers from elsewhere?
I'm optimistic that we're starting to see the conversation turn. I would love to see us have a nationwide kitchen table conversation with parents that say getting into the trades is a great way to grow a career, a great way to become an entrepreneur, and to really make a living as you go forward in the U.S. Because it is going to be a stable piece of employment that is critical to what we do to build out our infrastructure. We're involved from a corporate perspective in places like MicroWorks, Women in Plumbing and Piping, and at the grassroots level, really trying to advance that as a career for men and women in the United States.
Hey, Kevin, going back to sort of the macro environment for a sec, we're all sort of anticipating that Fed rate cut. What happens to your business in non-res and res if we get that rate cut this year?
So on the non-res side, we've still got, like I said, those tailwinds from really large capital projects, data centers, chip factories, onshoring and manufacturing. That's in play, that's running. If you look at the residential side, get past the election, have some rate cut and easing of housing affordability, and we think that we'll see some continued growth. Single-family construction is in a reasonable place just because we're not having existing, home turnover right now, and so new construction is a good place to go. We think we get to the back half of this calendar year, the remodel side of residential begins to pick back up steam, and with a few rate cuts, we'll see that new residential construction, particularly single-family, start to get back to growth.
Kevin, is that a risk, though, weirdly? Is like you get rate cuts, all of a sudden, boom, you get the demand, you get a lot of growth, and that's going to trigger some more inflation, and we're going to get into a different spiral. Like, is that something that you can see?
Yeah, for us, we're looking at, like I said, commodity-based input deflation in the price category helps with affordability, but quite frankly, unit construction starts to get at the affordability concern. We need to build more housing stock in the U.S. We need roughly 1.5 million units built per year to take care of new family formation, immigration, disaster recovery, second homes. So we've got a ways to go, and we need to get back on that track to building housing stock in the U.S.
All right, Kevin, great stuff. Always great insights. Kevin Murphy over there at Ferguson, the CEO, major HVAC company here. A closer look at the manufacturing economy here in the U.S., Alex Steele. And I mean, it's funny, I guess we're not really a manufacturing economy anymore, but it's still very critical, particularly for the health of the markets and to a certain extent, I think just our general psyche about how things are going.
Yeah, I was going to say, critical to the markets, whereas the consumer is critical to the economy, if we look at it a little bit bifurcated along those lines.
Yeah.
But I thought that was interesting that inflationary impulse is now totally turned around when it comes to commodities. It's still disinflation, and that hasn't kind of risen up yet, despite sort of PPI maybe getting a little stickier over in China because of freight costs, et cetera.
But does this, I don't know if we're supposed to say this out loud, but is this the balance that I think Jay Powell was kind of alluding to?
You're Goldilocksing it on me, aren't you?
I'm not, I don't want to use that word, but that's a four-letter word around here. But but he did kind of get at something that I think we're all wishing for. I don't know if it's true, but Jay Powell's a smart guy, so if he says it, I would think he has some sort of fundamentals to back that up.
And then to Ferguson's point that Kevin Murphy was making, if you wind up having rate cuts, you still have housing and they have the growth there, and then you have demand, but we need it. We need the supply, so it's okay. That's going to even out. You're not going to get that inflationary impulse that some are worried about.
Yeah, great conversation coming up. Another great conversation. I don't know if you've heard about this, but AT&T apparently they had this massive data hack, but like most data hacks, we don't hear about it until months after the fact. It actually happened last year. We're learning about it now. The stock moving just a bit on that as an SEC investigation gets underway. It's our stock of the hour. The discussion up next. This is The Close on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. The top names in global leadership are on Bloomberg.
I envisage not only some kind of a bridge towards membership or language linked to the irreversibility of Ukraine's membership in NATO, but also some kind of a broader package of military material, of financial aid. The more we support Ukraine right now, the sooner the war will end.
Nobody covers the top global leaders like Bloomberg Television and Radio.
Morning from our world headquarters in New York, I'm Menace Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. The top names in business are on Bloomberg.
One of the reasons why I'm frustrated, like many Americans, about our choices for president is neither is proposing to do anything about a coming debt crisis in our country. Our debt is already as large as our economy. It's going to go nowhere but twice as big as that. We have an entitlement problem, which is these entitlement programs are going bankrupt by the end of the decade. We have to get ahead of that. Otherwise, we're going to have a debt crisis in America.
Nobody covers business like Bloomberg. Context changes everything.
Welcome back. It's time now for our stock of the hour, and it is AT&T not participating in today's rally. This after the company announced a massive hack of customer data. That breach included records of calls and texts for almost all of its mobile phone users for a 6-month period back in 2022. The Federal Communications Commission here in the U.S. now saying it's investigating that breach. Chris Palmieri joining us right now to talk a little bit more about what we know. And Chris, I just want to start off. There was an interesting post on X from John Scott Ralton, who's a big sort of a researcher in the cybersecurity space. And he basically said that this basically gives whoever got this data, in his words, NSA-level view into Americans' lives. Is this breach that severe?
Scary. I mean, what's shocking about this is how widespread it is. It's virtually every single AT&T customer. Landlines were involved as well, and other companies that's connected through AT&T cellular networks. So, you know, just a huge audience there. And as AT&T itself noted, that although personal data isn't involved, the phone numbers are, and you can sort of trace back and see whose numbers they were and figure out virtually who's talking to whom across the country during those 6 months.
Do we know anything about who issued the attack? Did AT&T pay to not have the data released? Do we have any of those details yet, Chris?
They haven't said anything about any ransom. It was a workspace, AT&T connected through a third-party vendor, which they've identified as Snowflake. So you can imagine maybe somebody getting credentials and pretending they're an AT&T employee, something like that. There's a lot of question as why, if this was known in April, why we're just hearing about it now. The FBI has said that they've actually delayed disclosure for security reasons, and so a lot of speculation then that, you know, that they have somebody that they've in custody or and apprehended in connection with this, and maybe more, and that they feel like it's contained. The information wasn't distributed publicly, and so for those reasons, it may be, you know, all wrapped up, but it's still very scary.
It's very scary, and it gets to, I think, a question that a lot of us has, Chris, is, did this, cause any disruption? Do we know if it caused any disruptions around the time it occurred? And more importantly, I mean, what happens to all these folks? I mean, they're going to have to, like, change their numbers or get new identities, or, you know, what?
Yeah, I don't see, you know, I don't really see how you can erase the history of those calls. I mean, if we believe them now that it hasn't been leaked publicly, hopefully it's contained. You know, but this just seems to be almost a monthly event. I mean, it was just in April too that AT&T disclosed another hack, and we've got a list of all the big carriers experiencing this kind of stuff.
Yeah.
You know, so it's just. Yeah, well, no, it's not as easy as just, you know, watching your credit card or something.
All All right, Chris, we really appreciate it. Thanks for hopping on with us on this. Chris Palmieri of Bloomberg joining us. I was speaking to John Butler, Bloomberg Intelligence. He's not worried about churn. He's more worried about, will the reputation damage in the short term prohibit people from going to AT&T because they're so freaked out?
Yeah, the problem though is like, I mean, you know, not to speculate, but I assume every carrier deals with this from time to time. Maybe not to the extent that AT&T, but I feel like you said, it seems like once a month or something we hear a major company basically saying somebody who shouldn't have our data has our data. I mean, how do you solve this?
I mean, landline though, that's something.
So go back to a landline?
No, they still took your landline information.
Right.
Like that was so freaky. All right, we're gonna count you down to the closing bells. We're losing a little bit of steam as we head into the close. We are no longer at a record high for the S&P. Christina Hooper joins us next.
The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested, they want to be an early adopter of the stock, they're interested in the story.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m.
Markets on close imbalance. The S&P 500, 3 billion to the sell side. The NASDAQ 100, 1.5 billion to the sell side. The Dow 30, 900 million to the sell side. And the Magnificent 7, 700 million to the sell side.
of the highlights today that we really haven't talked about is the strength in investment banking and trading. And as you just pointed out, Morgan Stanley, Goldman Sachs, Bank of America, we expect to see really good numbers from those companies. The investment banking numbers year over year, we're seeing 30, 40, 50% gains.
Gerard Cassidy, head of U.S. Bank Equity Strategy over at RBC Capital, kicking us off to the close just a little while ago. Romaine Bostick here alongside Alex Steele with about 10 minutes until we get to those closing bells. Alex and, of course, Gerard, talking a lot about those bank earnings that we got this morning. Kind of a mixed bag here. I mean, J.P. Morgan, as always, record profits. What else is new? But the other names there still kind of in flux.
I mean, Bank of New York Mellon, though, having an amazing quarter, up by 5%. Wells Fargo, worst performer still on the S&P. I should point out we're rolling over here from that top of the S&P. We are no longer sitting at a record high, although the Russell 2000, yes, off its high, still holding on to some of those gains, up by about 1.3%.
Yeah, interesting, too, like the complexion of this. I mean, even if we do get a little bit of a selling into the close, we're still talking about a pretty decent week for the major indices, and probably a big story on this week here is that rotation a little bit out of tech and into, I guess, some things non-tech. Real estate, your best performer as a sector on a weekly basis. Christina Hooper joining us right now. She's the Chief Global Market Strategist over at Invesco. And Christina, I do want to start off with that rotation. I mean, we'll just call it that. I know it's only been a few days of rotation here, but there was an opening that this market had been looking for. And you really saw that in force over the last few days, where when they got that signal that maybe rates, the Fed rates, would come down, maybe economic conditions would be cooperative, you saw an embrace of cyclical, you saw an embrace of materials, you saw an embrace of interest rate sensitive stocks.
Absolutely. The market is assuming that the Fed will act soon enough that we will avoid any kind of more serious economic slowdown, and that we're likely to see a reacceleration in coming months. So that's what markets are betting on. We've had this happen before, though. So it's a question of whether or not we actually see the follow-up by the Fed in enough time for us to prevent greater problems, because right now we're seeing cracks that we hadn't seen before. So time is of the essence.
Do you have confidence, though, that the Fed will act soon, or at least will signal that they're going to act soon? Because that was the chorus particularly coming out of that last, the CPI report. But even when Powell was testifying, a lot of people were saying, look, the time to do it is now, and just do it. But we're probably not going to get it in July, and I'm not certain we're going to get it in September.
So I still think there's a good chance we get it in July.
Really?
And I think if Jay Powell is wise, the Fed will move in July. It will be viewed as less political than doing it in September.
Interesting.
For one reason. But I also think it's because the data argues for it, and monetary policy conditions are just so restrictive. If we look at the gap between core PCE and where the Fed funds rate is, it's the largest gap since 2007, which is rather ominous. And if we were to look at the proxy Fed funds rate that San Francisco Fed runs, factoring in other monetary policy tools, it's at about 6.4%. That's way too high given how much progress we've seen in disinflation.
I'm curious, though, a hypothetical that if they were to cut in July, A, you think that would be just 25 basis points, and two, does it not matter that that wasn't telegraphed in advance? Because if he did cut, that would be a surprise.
Well, he still has a few weeks to telegraph it, but I will admit, I think it is unlikely he does it. I think it is, though, the right thing to do, and I do think he has enough time to telegraph it.
So going to the small cap and the rotation situation, Chris Harvey over at Wells Fargo had a note out that talked about kind of what you need to really sustain that kind of rally. He said, we believe the great rotation needs lower rates and earnings optimism. He says the CPI delivered lower rates, but earnings concerns linger. Just look at Delta, for example, and we see an oversold bounce, not a rotation. The best risk reward appears to be greater rate sensitivity. We got one, but not the other, because earnings might not hold up. And then in small caps, you can make the same argument.
So I think earnings will hold up once the reports start rolling out. We've seen a very, very benign downward revision season thus far. So from March 31st to June 30th, we saw a very, very small level of downward revisions, much lower than what we normally see. So I suspect that we're going to have a relatively good earnings season. What we have to worry about is going forward, right? The banks have signaled that with increased loan loss provisions. We're seeing a lot of signs that the economy is weakening from here. And that, I think, is the bigger issue that's the one that the Fed can remedy by acting sooner rather than later.
So under that environment, though, like small caps could do well. It's so hard for me to understand, like the economy is weakening, so buy small caps.
Because markets discount in advance.
Yeah.
So markets are saying this is what's likely to happen by the end of the year. We'll see an economic reacceleration, so we're going to buy on the rumor.
Fair enough.
I have to ask you about politics, too. I mean, you mentioned kind of how the Fed might want to try to steer clear of the November election by maybe getting these rate cuts started before then here. What about for investors overall? There's been obviously a lot of speculation about the policy differences between the two candidates, and obviously a lot of concern that one candidate might not end up being a candidate, depending on how things shake out. Do you avoid that as an investor right now, or do you try to position around it already?
I think you have to put on political blinders and assume that that is all noise. And history tells us that is noise, that, we could certainly see some very short-term volatility, but it doesn't matter for the longer term. So it's really important not to get spooked by what's going on in politics. The easiest way to do that is just put on blinders, stick with one's investment policy, and not let it change because of what's happening.
What are clients, though, asking you about right now when they come to you and your team with their worries, their hopes, their dreams? Like, what's kind of at the top of the list?
Well, I think it's a combination of when will the Fed act and are we headed for some kind of recession? Interestingly, those are the questions that have popped up rather recently. I think for a long time, many were comfortable with the idea that the U.S. economy was very resilient. That's starting to change a bit. And some of the data certainly is suggesting that. If we look at most recent ISM PMIs, but also if you look at the University of Michigan preliminary consumer confidence data for today, that came out today, that is telling us there are concerns, and that's certainly what's bubbling up in client questions.
Yeah, and it was interesting too in that UMich data to see kind of the difference between high-income folks and lower-income folks. Definitely.
So noting the S&P 500 currently up 0.5% since the beginning of the session at 5,623.
Invesco with about 3 minutes until the closing bells. Alex, still green across the screen. A decent day, a decent week, but some selling into the close.
It is. Also, it's interesting the UMich point that you were talking about. Inflation expectations came down, and yet everyone still felt worse. That was a head scratcher.
And that's the conundrum, though, that the Fed has to deal with, right? I mean, there's what the data tells you, but there's also, and we heard this, decades ago, right, from James Carville, right? The economy is a feeling for a lot of folks.
And
it's not a data point.
Yeah. You know what's not a feeling? The equity market.
Well, the equity market, you're getting your gains here today, 56.14, of course, off the highs of the day here, but still shaping up for what is going to be a second week of gains for the broader market as we move closer to those closing bells. Our full market coverage, it starts right now on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Alex Steele, taking you to the closing bell. Our global simulcast starting with help from Scarlett Fu, Carol Masser, and Tim Stenovic in the radio booth.
They're back.
As we welcome our audiences across all of our Bloomberg platforms. We did miss you, and I hear that both you guys are a little under the weather. So if it's okay, Carol, I'll do all the talking for you. Is that all right?
Oh, like it's anything different from before?
It's a day that ends in Y.
I'm just going to say we brought some of the green home to Wall Street. That's all we're going to say. Because we see pretty broad-based rally, guys.
Yeah.
Yeah, go ahead, Romaine. I thought you were going to talk.
Carol, you set it up for me here. But we talk about those moves here and the idea that we did get that rotation this week, a rotation that I think a lot of people have been pining for quite some time. I guess the big question is this going to be one of those situations where it all unravels when we come back on Monday?
Yeah, but the data confuses me because you have consumer prices, of course, cooling. That's what we got earlier this week. But then today we got wholesale prices that rose more than anticipated. So how do you square that?
Well, yeah, and we were talking earlier about how UMich came in lower, but then the inflation expectations also came in lower. So some of these things may not quite be adding up. But guys, I gotta say, it's really hard to sort of poo-poo the rally when the Russell 2000 is still having an incredible day. Like, it's off its highs, but still, it's up 1%.
I'm glad you brought that up.
And an incredible week, too.
Yeah, because what did you say, Carol? 6% for the week?
6% for the week overall.
Yeah, so a big rotation yesterday. away out of the mega cap tech names and into those small caps.
And we should point out on a weekly basis, it looks like it's the strongest outperformance we've seen from the small caps going back to April of 2020. Of course, a lot of that aided by the big drop that we had in yields, a big drop in the dollar as well on the day and on the week. As for the day, here are your numbers. A Dow Jones Industrial Average in the green, higher by 0.6%. An S&P 500 in the green, higher by 0.6%. A NASDAQ composite also in the green, higher by 0.6%. Your outperformer on the day, trying to separate itself, is the Russell 2000, a 1% gain on the day. Mid caps and transports also higher as well.
All right, so I'm just looking at the Russell 2000 since we're talking so much about small caps. Most names in the index today, over 1,400 to the upside. If we go to the big caps, Scarlett, same thing. It's pretty broad-based rally. You've got almost 400 names to the upside in the S&P 500.
Yeah, absolutely. Very broad-based advance. Look at the 11 sectors. The only sector in the red right now is communication services, which admittedly is fairly big because you've got names like Facebook in there, or I should say Meta, but it's not one of the decliners. You've got Netflix and Paramount dragging that particular industry group lower. As for the big gainers, consumer discretionary, materials, and technology all up by at least 0.9%.
All right, let's get to some of the individual gainers, if I may, in the Friday trade. I know we talked a lot about, obviously, the big banks because they kicked off the earnings season in a big way, but most of those names finishing lower today. We'll get into that in just a moment. Here's a gainer, though, in the financial space, and we're talking about Bank of New York Mellon, up about 5.25% in today's
So for the
trade.
week,
It's the
noting
nation's
the
oldest
Dow
bank.
up
They reported second quarter adjusted
1.6%,
earnings per
the
share
S&P
that came in
500
ahead of
up
consensus estimates.
0.9%,
So investors kicking that
and the
one to the
NASDAQ
upside.
up
We saw a lot of movement
0.2%.
in the EV space when it comes to some of the share names. Tesla, a gainer in today's trade, up about 3%. It was a top gainer in the NASDAQ 100. That's despite a UBS downgrade on concerns that the company shares have risen too much too soon, on optimism over its AI plans. There was a lot going on, but nonetheless, this analyst cutting it to a sell. 12-month price target was raised, though, to 197 a share. So very interesting. So nonetheless, though, Tesla now performer in today's session. I mentioned the EV space. Here's another one that saw some move to the upside. EVgo shares jumping as much as 20% in today's session, finishing with a gain of just shy of 19%. Benchmark raising the price target on the $1.1 billion market cap operator of EV charging stations to $5 from $3 a share, talking about increased charging network utilization and a recent positive shift in market sentiment. And one more, because we like the nuts and bolts when it comes to what's going on in our economy. And a great read on that was Fastenal. That company up about 2% in today's session, off its highs of the days. This company coming out and it posted inline profit and sales for the second quarter. So earnings season definitely underway here.
Okay, this one's not on my list of decliners, but we do have a headline from Meta Platforms, which did finish the day down by 2.8% today in the after hours. Not moving much, but I'm talking about it because we have a headline that Meta has removed Trump account restrictions, this according to Axios. As a reminder, following what happened in January 6, 2021, Meta Platforms, in addition to other social media companies, Twitter at the time put restrictions on, at the time, the president's account there. You know, he's certainly the front runner. He's not the official nominee yet, but that is coming very soon. We'll continue to bring you updates on that story as we do get them. Let's get to some other movers, though. Other decliners. Carol did mention some financial institutions that did move higher. I got ones that moved lower on the day today. I do want to start with shares of Wells Fargo, which actually saw their biggest drop since last year's regional bank crisis. Second quarter results were hit by higher than expected costs. Shares today fell by just about 6%. Expenses for the quarter climbed 2% to $13.3 billion. It was higher than the 0.2% increase that analysts had expected. The vast majority of that increase coming from operating losses. Analysts also pointed out the firm's higher expense guidance for the year. Also, keep an eye on shares of what happened over at Citi. The company reported earnings earlier in the day. They did pair a rally that had taken it up 28% this year through Thursday. Shares finished the day down by 1.8%. Citigroup said that costs for the year are now likely to be at the high end of the range it previously